to ensure voting rights for people of color. And so the Supreme Court already has taken away a section that required certain states to get pre-clearance before they redistrict, and that was a case called Shelby County versus Holder. And now in this case, it appears they're also getting rid of the possibility of challenging gerrymandering based on race.
Okay, cool.
This could affect, I think people have said as many as 12 different congressional districts throughout the country. So it's a 6-3 vote because the 3 liberals are in dissent. You know, this court has really dismantled voting rights over and over again. So this is shocking in a way, but it's not a surprise after hearing the oral arguments.
So
What?
I'm sorry.
Oh, no. So what implications does this have beyond Louisiana? Because I'm sure plenty of states are watching this carefully.
Yeah, as I said, there are I think around 12 different districts that could be affected by this. And of course, they're mostly, I think they're all Democratic representatives in those districts right now. So if you take out the use of race and it's gerrymandered again, you're going to have less Democratic districts, most likely, less districts where people of color are in the majority. So I heard one election expert say that this is just sort of like Armageddon for voting rights if they decided to do what they did here. And it was written by Justice Alito, and I haven't gotten through it. It's written by Justice Alito, so you can imagine that it's very, very strict and very, very, he's always votes against voting rights. So
There you go. All right, June, thank you so much. Appreciate that. June Grosso, Bloomberg's legal analyst. Again, the Supreme Court curbs use of race in drawing voting districts. Another red headline, Scarlet crossing the Bloomberg terminal here. Warsh Fed chair nomination clears Senate panel vote. So after much delay, moving very quickly here. So we want to bring in Enda Curran, Bloomberg Fed and economics reporter. Enda, it looks like we're making some progress here, or the Congress is making some progress on getting Mr. Warsh on board.
Yeah, so after many months of protracted negotiations, we finally have had that committee vote now. So this moves Mr. Warsh's nomination out of the Banking Committee, and it should go on to the Senate floor for a full vote. Probably at some point soon. Mr. Powell, current Fed Chair, Mr. Powell's term ends on May 15th. Whether or not Mr. Warsh gets his full vote by then, or whether he's a few days over, it doesn't really matter very much because the next policy meeting after today isn't until the middle of June. So today just really cements that after that extraordinary succession drama we've had since January over the DOJ investigation and all the rest of it around all the rest of questions around the Fed, Mr. Warsh has now cleared that critical vote and is on the way to be the next chair.
Right. The question now is what happens with Jay Powell's seat. His term as chair ends on May 15th. Do you think this is something he's going to address at the news conference at 2:30, Enda?
I think it'll be hard to avoid it, Scarlett. As you say, his term as chair will end in the middle of next month, but he's entitled to remain on as a governor at the Fed until January 2028. Typically speaking, Fed chairs head off and enjoy their retirement or head into the sunset. But Mr. Powell made it clear, was it maybe last month, I think it was, in his press conference, that he can't leave his governor role until the spectre of that DOJ investigation into him and the Fed is cleared in all finality. Now, there's a debate over whether or not what the DOJ did last week in terms of dropping their investigation does meet that threshold of finality, because two things. A, they continue to appeal against the Fed's court win that quashed the DOJ subpoena in the first place. That's one thread on this. And the second part of it is the Inspector General investigation into the Fed, into the cost of the building renovation there, is expected to report at some point over the summer. And the DOJ made it clear they have a threat that they could renew their investigation depending on what that particular finding from the IG throws up. So from Mr. Powell's point of view, he may want to hang on till all of that's clear. Critics would say he should just move on because it risks sort of stoking political resentment and political criticism of the Fed. But he's sure to comment on it, I would imagine, at his press conference later today.
Independence of the Fed, where is that discussion these days, Enda?
It's become very fraught, very divisive, of course. You know, Mr. President Trump continues to hammer the Fed over interest rates. He wants them brought down quickly. He's even said that he would be disappointed if Mr. Walsh, if he gets finally confirmed as chair, doesn't get a move on pretty quickly as well. So that political pressure continues to be there. We await, of course, the outcome of the Supreme Court ruling on the Governor Cook case. That's going to be very important. We'll wait and see what Mr. Powell signals about his future. That's going to be very important. But I think putting now in the end of the year, there will be a lot of focus on how will Mr. Walsh respond to political criticism? Will he kind of stand up as a heat shield for the Fed, or will he be seen as buckling under Mr. Trump's pressure on the one hand? And on the other hand, how do the rest of the policymakers react, including Mr. Powell, like Ms. Cook, etc.? So lots of question marks still in terms of the mood music hanging around the Fed.
We've kind of addressed all the existential questions related to the Fed. I didn't even get to the decision itself, which comes out at 2 p.m. We know that the Fed is unlikely to do anything with the rates. It'll keep them unchanged at 3.5 to 3.75%. What is the thinking in terms of any kind of tweak to the language inside the policy statement?
Absolutely right, Scarlett. Probably because of the Iran war, they're kind of sitting on the sidelines, waiting to see where things go. So no change on the policy side, like you mentioned. There has been, though, this kind of debate a bit behind the scenes at the Fed about whether or not they should be signalling in the statement that, there's two-sided risk here. For sure, at some point we could lower interest rates. That was the story before the Iran war. But some officials at the Fed have been saying we should be warning that at some point we may have to raise interest rates. And it would be interesting to see if Mr. Powell sort of puts a bit of colour around that, if he says that debate gathered more steam today, whether or not even that line does appear in the statement, this idea that there should be two-sided risk signalled to the public. Some people think Mr. Powell won't want to signal too much new in his last press conference as chair. He wants to hand over to the new incoming chair and let him sort out the messaging. But I think that's one thread on today's story which people will be keeping an eye on.
All right, and thank you so much. Really appreciate it. Enda Curran, global economy reporter for Bloomberg News. He's based down there in Washington, D.C. Again, I was going to say the big news of the morning, but I'll just say one of the big pieces of news this morning.
So many headlines.
Is the U.S. Supreme Court limited the use of the Voting Rights Act to create predominantly black or Hispanic election districts in a major constitutional ruling that buttresses Republican efforts to keep control of the House in this year's midterms and beyond. We want to go back to June Grosso. She is Bloomberg's legal analyst here. June, talk to us about the history of this ruling and this aspect of redistricting.
So, I mean, the Voting Rights Act has been under fire for, such a long time, and the Roberts Court has been very receptive to sort of destroying, I'll use the word destroying, the Voting Rights Act. In 2018, I believe it was, they took one part of the act which required pre-clearance. Certain states that had a history, considered to have a history of racism, Texas, et cetera, certain states in the South, would have to get pre-clearance before they redistricted, before their plans were approved. They took away that. And now this is really the other significant part of the Voting Rights Act, the remaining part of the Voting Rights Act, which was passed in 1965 to address discrimination against black votes. And I'll just read a line from what the dissenting opinion of Justice Elena Kagan, the three liberals who are in dissent, said, under the court's new view of Section 2 of the Voting Rights Act, a state can, without legal consequence, systematically dilute minority citizens' voting power. Of course, the majority does not announce today's holding that way, but it's understated, even antiseptic. So, I mean, this is really consequential, and it's consequential for, I think, the Republicans, holding the House. If some of these states can redistrict before the midterms, I mean, I don't know if that would be possible as far as timing, but it really is consequential for voting rights. And the court has, systematically through the years, you hear them say, well, we're so far away from the time of the Voting Rights Act, and there isn't, I think Justice Roberts was the one who said in Shelby County, we don't have that kind of discrimination anymore. Okay. So we don't, and how long can we keep doing this? How long can we keep having these rules that prioritize, race in voting districts? So I think it's a stunning decision, although the court has been heading in this way for a long time. I think a lot of people hoped that they wouldn't get to it at this point. But it's really consequential.
It's consequential, and you go back to the Voting Rights Act that you mentioned and how this is kind of part of the dismantling of it. What is left of the Voting Rights Act right now?
I don't think there's much left of it. I have to get an expert because the two biggest sections were the section that was eliminated or gutted in the Shelby County case, and then this section. So I don't think there's much left of the Voting Rights Act.
How are districts drawn up in the first place? I mean, that's my question.
That is a great question.
Well, gerrymandering. Have you seen you seen some of the even if you look in Louisiana, in order to keep the House Speaker in a Republican district, they have these odd shapes that you would never imagine, different kinds of weird shapes so they can get in people that they want. It's political at this point. It's, and the Democratic states do it as well. The Republican states do it as well. And it's just I don't know.
My old district in New Jersey, which we've since moved from, I finally saw it drawn somewhere, and it was unbelievably.
It's just a bunch of squiggly lines everywhere.
I'm like, how did they figure that out? Because having lived there, that's not how I think of my area.
No.
My area is this town, this town, this town.
No, it's been cherry picked.
Yes, exactly.
They have people who do this for a living, and they have all kinds of, electronic ways of doing it. But if you looked at this, the one in Louisiana looks like a sliver up the coast. But all the states
do that. Right?
And, there's the only thing that has happened but only in Democratic states, they've had maps drawn by commissions. So in that way, you get a fair map because it's drawn by a commission with maybe equal representatives on. But only Democratic states have done that, and that's put them in a bad position, which is why you have some states like California redistricting in a different way, not using the commission. So the way to do it is to, have a commission. But when you let Republicans or Democrats do it, they're going to do it to their own advantage. And it's so easy for them to draw maps and just eliminate certain, minority populations. It's a mess. It's a mess, really. It's just a mess.
Let me ask a really dumb question. When the Supreme Court makes a ruling like this, people jump into action right away, right? This has immediate consequences?
Well, yeah. Well, I think what will happen is, states will start looking at this and deciding what to do. Louisiana certainly is going to jump into action. Yeah, because what they're going to do is, the politics of it, they're going to start looking at their maps and seeing what they can do and how they can use their power as legislators to redraw the maps. I just think this is opening up a can of worms that, the implications are just crazy, I think, as far as what's going to happen next. Because, you see that what's happening. Florida is trying to redraw its maps without even this decision. So, we've come to the point where are we going to have Democratic states with all Democratic districts and Republican states with all Republican districts? It's sort of mind-boggling. I'm still stunned by this.
Does this change any of what California voters just decided or what Virginia voters decided?
No, I don't think this has anything to do with that because that was a separate. I think that Texas passed the Supreme Court. I think California may have passed the Supreme Court as well. They're saying that wasn't based on race, that was based on politics. And it's okay to gerrymander based on politics. So think about that. Think of it. It's okay to gerrymander based on politics. So, Republicans and Democrats are fine, or they're allowed to go in and gerrymander based on politics. Before this decision, it was just you couldn't gerrymander based on race, and now you can gerrymander basically based on race, no matter what the Supreme Court said in its majority opinion.
What's left for the Supreme Court this session here? This was a big one.
Yeah, the case that we're waiting for at Bloomberg is the case of the attempted firing by President Trump of Lisa Cook, the Fed Reserve governor. And the thing is that every week that it's opinion day, we expect that case to come out because it was argued so long ago and because it seemed like the justices were on board with not allowing her to be fired. But it's taking so long that you start to wonder what's happening. Is it because they were writing a lot of concurrences and dissents? Is it because they're having a hard time distinguishing as they want to the Fed chair from other board members that he's fired? So is that what's taking them long? Are they just holding it?
That's what I think. I think they're just good programmers, and they're holding their juiciest one for
They
the
say they don't. They say they don't, but I don't. I really don't believe that, because it's no coincidence that all these controversial cases come down the last day of the term. So
when is the last day of the term?
well, it's a movable date.
Okay.
It used to be the very end of June, and then they would go on vacation. But it's now, we've had a couple of times where it went into July because they couldn't get their stuff finished, and they had so many late-breaking opinions. There used to be, I mean, there's a story about a justice that used to have his car waiting outside the court the last day, so they could drive him to his vacation spot. Then they all disappear and go to different locations for the summer.
All right, very good. June Grasso, thank you so much for that analysis there. June Grasso, Bloomberg's legal analyst, giving us the latest on the Supreme Court ruling. I want to bring in Michael McKee, covers all the economics and international aspects of our reporting for Bloomberg. Michael, you're down there in D.C. You've got a Fed meeting today, but boy, we just had a Supreme Court ruling, which has obviously political ramifications for this country, and maybe economics as well. What's your initial take of the Supreme Court ruling here?
Well, the ruling sets the stage for states to redraw congressional districts, but the question is, do they have time to do that? In some states where they have a number of black majority districts, it's already too late because filing deadlines for primaries have already passed. The issue is how many states could still do it. One expects that Louisiana would try, but the secondary question is then how far do they get with this? Because if you draw the districts, somebody is going to complain to the courts about it. It goes back into the court system to question whether the new maps are discriminatory in one way or another. It does have a long-term foundational impact, however, in that it dilutes minority voting power in the sense that you can't create a district that is basically guaranteed to elect a minority, and that would be a question of disenfranchisement for a lot of people. And the kind of deal that many states made that they would never admit is that we'll give you your own minority district, and then we will be able to use the rest of the state for our own white majority districts, and most states Republican districts. So at this point, there could be a shift in the balance of power in some states once they can get around to actually changing their congressional districts.
Boy, this gets messy really quickly. And that's the net effect of this kind of decision. Was this a surprise, the way that Supreme Court ruled?
No, it's not at all. In fact, legal and political analysts had been expecting this for quite some time. The court has not liked the Voting Rights Act for many years. Chief Justice Roberts has said that while it was useful at one time, it cannot be permanent law because many of the states and many of the aspects of the Voting Rights Act have been, you'd say, cured, taken care of. People can vote, poll taxes are gone, that sort of thing. So they've been gutting it one section at a time. This is Section 2, and now it is gone. So the Voting Rights Act itself is not worth much anymore, but that was expected, and that's why you have a lot of lawyers, especially on the Democratic side, waiting to pounce on any new districts redrawn to see if they can make the case that they discriminate in one way or another and aren't fair.
All right, Michael, you're down in Washington, D.C., and we have the Fed statement at 2 p.m. and the Fed conference with the media at 2:30. It looks like Mr. Warsh's nomination, after being grounded to a halt, is moving very quickly here today. What's the latest?
Well, it was always expected to move quickly once Senator Tillis dropped his objections because the Republicans control the banking committee, and that's what happened, a 13-11 vote. Most of the Democrats did not even show up for the vote. They voted by what's called proxy. Next, he goes to the floor. Now, they could do it within 24 hours. That's the limit. They have to wait before they can bring it to the floor. But the Senate is so wrapped up in other business with the budget, with the FISA surveillance warrant bill, that at this point, it's probably going to be another 2 weeks because they're off next week. And so maybe the
Wait, they're
second
off next
week
week
of May. They're off next week. It's not a surprise. Legislative days are not the same as calendar days.
Clearly.
So it's probably going to be the best guess is the second week of May, which would be in time for him to take over as chair on the 15th when Jay Powell's term is up.
Okay, so that being the case, that this full vote will probably happen before May 15th when Jay Powell's term is up as chair. How does that change or affect, or maybe not at all, the news conference that Jay Powell will be hosting at 2:30 p.m.?
I don't think it changes at all because nobody expected Warsh not to get through the committee. The question is really, does Jay Powell want to wait around and see what criminal jeopardy might still be out there for him? They've dropped the probe at the Department of Justice, but said they could bring it back if the Inspector General finds any criminal liability. And even if they didn't, this Justice Department has shown that it can sort of make things up to try to pursue you. And we saw that with the Comey indictment yesterday. So does Jay Powell trust that the investigation is well and truly over, in his words, enough to resign? There's also the possibility, which has been talked about, that he might want to wait until after the midterms. If Democrats were to win the Senate, then they could block any particularly difficult nomination to the Fed by President Trump, and so he might want to do that. He's talked about preserving the Fed's integrity. So that's going to be the major question surrounding today's meeting, whether Jay Powell.
What are maybe the expectations for Kevin Warsh and his chairmanship?
Well, the expectation is that it's not going to be very dramatic when he takes over because the economy sort of has the Fed boxed in at this point. Inflation is rising, and the longer the the Strait of Hormuz is closed, the more danger the economy faces from higher inflation from not just energy prices, but from second-round effects from things like food prices because fertilizer's not getting through. So they can't really move to lowering rates as the president wants right now, and they don't really know what their timing is going to be as long as the war drags on. So Warsh will come in and we'll have a series of meetings probably where the Fed does nothing. Maybe he starts to talk to them about the idea of getting rid of the dot plot or changing some communications, but since he's just walking in the door, it's probably not something that's going to happen immediately. And of course, if Jay Powell stays on, it raises a question of who's really influencing the Fed at that point. Awkward, yes.
All right, Mike McKee, thank you so much. Mike McKee is our chief economics and policy correspondent here in New York, but he is in Washington, of course, to attend that FOMC decision due out at 2 p.m. Eastern time. Of course, we will have special coverage of the Fed Decides starting at 1:30 p.m. Tom Keene, Jonathan Farrow, and Lisa Bromwitz, they will be on Bloomberg Radio, Bloomberg Television. You want to keep it right here as we cover all of that. And ahead of that decision, we have a mixed day in equities right now. The S&P barely higher, the Nasdaq up about 0.2%.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
1040 on Wall Street. I'm Alexis Christoforous. This Bloomberg Business Flash is brought to you by IBKR. Trade, election, climate, and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest on your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. Oil is spiking today as the U.S. signaled it would stick with a naval blockade of Iranian ports to choke off Tehran's oil exports and force it back to the negotiating table. Brent crude is now above $117 the barrel. West Texas Intermediate crude up nearly 5% at about $105 a barrel. Ahead of today's Federal Reserve meeting on interest rates, likely the last with Jay Powell as chair, stocks are mixed. S&P 500 up about 3 points. Dow Jones Industrial Average down about 220. NASDAQ Composite up 45. As for some stocks in the spotlight, shares of Seagate Technology racing ahead 15% after the company said the data storage needs of quickly growing artificial intelligence applications helped more than double its profit during the latest quarter. Shares of Adidas up about 7.5% after reporting an upbeat first quarter report card supported by strong momentum in its apparel division and healthy demand for its soccer and running shoes. And shares of Biogen up 2.5%. Sales beat expectations. It's a sign the company's Alzheimer's drug is helping offset pressure of its multiple sclerosis franchise. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Paul and Scarlett.
Thank you so much, Alexis. That's a lot of news to digest. We went through a lot of earnings. We've got a lot more to come this afternoon, Paul, with 80 seconds of big tech earnings.
Wow.
That's according to a Bloomberg News story headline that will decide the stock market's fate after 4 p.m. this evening. Absolutely.
We got four of the biggest companies in the U.S., Alphabet, Amazon, Meta, and Microsoft, all reporting after the close here today. Let's welcome in David Kirkpatrick, founder of Techomony. He's been covering this tech space for a very long time. David, we got these big companies reporting after the close here today. The focus is going to be on AI. How are you looking at AI these days, and how do you think the companies are approaching AI these days?
Wow, Paul, thanks for having me. A great big question. Obviously, AI is the historic, massive technological transformation that is washing over all of us these days. So it is the story in technology and to some extent in business and certainly the defining story for the markets in many ways. So these companies have all executed extraordinarily well in the last couple of years, I would say. They have made shockingly large commitments to investing in this new technology. The question that will be on investors' minds today and for the foreseeable future is, have their bets been so large as to be illogical given the scale of revenues and profits that are possible as a result? But, I think today is going to be a pretty good day for these companies from an earnings point of view. The question is, will they disturb people with their forward projections, with what they say they're going to have to spend in the future, and with what they say about what might happen next quarter?
Yeah, that's a great way to put it. And let's just quantify that shockingly large investment that these hyperscalers have made in AI. They've earmarked $660 billion for 2026 on AI infrastructure. I know, it's so mind-bogglingly large. My question to you, David, is that sometimes investors are okay with what these companies are projecting. They feel comfortable with it. They cheer it, in fact. Other times they get really nervous and they kind of sell off the stock because it's much larger than they thought, or it's something that doesn't feel good at the moment. Where do you think we are with that?
Well, I think we're on a precarious knife edge, really. And I think that's hard to say because people are very aware that these stocks are very highly valued and the expectations are huge. And the entire market, to some extent, resides upon the outcome of these questions. So, the stakes are extremely high. So I don't think every investor is in the same place, but I would say on balance, they have to be very decisive today that they are making the right bets and that they will pay off over the long term and to some extent over the short term. I mean, obviously, investing as, you know, on average, these companies of the four we're talking about are putting maybe 150 billion, they claim, into, on average, into AI infrastructure this year. We won't see the profit results from that in the next couple quarters, but investors have to be reassured that there is potential profit coming that's proportionate to this historically large investment. I am not convinced, by the way, that there will be.
David, how about if you focus on Google here? I'm probably one of those people that said, boy, I think Google is going to fundamentally threaten search as we know it. And the biggest potential loser in that scenario would be Google. How do you view it?
Well, a lot of people worried about that, but that seems so far not to be true. I mean, Google, as the company that essentially invented a lot of the current AI design, the transformers that are at the base of this magical technology, they're in a very good position because they have extraordinarily high quality technology and a very, very good AI model. And they have done an also very good job, in my opinion, of using it to keep their search customers satisfied. The question is not so much, will Google continue to dominate search? There's a more interesting question, which isn't one that investors focus on so much, but as more and more of the Google search users do no longer need to click out of those search results, is this new model that Google has successfully used going to undermine the existence of the internet as an informational resource because people aren't going to the websites that produce this information anymore? So that's an interesting question, but I think Google is doing extraordinarily well, and Gemini has really risen as close to the top of the pack as anyone for its quality and its reliability.
David, I got to ask you about Meta as well, the company formerly known as Facebook, because you wrote the book on Facebook back in the day, The Inside Story of the Company That Is Connecting the World. We got word from China that their authorities ordered Meta to unwind the takeover, their takeover of Manus, which is an AI startup. China, just like the U.S., does not want the transfer of sensitive technology to a geopolitical rival. What does that mean for a company like Meta, which for the most part does not grow its own innovation? Oftentimes it kind of copies what others are doing or buys its way to dominance.
Well, in the case of AI, they've done both. They've done quite a bit of internal development, but they've also bought the majority interest in Scale AI and Manus and other companies. This issue of disentangling an acquisition that is essentially complete is a very challenging problem for them, but it's a bigger problem for the Chinese government and for Manus in some ways than it is for Meta, because, you know, if they had to somehow successfully strip out the Manus components, they would continue to be very well positioned in AI. I think it's an open question. You know, it's been widely reported in the last couple of days that the investors in Manus have already distributed the profits that they got from selling the company. So how is Meta going to get back the money they paid? It's a big problem, and it sounds like a lot of money, $2 billion, but with a company that's worth like 1.7 trillion in the markets, it's really not that big, and it's a vexing, weird problem, but isn't that big of a deal, in my opinion.
Dave, about 30 seconds left. How concerned should software as service companies be with AI?
That's a really good question. I wish I had the answer. Right now, my gut is not as concerned as has sometimes been said. But the really unknown is how completely is AI going to be able to essentially on the fly reconfigure any kind of software in the future for users based on their needs. If it turns out that the most aggressive predictions are true, that can happen, then really all these software as a service companies will have a serious problem. Yep. But the data repositories they control are so important. For now, I think they're fine.
All right, good stuff. David, always a pleasure speaking with you. David Kirkpatrick is founder of Techonomy, and of course, he is the author of The Facebook Effect, the inside story of the company that is connecting the world. Paul, we have another red headline here on the Bloomberg that just crossed. The Pentagon says the U.S. government has spent $25 billion on the Iran war so far. About, what, 8 weeks in, 9 weeks in?
Okay, all right. That's the bill that the Pentagon is disclosing here, and I'm not sure where the end is.
That is the big question.
But we have a ceasefire, so maybe this is one.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. So you can check us out there. Again, we got the 4 big mega tech companies reporting after the close. We're talking Amazon, Alphabet, Meta, and Microsoft. One of the issues is the growth of AI. And we've seen the market really discern winners and potential losers from AI. And one of the sectors that's come under pressure has been software, particularly software as a service sector. So we're going to break that down a little bit. We can do that with Neeraj Patel, Senior Software Analyst at Bloomberg Intelligence. Neeraj, I know you put out a research note recently on this, but we saw earlier, or late last year, earlier this year, some software stocks, and particularly the software as a service stocks like ServiceNow and Salesforce, really get sold off here. What's your view?
Yeah, I think when we look at the AI disruption to application software, huge market, 700 billion market, but definitely there's winners and losers. And from our view, system of record companies like Salesforce, like Workday, like SAP are in the at least not going to be structurally replaced by AI. Other companies that are in marketing application, HubSpot, Klaviyo, even some of Salesforce marketing, Adobe marketing, they have more pressure there because it's a very heavy language-based, repetitive type of solution that they offer to the clients, which AI is very good at. So we think they're more suspect to being displaced.
The software market is massive. We kind of forget that sometimes because we talk about only the big players, but there's a lot of startups and they're borrowing from the private credit market as well. And I go back to some news from the previous week about a Blackstone fund cutting the value of its loan to a dental implant company. That's, kind of private credit woes continued. But Blackstone also refused to extend a lifeline to a software company, Medallia. And I know that's kind of out of the purview of, the big software companies that we cover that are listed. But I'm wondering whether there's any spillover to the bigger software companies from something like that.
Yeah, I think it's a ripple effect. And I think you've seen this with the valuation coming down. And when we look at a couple valuation metrics, even for the big, large cap companies, they're trading on par with the S&P 500. That's never happened historically. They're trading at 20 times forward earnings, and they have about an 8 to 9% sales growth rate and an operating margin that's on par. And there is definitely spillover from these smaller companies because what that is signaling to us is the additional growth, which was an additional analytic or AI layer like Medallia was selling, like these other companies were providing, was sitting on top of a base core package. So the additional growth rate is being pulled down because AI is attacking the workflow layer, the analytic layer, the insight layer, which was an upsell and additional cross-sell for these companies.
What can some of these software companies do, I don't know, to protect their business, to defend against AI? What can they do?
Yeah, I think they're taking the steps. We're just not seeing it in the financials, and we're not going to see it for the next couple of quarters. You're going to see this steady low teens growth rate. The gross margin is going to be preserved, but under the hood, they are developing a lot of agents for their portfolios, and that's exactly what they should be doing. They're introducing agents, and they're introducing them quite aggressively. They're not going to charge customers for this additional usage. They want to land that account, and maybe after mid-2027, we expect some repricing of the subscription and the outcome task-based solution. So they're definitely taking the steps that they should be in introducing agent and AI native solutions, but it's just going to be, we're going to have to wait for some type of AI monetization to surface from these companies, which is going to take until mid-2027 from our view.
Neeraj, we were talking earlier about how 4 of the Mag 7 names are reporting earnings after the close. What will you be listening for as it affects your software industry?
Yeah, I think we've been trying to get a handle of, when is the financial impact to the application software and as well as infrastructure software going to take place? It's not there today, as we've stated. And I think, as you're pointing out, Scarlett, what do we look at is kind of a little gray. But what I've been focusing in on is what are the building blocks for these agents? And when I look at the building blocks, I see the coding agents, Claude Code, Cursor, OpenAI, Codex. Are the monthly downloads increasing there? Also, some of the other ecosystem metrics like MCP, which is a standard protocol of communication, are the downloads increasing there? Are the usage for orchestrating these agents? There's some other AI native solutions like LangChain and Crew AI. Is that usage being increased? So as long as that increase is continuing, which is being utilized by these big four cap companies, then we think agents are going to come to the enterprise, and it's just a matter of time. And it's giving us a signal that trend's underway.
Neeraj, thanks so much. Really appreciate it. Neeraj Patel, Senior Software Analyst for Bloomberg Intelligence. He's based down there in Princeton, covering the software stocks. Again, software stocks, particularly the software as a service stocks, really coming under pressure as the market tries to differentiate not only the winners in AI, but who might be displaced. And some of the software as a service companies were definitely being sold off earlier this year. So we'll be paying attention to some of the comments from the big tech companies this afternoon. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just a moment. S&P 500 absolutely unchanged on the day. The Dow's down 250 points. That's a 0.5%. But the Nasdaq eking out a little bit of a gain here, up 28 points, 0.1%. Being driven in large part by oil. WTI crude oil up $5.20 to $105 per barrel. 10-year Treasury yields higher by 5 basis points here today, pushing out to 4.39% on your 10-year. This is good.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Good Fed Day morning. Fed Day, of course, really beginning at around 2 p.m., but, you know, we're all preparing for it right now. This is Bloomberg Intelligence. Paul Sweeney and Scarlett Fu here with you as we get ready for a busy afternoon. We've got the FOMC decision, and we've got a lot of earnings coming up after the market close. We're going to talk about all of that, starting with Ira Jersey, our chief U.S. interest rate strategist, on the upcoming Fed decision, but also what a Fed Chair Kevin Warsh would mean and would do. Of course, he was just confirmed by the Senate Banking Committee. Now the vote goes to the entire Senate. Anurag Rana is our Bloomberg Intelligence technology analyst, and he'll be walking us through what he'll be listening for when it comes to the 4 Mag 7 names that will be reporting after the close: Alphabet, Meta, Amazon, and Microsoft. Rob Barnett, our senior energy and commodities analyst, will talk to us about oil. Those prices are on the rise this morning, with WTI up 5%, Brent also higher by 5%. We're now looking at $105 a barrel for the U.S. benchmark. And Nancy Tengler, CEO and CIO of Laffer Tengler Investments, gives us her stock picks. First, though, let's go now to Amy Morris for our Bloomberg Business Flash. Amy is in Washington.
Thank you, Scarlett. The entire stock market may be riding on 4 big names today: Alphabet, Amazon, Meta, and Microsoft, all reporting earnings this afternoon. Mandeep Singh is global head of tech research at Bloomberg Intelligence.
There needs to be clear beat and raises, and even a strong beat is not enough. You want to see them show, improving margins when it comes to the hyperscalers.
Mandeep Singh with Bloomberg Intelligence says the Magnificent 7 names could report within 80 seconds of each other right after the closing bell. The Fed's April rate decision also just hours away, 2 p.m. Wall Street time. The focus may be less on the future for rates than on Jay Powell's future as a member of the board after his term as chair runs out in just about 2 weeks. Bloomberg's Michael McKee in Washington.
We know the Fed isn't going to do anything now. They are sidelined, as are pretty much central banks around the world, waiting to see what happens with oil prices, with the war. And don't forget, we've got tariffs coming down the road, so there's a lot of uncertainty about where the economy is going.
Bloomberg's Mike McKee in Washington. Our coverage of the Fed decision and likely final Powell news conference begins at 1:30 this afternoon on a special edition of Bloomberg Surveillance. The Fed decides on Bloomberg Radio and television and the Bloomberg Business app. We do check markets for you all day long here at Bloomberg. The S&P 500 little changed on the downside. NASDAQ little changed on the upside, and the Dow down about 0.5%. 10-year Treasury yield at 4.39% and the 2-year yield at 3.88%. Checking WTI now topping $105 a barrel. Brent crude now topping $117 a barrel. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
All right, Amy Morris, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney. We're here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. As Amy was just reporting, we got some red and green on the screen here. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Avalon Purnell. Avalon, what are you looking at today?
Start off with one of the top performers on the S&P 500 this morning. That's NXP Semiconductors, ticker NXPI, jumping 25% to hit an intraday record. Wow. And that's after the chip maker reported first quarter results that surpassed expectations and also gave a second quarter forecast that beat estimates. Part of that optimism, though, which I found interesting, stems from growing demand from the auto industry as companies look to push more software-defined cars and EVs.
That's what I've kind of joked. I've been going to the CES conference in Vegas for like 30 years, and it used to be actually a consumer electronics show.
Not anymore.
Now it's an auto show, with some, so, and my new vehicle, I just upgraded, my lease expired, so I went from a 2023 model to a 2026. Even that changed from 3 years, I had to relearn everything.
Yeah.
That's how much it changed.
Well, I mean, a car is now just a tech gadget on wheels.
Yes, it's
essentially.
It's my iPhone with 4 wheels is what I say.
Well
so
said.
That's pretty interesting. And that's a 52-week high for NXP Semiconductors. What's next?
What's next is Wingstop. That's ticker Wing, now falling about 5.8%. That's after the chicken chain lowered its guidance for the full year as those first quarter same-store sales fell below expectations. The results really confirmed investor concerns that customer traffic to the chain is continued to significantly drop off. TD Cowen writing that it was a tough start and that part of the miss can also be attributed to Wingstop's customer base potentially being more exposed to those macro headwinds that we've seen throughout the start of the year. And some are also questioning if the loyalty program will help drive sales back as we head in towards the second half of the year. We'll see, though.
Everyone's got a loyalty program.
Yes.
Speaking of loyalty programs, there's one for Starbucks as well, and you're taking a look at that one.
Yes, that's ticker SBUX, B-U-X, now gaining close to 9% right now, most intraday since January. That's after the company's second quarter sales topped estimates, and it boosted its full-year comparable sales forecast. Starbucks largely had U.S. sales to thank for that beat, and interestingly enough, at least to me, the popularity of cold foam among Gen Z.
What?
Yeah, the sales of cold foam was up more than 40% in the second quarter. So looks like that push towards protein is working.
That's different from cold brew, right?
Yes. It's like the little foamy top that you have on top of your drink. Instead of whipped cream, you could get cold foam.
Okay. Double short mocha. I've been ordering the same thing for.
Now ask for cold foam.
Yeah,
oh, you should.
That's your protein.
My first Starbucks I ever went to like 100 years ago was outside the offices of Janus Financial in Denver, Colorado. And I walked in, no idea. I had no idea how to order, no idea.
You told them you wanted a small and they laughed at you.
Yeah, exactly. I got behind one of those people just Saturday. This person came in and like she had never been in a Starbucks before. So the
she was living under a rock.
I had spent like 10 or 15 minutes explaining all the drinks, and then we got to the sizes. And you couldn't forget that.
Yeah,
so
I know.
It was
you can't explain that.
The line was going crazy. People were going nuts. It was very funny to see. Very good. We appreciate that on the stocks on the move there. Avalon Purnell, we appreciate that. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We got the Fed meeting today. Big deal for those who follow the Fed and rates and treasuries and all that kind of stuff. There are people who actually do this for a living. Ira Jersey is one of them. He's the chief U.S. interest rate strategist for Bloomberg Intelligence. Ira, what are you going to be listening for from outgoing Fed Chairman Jay Powell? And I don't know, we may get an incoming chairman in the next couple of weeks.
Yeah, I mean, given that Kevin Warsh got through the Senate Banking Committee on a party line vote this morning, it's going to be a done deal that he's going to be the next Fed chair. He'll start in about 3 weeks in that seat, and then he'll take over the helm probably of the Federal Open Market Committee come mid-June at that meeting. I think Jay Powell, he'll obviously, given that this is likely his last meeting, there'll be a lot of questions about his time as chair. I think on a forward basis, it's going to be, incrementally what other members think and are thinking about the path of monetary policy. We see, with oil prices back up above 100 and the like, I think that will be certainly something that he's asked about quite a lot is what are these pass-on inflationary effects and what it might mean if, it seems like inflation expectations become unanchored.
How much of a language change are we going to see in the statement itself? Because right now, the FOMC has this posture that the next move is more likely to be a cut than a hike. Will they remove that language? And if they do, what kind of signal does that send?
Well, Scarlett, they did take an incremental step back in March, right toward the beginning of the war, where they became a little bit more balanced than they were in January, right? January's statement was more dovish, and the last statement was, a little bit dovish, but mostly balanced. I think they might take another step toward being completely balanced. And when you look at things like other forward indicators that the Fed likes to look at, such as the Beige Book, the sentiment of the Beige Book, and we have a natural language processing model that looks at, all of the statements within these types of Fed communications, the Beige Book was completely neutral. So I think it's very likely that the Fed will continue to lean that way and basically say, hey, we might have to cut at some point in the future, but it's a long way off, particularly given the current economic environment and our fears and worries about inflation.
What do you think Fed Chairman Powell will do in terms of his term going forward?
Well, it's a good question. Typically you wind up getting Fed chairs typically resign after they finish their term as chair, and they also resign as governor. Now, Jay Powell's governorship doesn't end until January 2028, so he'd be allowed to stay. And it's not unprecedented. There have been a few former chairs that have stayed on to finish out their term as governor. But I think that as long as he's convinced in some way that the Justice Department won't come back and prosecute him when he's a private citizen, that he probably will, take a bow and leave his governorship as well. It'll be interesting to see if that happens and if that transition occurs very smoothly on May 15th, or if he stays on a little bit longer and kind of there's some lingering doubt. I suspect that he would like this to be behind him, so I think it's really in the DOJ's and the White House's purview now to kind of let him kind of go off and do whatever he's going to do next, probably in academia or in the private sector.
Yeah, retire first and then look at his options after that.
Exactly.
Ira, thank you so much. Ira Jersey is our chief U.S. interest rate strategist, joining us to preview the Fed decision and, of course, the Jay Powell news conference. It all begins at 2 p.m., but we will have coverage starting on Bloomberg Radio and Bloomberg Television at 1:30 p.m. with the Fed Decides. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Also, after the close today, we've got a slew of earnings. The argument that Bloomberg News is making is that 80 seconds of big tech earnings is going to decide the stock market's fate. The S&P 500 already holding near record highs, the NASDAQ as well. Let's bring in Anurag Rana, our Bloomberg Intelligence technology analyst, to give us a sense of what he'll be watching for. So we've got 4 big companies, Anurag, reporting today: Alphabet, Meta, Amazon, Microsoft. Which of these do you think has the potential to surprise?
I think all of them should show improvement in growth rates. The surprise could be on the Microsoft side, only because last time they talked about their cloud not accelerating as much as they would have liked, or in a sense, if they would have allocated more GPUs to their Azure business, it would have climbed more. The big wild card is, what is management going to do this time? Will they allocate those GPUs again, or will they please Wall Street by reporting a much higher cloud number? I think that's somewhere where we could see some divergence.
So what do you think the message is coming from these big tech companies this quarter as it relates to AI? I'm asking as it relates to spending and returns. How do you think how do you think the message should go?
the message should be very clear. There is a big opportunity that they have in front of them, which is evident from the backlog they have or the revenue that they have but not recognized. They have to build capacity in order to recognize that revenue. And for the investor side of it, they need to show that their core KPIs, which is for Google, Microsoft, and Amazon, is going to come clearly from their cloud revenue. And for Meta, it's going to be total revenue. So those numbers need to improve in order for them to show that their story is resonating, that they have a clear AI strategy.
Okay, so when it comes to spending, and this is a question I posed earlier to David Kirkpatrick as well, with CapEx spending, investors tend to be, I don't know, they haven't figured out whether they're comfortable with companies matching what they have forecast or being disappointed when that happens. It's kind of like it's either too hot or too cold. People just aren't comfortable. So where are investors positioned in terms of how comfortable they are with these big hyperscalers spending exactly what they had promised?
So let's say you could take any company in this example. If, let's say, Amazon decides and they want to increase CapEx, they go on and talk about, oh, we're going to raise CapEx for the next 12 months, but their cloud numbers have not improved. That's not going to go well. I think both have to go in tandem, that they are showcasing an improvement in cloud growth rate. At the same time, they're saying, listen, the book suddenly became much bigger this quarter than it was in the quarter before, which is why we are investing. So those KPIs need to match because you can't just go with one and, you know, that's not going to go well, frankly.
Who's from these big companies reporting after the close today? Are there winners and losers? Or people doing a little bit better than others, or is it just I got to own all these things?
Yeah, Paulo, it's a lot about it is timing as well. When we, when the three of us talked about the same thing about a year and a half ago, it was all about there was only one company showing this AI boost, and that was Microsoft because they were hosting the ChatGPT app. Now, when you look in the last 6 months, Claude has done really well, Anthropic has done really well, and Amazon Web Services is the choice cloud provider for them. We have also seen, as of a few days ago, OpenAI going to Amazon Web Services and adding their models to their portfolio, which means Amazon now has multiple things to sell. And if enterprise adoption is going up, then they are probably going to be better positioned in the next 12 months. In the case of Microsoft, they have, again, a really good cloud business growing 38%. It's not a small thing. But at the same time, they got to figure out their own model strategy. They have to figure out their own chip strategy. So they need to allocate some resources on that. So there's a lot of, I honestly, everybody's dissecting this in the third degree at this point. Yeah. But if you move back and think, all three of these companies will have much larger businesses 3 years from now than we are today.
Let me ask a very basic question. We keep talking about tech being kind of divorced from the macro and the geopolitical events taking place right now. But are they? Does what's happening in the Middle East affect any of these companies?
So I actually say that tech itself is divided into two buckets, AI versus non-AI spending. But when we look at non-AI spending, it's bad. It's really bad. When you look at results from ServiceNow, even SAP said that if the war continues for another quarter, they will see their cloud growth go down. Now, these are the companies that are not in AI infrastructure play. There are only 6-7 companies in the AI infrastructure play, and they are the only ones who are seeing the benefit irrespective of macro conditions. But all the others, we expect IBM Consulting, Accenture, all of them are seeing that pressure because of Iran, because of the allocation of spend, of enterprise spend from to AI from non-AI work.
All right, who's the genius that scheduled all these conference calls today for 5:30 Eastern time?
Yeah, it's going to be an interesting evening today. You're after 4 p.m. and you have to dissect every company in both in those three parameters of KPIs going up, cloud spending, as well as the CapEx. So it's going to be a lot of fun today.
I bumped as I was leaving work yesterday out on Lexington Avenue, bumped into Dan Ives. and he says, "Oh, the next 48 hours is
Yeah,
going to
brutal.
be."
He had to get sleep like last night in
Exactly.
advance of everything. All right, Anurag, thank you so much. Anurag Rana is our Bloomberg Intelligence Technology Analyst joining us from Chicago. And it kind of reminds me of the big bank earnings as well.
Yes.
You know, when big banks start reporting, you've got 4 of them coming out the same day, but at least they space it out. So it's like 1 per hour, you know?
Right. And then the conference calls don't necessarily on top of each other.
Right.
So again, from an investor
They need to
relations
spread a
perspective,
spreadsheet around, you know, and just
yes,
pass along and say,
they
you
all
know,
know.
here,
They all
what time
know.
are you going to report?
They all
What time are you
know.
going to report?
I don't think they care. All right, very good there. S&P down 7 points, the Dow off 267, and NASDAQ down 12 points here today. Crude oil higher yet again today, $105 on WTI crude.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Amy Morris. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. We check markets for you all day long here at Bloomberg. The S&P 500 down 0.1%. NASDAQ little changed on the downside, and the Dow is down about 0.5%. The 10-year Treasury yield at 4.39% and the 2-year yield at 3.88%. WTI now more than 5% higher, topping $105 a barrel. Brent crude also more than 5.5% higher, topping $117 a barrel. The entire stock market may be riding on 4 big names today: Alphabet, Amazon, Meta, and Microsoft, all reporting earnings this afternoon. We're also waiting for the Fed's April rate decision, plus possible insight into the future of Fed Chair Jay Powell. Our coverage of the Fed decision begins at 1:30 this afternoon on Bloomberg Radio and Television and the Bloomberg Business app. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Thank you so much, Amy. And of course, for once, the focus is not on the war in Iran and oil prices, because we've got so many other things going on. On the calendar, you've got the big tech earnings. You've also got the Fed decision. But oil prices do remain an issue, and certainly it's going to come up in the FOMC decision and certainly press conference. WTI and Brent are both up more than 4%, and the U.S. benchmark is now trading at $105 a barrel. Let's bring in Rob Barnett. He is our senior energy and commodities analyst to tell us more about what he is seeing. Rob, what's the big driver right now? I think everyone has kind of gotten into this this new normal of oil prices will remain higher for longer and the Strait of Hormuz remains blocked up.
Yeah, so I think that the market is trying to ascertain how quickly we're going to see a resolution to the conflict. And I like to think in scenarios. So if you kind of had 3 buckets to put things in, you could have status quo, basically where we are today. One day the strait maybe seems to be open, next day it's closed. You get a little bit of traffic flowing through, but very difficult oil environment. That puts us roughly at where we see crude today. You could see escalation even. If we return to a conflict, that could be a bullish signal for prices. And then we have the idea of normalization, which the market seems to think could happen. And certainly if you look at the forward curve, prices out in December or into next year are much lower than where we see spot at today.
So, Rob, when you talk to investors out there, I mean, are they factoring in some kind of longer-term risk premium for the oil coming out of that part of the world, even after the strait is presumably opened at some point?
Yeah, it's a good point, Paul. So when we think about oil prices, we entered the year really expecting an oversupplied market, kind of a bearish sentiment flowing through. I think now, given the conflict, you can raise the floor on where you think prices might end up, because even if you get that normalization scenario where things reopen, it's going to take a long time to get back to business as usual. We've really been stressing inventories, and so I think a lot of folks will want to refill and get storage levels back up to perhaps where they were before the conflict. And that's going to take some time. But at the same time, you've got conflicting narratives out there, right? So yesterday we saw the headlines that UAE is leaving OPEC. That's ultimately going to bring more supply to the market once the strait is open and once things normalize. So there are some contrasting signals out there, but at least in the near term, probably the floor on pricing could be elevated versus where you might have been thinking at the start of this year.
Yeah, higher for longer, in other words. One thing that is really striking to me, Rob, is the idea that natural gas prices in the U.S. is below zero if you look at Permian natural gas versus what we're seeing in Europe, which they, of course, have gone up and remain higher. How long can that divergence last for?
Well, this is really leading to a great renaissance in some sense for the U.S., whether you're looking at LNG exports or petrochemical businesses. I mean, the U.S. is very competitive versus Europe or Asia or many parts of the world because we do have this abundance of shale natural gas. And we generally think that even if you saw some uptick in prices on the gas side here in America, there do tend to be seasonal variations, but we do have a sort of healthy amount of relatively low cost supply. And at least in the near term, I would continue to anticipate a very big disconnect between U.S. natural gas prices and European natural gas prices. And part of that has to do with how Europe has approached its energy policy. It's been prioritizing decarbonization over the last decade and not thinking too much about energy security. Given where we are today, perhaps that's a bit of a mistake, and it's been a good news story for anyone with exposure on the gas side in the U.S. just because we get cheap molecules.
Rob, at $105 per barrel, I'm going to go down in Texas and start drilling some holes here. What's happening with our oil producers? Are they taking advantage of this and ramping up production?
Well, Paul, you've raised a really interesting point. Higher oil prices is really great for folks in the oil patch. And my general sense is we are going to see some response on the production side given where prices are. But you got to keep in mind, this is a boom-bust industry, and many folks in the industry, they've got long memories. They know when prices run up, they're worried that there'll be a correction to the downside at some point and they'll get burned. And so there's this tension of, well, cash flow's higher right now, but what do you do with that cash? Do you return it to shareholders, or do you start to let CapEx budgets increase and raise production? I think we're going to see a little bit of a mixed narrative on that. I do not think that the U.S. can fully make up for the Strait of Hormuz being closed. So while U.S. and North America are going to be more dominant, they can't fill the gap completely.
Rob, always a pleasure speaking with you. Rob Barnett is our senior energy and commodities analyst for Bloomberg Intelligence, joining us from Miami. Here with us in studio, as opposed to in Arizona, is Nancy Tengler. She's CEO and CIO of Laffer Tengler Investments. So great to see you in New York with us.
Thank you, Scarlett. Good to be here. Great
so
weather.
I was noticing and taking a look at your notes that you've been trimming your energy holdings. We're just talking about energy companies. You've been trimming your energy holdings about a month ago. What's your exposure now to oil companies, given what we're seeing overseas?
So we exited EOG Resources, and that was what brought our holdings down. We're still overweight the S&P sector, but we own Chevron, EQT, and we added to Williams during that period. So, our thought was just that we got a great run in the first quarter. We saw some other places to redeploy, and so that is what we did.
Overall in the market, are you surprised at the degree to which the market rebounded off of those initial declines when the war started? Boy, the market just kind of ripped back higher.
Yeah, it's like 42 days down, 11 days up. So on April 4th, I wrote a piece that we published on the 6th that said I thought we had bottomed. We may have actually bottomed a little bit before that, but we were in buying on the 7th, which was the Monday. And we added to risk assets. So we added to some of the software names like Palantir and Microsoft. We also added to Starbucks and some of the other consumer discretionary names like Ulta and TJ Maxx. And then we added to GE Vernova, which looks super smart after earnings. It's had a little trouble in the last couple of days, but we're in that one for the long term. So I think we're pretty bullish, to answer the question, Paul. And so we've been using these periods like DeepSeek, like the war, as an opportunity to add to high quality names.
You got out of energy, or at least trimmed your exposure to certain names. What about software? Because not all tech is created equal. So, there's the AI plays and then there's software.
Yeah, it's hard. So we used to have Adobe in our 12 best ideas portfolio, and it wasn't feeling like a best idea. And that was about almost 2 years ago now. So we sold it. And what we didn't see was a management team that was pivoting to the new AI options. Same with Salesforce. Also used to be a member. We kicked it out of both our 12 best and our growth portfolios. And I think those were the right decisions. The one where we've really had to take a big gulp is ServiceNow. I think Bill McDermott's one of the best CEOs in the industry. I think they will be a winner, but you've got a lot of the shorts in there, and until they exit, same with Palantir and Michael Burry. They will ultimately be tailwinds, but for now they're headwinds. And so we've been adding to ServiceNow and Palantir as well.
As we all know, a big afternoon of earnings coming up here after the close. What are you going to be looking for, given that you do have exposure to the technology space?
Yeah, actually, we own all of them except for Meta, all the big players. And we own Apple, which will be obviously tomorrow, most of which are in our TGLR ETF. But I think what I would say is we're going to be looking for monetization of AI. So the knock on Microsoft has been they were capacity constrained. So we hope that logjam has lifted a little bit. We'll be looking at Amazon, which is our favorite in the group at the moment, just because it had lagged. And so has Microsoft, which we recently added to, but we've been adding to Amazon over the last year. I think we'll be looking for advertising there and the Trainium part of the business, and then of course AWS, like everyone else. And we're going to be thinking about backlogs, like where are these companies in terms of capacity, because that will give us information for the chip stocks and for the infrastructure stocks.
That TGLR ETF, by the way, the ticker is hands down like the best ETF ticker, short for Tangler. Nancy, talk a little bit about why you don't own Meta. You mentioned you have all the big Mag 7 names that are reporting today, with the exception of Meta. Why not?
Yeah, we had shifted out of Meta into Spotify a number of years ago and watched Meta go up, but Spotify go up more until recently. I think for me, it's the business model. I don't love it. I don't love the purpose of the software. And I don't really, I'm not a big cheerleader for the CEO, let's put it that way, and the two-share business. But mostly it's because it's going to be difficult for them to monetize AI. And so they're going to use it, and they're going to use it in advertising, but they're not going to be one of the pivotal players in our view. So we thought there were better places to be, and I haven't seen a reason to get back in.
30 seconds, Nancy. We go to the Fed meeting today. What are you going to be looking for from the outgoing chairman?
Yes, I'm going to be looking to hear if he's leaving or not.
Right. Yep.
And then I just think, kudos, well wishes, and I don't think we're going to get a rate hike. And I think even though everyone's saying that Warsh is only one vote, we haven't heard that in the past when it was Powell, just one vote. So I think Warsh is a consensus builder, and hopefully we'll hear a very friendly handoff.
Do you think Jay Powell will answer the question directly on whether he's going to step down? No? Okay. So he'll continue to obfuscate.
I think so.
All right. Just asking for the prediction markets people, right?
Right.
That's great.
Nancy Tangler is CEO and Chief Investment Officer at Laffer Tangler Investments. Always a pleasure speaking with you, Nancy, and thank you for coming in again. We are looking at stocks marching lower right now. The S&P lower by 1/10%. The Dow off by 2/3%, and the NASDAQ little change right now. A big, big day of earnings coming up with a number of big earnings being reported. Alphabet, Meta, Amazon, and Microsoft, and that FOMC decision at 2 p.m. Eastern time, followed by Jay Powell's news conference at 2:30 p.m. Oil prices are higher as well, up by at least 5% this morning. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Amy Morris. This Bloomberg Business Flash is brought to you by Chapter. The average couple spends more than $300,000 on health care in retirement. Want to know how much of that you could keep? Find out today in under 20 minutes with one free call to Chapter. Go to askchapter.org to get started. We check markets for you all day long here at Bloomberg. The S&P 500 down 0.1%, NASDAQ unchanged, and the Dow is down 0.7%. The 10-year Treasury yield at 4.39%, the 2-year yield at 3.89%. WTI now topping $105 a barrel. Brent crude topping $117 a barrel. Bill Ackman's Pershing Square going public after raising $5 billion, which is at the low end of its fundraising target. Pershing Square USA shares are indicated to open below the $50 per share IPO price, the company facing questions about what will drive demand in the secondary market. The entire stock market may be riding on 4 big names today when Alphabet, Amazon, Meta, and Microsoft report earnings this afternoon. Bloomberg Tech host Ed Ludlow.
We're bracing for Armageddon, and more than ever, Wall Street is looking for evidence of ROI. They want to see that capital expenditures is followed by boosted forward guidance and tangible revenue growth.
Bloomberg Tech host Ed Ludlow. Look for those earnings potentially within 80 seconds of each other after the closing bell. And we're hours away from what may be the final Federal Reserve rate decision of the Jay Powell era. It comes your way at 2 p.m. Wall Street time. Our coverage begins at 1:30 on Bloomberg Radio, television, and the Bloomberg Business app. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
All right, Amy Morris, thank you so much. We appreciate that, as always. Again, it is Fed Day, as Amy was mentioning, and Tom Keene and the surveillance team, John Farrow and Lisa Bronwich, they're going to bring it all to you starting at 1:30 p.m. Wall Street time. 2 o'clock, we get the statement. 2:30, the press conference. Bloomberg's own Michael McKee is in D.C., and he will be at that press conference. So we got you covered there. Let's break it down with Dennis Lockhart, former Atlanta Fed president. Joining us from Atlanta, Georgia. I'm going to guess some Peachtree Street or Avenue or Boulevard or something like they do down there in Atlanta.
Way or court.
Exactly. I don't know.
All of the above.
All the above, exactly. Dennis, it's going to be a very interesting Fed meeting today. It'll be the last meeting for Fed Chairman Jay Powell. I guess for a lot of people, the biggest question or one of the key questions is, what is the chairman going to do once he steps down from his chairmanship? How do you think he'll stay?
Well, we haven't had a decision yet, and I doubt you're going to hear a decision today in the press conference. I think that Chair Powell probably is still deliberating and waiting for some more information. The Supreme Court finding on the Lisa Cook case will be an important piece of it. He may very well not be satisfied with the finality of the decision to drop the investigation by the Department of Justice and be trying to get more certainty around that. So there are reasons why he may very well hold off on that question for a bit longer.
I'm interested in your saying that the Lisa Cook decision by the Supreme Court might be something that he's waiting for. Just walk us through what that means in terms of the makeup of the Fed's board if the Supreme Court does come out with a ruling. And remember, it has until potentially end of June before it has to come out with an opinion.
Well, it's a fairly complex picture, but in straightforward terms, if Lisa Cook could be fired, it opens up another position. It means that the White House and President Trump can add one more ally to the Board of Governors. That may, in the view of some people, imperil Fed independence. It's a very, very important case because it puts every governor potentially as a target if that governor does not vote the way the White House wants. And you can find some reason to fire that governor. And so they're all in peril. And it just is a chilling effect on the independence of decision-making in the committee.
So, Dennis, I guess just from the economics perspective here, inflation, full employment, the war in Iran is arguably impacting the inflation part of that equation here. How do you think the the Fed is kind of viewing the geopolitics of the day?
I think they're in a wait and see mode. They want to see if the war lasts much longer, and if so, what effect do higher energy costs have on prices, and are some of those effects more persistent than transitory? There's a lot to learn in the coming months about what the war is going to do to the price level and also the rate of inflation. I think because gasoline is so important to consumers, the committee members some at least, are concerned that the public's inflation expectations could very well be affected by the higher gasoline prices. And inflation expectations is something that economists and the Fed committee members really pay a lot of attention to, because it can dislodge the anchoring of expectations of the public, and that can lead to sort of a self-fulfilling inflation cycle.
Yeah. I think about, and this is something that the Wall Street Journal wrote about as well, the U.S. economy and what it's had to absorb in the last 5 years. You could argue there have been 4 supply shocks: the pandemic and the reopening from the pandemic, Russia's invasion of Ukraine, tariffs in April of last year, and the war in Iran. You could say that these are one-offs at different points, but what is the cumulative effect of one-off supply shock after one-off supply shock over a condensed period?
Well, I think you're suggesting, Scarlett, and I would agree with it, that the overall picture is the U.S. economy has been very resilient to a number of supply shocks. The importance of the term supply shock is it's not something that monetary policy can affect directly. And therefore, the Fed, in setting interest rate policy, really has to often look through a supply shock. And that's one more reason why I think in this particular case, the committee is likely to be on hold for several months.
Dennis, how is Kevin Warsh, how do you think that transition is going to go? How do you think he will put his imprint on this Federal Reserve? Because his candidacy is making its way through Congress today pretty quickly.
Yeah, I believe it's gone from the committee now to a Senate vote. So he will be confirmed shortly, and I think he's extremely confirmable. He's a very able guy, and has really very good experience. So we've really got a good person, I think, to become the next chair. I don't envy him the tightrope walk that he's going to have to execute particularly in the first year in office, because certainly he's going to be under some pressure from the political side, the White House. And at the same time, he's got to establish himself with the committee. The committee's respect is not just automatic, whoever's in the job. And he's going to have to, I think, to assert a degree of independence to convince his colleagues that the decision-making independence that the Fed has enjoyed is going to be preserved under his watch. And if, so he's going to be pulled in 2 different directions. And he's now making a transition, in my view, from someone who was effectively campaigning for the job and got it, to someone who has to be a consensus builder and guide a process in which there are 12 people who vote on policy.
All right, Dennis, really appreciate your joining us. Dennis Lockhart, the former Atlanta Fed president, joining us from Atlanta, Georgia. Dennis Lockhart was the Atlanta Fed president from 2007 to 2017. Ahead of that Fed meeting, we have the equities marginally lower.
Yep.
I mean, the NASDAQ is unchanged right now. The S&P 500 is lower by 0.1%. There's a lot of wait and see going on right now.
I think there is. I think you're right. I think it's a wait and see on the Fed, certainly, and on the earnings after the close for some of these big technology companies. Mandeep Singh from Bloomberg Intelligence said, you got to, beat and raise and do it decisively.
Yeah.
Not just a little bit. So, the bar is always high for these companies. So we'll see how they perform.
But with the S&P near record highs, it's a lot higher now than it was before. This is Bloomberg Intelligence on Bloomberg Radio.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube. We're streaming live on Bloomberg.com as well. IPO priced to last night to this morning. That's Pershing Square. It's Bill Ackman's combined initial public offering for his closed-end fund and alternative asset manager, Pershing Square USA. The ticker's PSUS. Initial price of $50. It hasn't started trading yet today. I'm looking at the bid ask in the pre-market, $37.50 to $42.50. Anthony Hughes, equity capital markets reporter for Bloomberg News, joins us here in our Bloomberg Interactive Broker Studio. So first, let's go to this discount that the pre-market trading is showing. Explain to us why this is not unusual, and it does not mean that this is a disappointing deal. It has to do with the structure of a closed-end fund.
Well, it has to do with the structure of the overall transaction, which is quite unusual. I mean, closed-end funds have really lost popularity over the years, and I think mainly because they don't really deliver returns initially, and they do tend to trade at a discount to net assets because it's really just a pool of cash, and hopefully the manager in this case will go off and invest that money and they'll do well over time. But at this stage it's really just a pool of money, and the manager here will be charging a fee on that, so there's not really a lot of reason for it to trade at a premium to the NAV, which is effectively $50 a share in this case. But this is unusual, specifically this deal, because we've actually got two companies listing today. There's Pershing Square USA Limited, which is the closed-end fund, which you've just been talking about. Okay. And then as he structured this deal, he also offered a bonus share in his own management company, and that's also listing today. So this is a little bit confusing for some people, I think, but really this is the thinking from Ackman was that due to the inability to provide an IPO pop from the closed-end fund, he thought he provides some sort of compensation for that by offering this bonus share in his own management company. Now, that's also going to list today soon, and at the moment I think the indications are for about, like, say, maybe $25, $30 a share. I mean, it remains to be seen here, but if you do your math, you can see that if the closed-end fund trades down, say, 10%, and if you bought 5 shares for $50 each, you spent $250, you're losing. If you lose 10%, you lose $25, but you get your free share in the management company, which might be worth $25. So net, you could be flat.
Gotcha. Interesting. Yeah. So I mean, it's a very interesting, unusual structure. But and people are buying into Bill Ackman and his track record over decades, right? Has he indicated how he may invest some of these funds?
Yes, it's pretty clear how he'll invest. I don't think he's been as clear about it as he could be, but essentially what will happen here is he will pretty much replicate the portfolio he already has, which is a concentrated portfolio, about a dozen stocks. In a lot of the money he already manages is in this European vehicle, which is very similar, although it has a different fee structure. But really, this includes big holdings in, these are some of the holdings which he's well known for, which, his number one investment is in Brookfield, and then he's also got a big investment in Uber, and he's talked about Fannie and Freddie, but also he's got some Mag 7 stocks there, I think Meta, Alphabet, and Amazon.
Okay. The fee structure, what is the fee structure here in the US? Because he's not doing this for free.
Yeah, so the big selling point here from his perspective, in terms of getting people to subscribe to this IPO, was that, he's saying this is the cheapest or the lowest cost hedge fund in the world. And, that's an interesting line. But essentially what he means in saying that is that he's charging a flat 2% asset management fee, and there's no performance fee. So usually with a hedge fund, it'd be or a private equity fund, say for instance, it'd be a 2 and 20, famously a 2 and 20 structure where 20% of the upside or the carry, whatever, would go to the asset management. That's not the case here. So he's really just charging this flat 2% fee. So that's one of the key reasons he thinks that this is attractive to investors.
And it's just it's another revenue stream for him. 2% of $50 billion.
Yes.
That's his revenue stream right there.
Yeah, that's $100 million that goes straight to the management company. And obviously, as I noted, the management company is also listing today. And, how much money he raised through the closed-end fund also affects what the value of the asset management company is, because it's going to be another, he's got really 20 billion of assets under management now. This adds another 5. So it's a pretty significant lift to his assets under management and the value of his management company, permanent capital too, which, theoretically gets a premium as opposed to open-ended funds where people can redeem their money. So, that's the package that he's put to people. And I think, but ultimately it looks like from the early indications, it's going to be a pretty sort of flat outcome, basically.
Right, for investors here. So presumably, do we know who's buying this these initial offerings here at institutional retail, it seemed like an opportunity for retail investors to invest with Bill Ackman.
Yeah, so really a closed-end fund would be, let's face it, more for a retail audience, because institutional investors would, they'd invest their own money. They wouldn't necessarily want this third, this other layer of management to invest in, say, the Mag 7 or whatever. Right. But, obviously, Ackman in this situation, he put together a deal for the institutions. He wanted the institutions to come along. He had a capital commitment for $2.8 billion. So of the five, $2.8 billion was upfront committed by institutions.
Oh, okay.
And he said this morning on TV that there were family offices and pension funds and other those sorts of big investors, and they were involved. And so really about 80% of the $5 billion has come from institutions. Okay. But those people who put in the $2.8 billion up front, they got a little bit of a better deal on the bonus share. They got 1.5 shares in the management company for every 5 shares in the closed-end fund, whereas the new investors who came in, including the retail investors, they got 1 share for every
right, so a little incentive to be
one
early.
bonus share.
Very interesting structure. We'll see how this thing trades going forward. Anthony Hughes, thanks so much for helping us out here. Anthony Hughes is equity capital markets reporter for Bloomberg News. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metal. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. We have a red headline coming across the Bloomberg terminal here. Trump says he rejects Iran offer to reopen Hormuz. That's according to Axios. And WTI crude oil trading higher on that news. It's now, WTI is up $6.94, just under $107. This is Bloomberg.
From ABC News, I'm Michelle Franzen. The Supreme Court ruling against a key section of the Voting Rights Act. Here's ABC's Stephen Portnoy.
The case was about the drawing of majority black congressional districts in Louisiana. The court's 6-3 holding strikes down that map as an unconstitutional racial gerrymander. Section 2 of the Voting Rights Act survives, but it's now been significantly weakened by the court. The law seeks to ensure that minorities are entitled to equal participation in voting. But Justice Samuel Alito's opinion, co-signed by his 5 conservative colleagues, is likely to limit enforcement of Section 2 and help Republicans in their efforts to redraw districts that now include large minority populations.
Top Trump administration officials testifying on the White House $1.5 trillion defense budget. Secretary Pete Hegseth facing lawmakers for the first time since the war with Iran began and pushing back on bipartisan criticism over the war and U.S. goals.
The biggest challenge, the biggest adversary we face at this point are the reckless, feckless, and defeatist words of congressional Democrats and some Republicans. 2 months in, I remind you, 2 months in.
Talks with Iran remain stalled over the blockade in the Strait of Hormuz, driving up oil and gas prices. Former FBI Director James Comey expected to self-surrender 1 day after a federal grand jury indicted Comey for his Instagram post last year of shells in the formation of 8647. Prosecutors allege it was a threat against President Trump. ABC's Jonathan Karl says it's the latest effort by the Trump administration to prosecute Comey.
I've been talking to current and former federal prosecutors who are calling this the flimsiest federal indictment that they have ever seen. Even Trump's allies are privately calling it embarrassing, or as one very prominent former Trump DOJ official told me last night, depressing.
King Charles and Queen Camilla in New York City today, on day 3 of their U.S. visit, paying respects to the September 11th memorial. You're listening to ABC News. Tech titan Elon Musk expected to be back on the stand today in his case against OpenAI CEO Sam Altman. Musk is suing Altman, saying he was tricked into investing in OpenAI as a nonprofit. Here's ABC's Mike Dubusky.
Last year, OpenAI transitioned from a nonprofit business to a traditional for-profit business. They make revenue from subscription services and selling APIs and catering to investors and what have you. Musk says that is basically a betrayal of his trust, and that's why he's taking Altman to court in California this week.
Musk co-founded OpenAI with Altman in 2015, but left in 2018. Altman is also expected to testify. In Texas, while Republicans John Cornyn and Ken Paxton have been fighting it out in the primary over a Senate seat, the Democratic nominee has been making waves.
In the Texas Public Opinion Research Survey, likely general election voters in the Lone Star State say they would back Democrat James Tallarico over incumbent Senator John Cornyn, 44% to 41%, just outside the poll's margin of error. In a hypothetical matchup with Ken Paxton, Tallarico holds an even wider lead. But November is still a long way off, and no Democrat has won a statewide election in Texas in over 30 years. Jim Ryan, ABC News, Dallas.
A new study revealing many Americans are not getting enough sleep. According to the CDC, 30% of adults are sleeping less than the recommended 7 hours a night. Michelle Franzen, ABC News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The market waits for Bill Ackman, and we've got him right here on Bloomberg. Welcome to the Wednesday edition as Ackman's Pershing Square goes public today on Wall Street in a combined IPO that priced at the lower end of expectations. Before we turn to politics, the Supreme Court ruling today on voting rights, the wrangling on Capitol Hill, we bring you an important conversation with Ackman himself, and it's going to begin any moment now. CC, let us know, because we want to see the very beginning of this when it takes place as we wait for voting, or I should say voting. It's the political guy here, actual trading to begin in Pershing Square. We actually get to hear from the man behind the operation. With our eyes on Wall Street today, broadly, we'll take a look at the markets with the Dow Industrial Average down 334 points. 34-point loss for the NASDAQ, and the S&P 500 is down 12. Let's go to Danny Berger, now live in New York.
At least 2 years. It's had fits and starts, much like this American IPO market itself. What was it like to get this over the line?
It's great. It's a great day, but it's really, it's the beginning, right? The beginning of a journey.
So it's the beginning of a journey, and now armed with $5 billion. How quickly can you put that to work?
Actually, we think it's a very good time to put the capital to work, and we invest in the most liquid companies in the world. So it's weeks, not months.
So it's weeks, but there's this question. So some of the companies that you own in your other portfolio, for example, Uber, Meta, they've had a good run, and you're already very long them. So the question might arise, is now the right time to be doubling down?
Actually, I think the companies you mentioned are very cheap stocks today. Interestingly, some of the best businesses in the world are trading at the lowest multiples they've traded at, in some cases, in history. Actually, those multiples bottomed maybe 2 weeks ago, so we're a little bit off the all-time bottom, but very bullish on the economy, and there are some amazing businesses available at really cheap prices. This will be kind of a continuation of what we're doing now, so we're going to just add to existing positions, which will give us more ownership. And our strategy, we like to be a big shareholder.
As you said, very liquid stocks. So the
Yes.
market is there. What about for like a Fannie or Freddie, where they trade OTC? How does that work? How do you dive back in without moving the market?
We're going to be very thoughtful about the way we deploy the capital. We're not going to tell anyone on TV what we're going to do.
I see. You don't want to front run anyone.
Yes.
Perhaps a wise decision. And look, you've discussed, you were talking about it earlier this morning on CNBC, that closed-end funds, they trade at a discount to NAV. That's not a surprise. So what does success look like in this scenario? Is for example, like a 10% discount okay?
So I want to give you a new construct to think about.
Please.
Okay, so there's hundreds of closed-end funds, but they're a very different animal for what we're doing here. We're adopting the closed-end structure, the legal structure, the corporate structure, because it's the most flexible and most tax-efficient corporate structure in America. It's never been used for the purpose that we're going to use it for. But if you think about our business as a business, think of us as an investment holding company. It's a business that's earned a 19% return on equity for the last 22 years. If you look in Bloomberg, someone should do a search real time. Find me a business that's earned 19% on equity for the last 22 years. It trades for less than 2 times book value. And we're taking the company public at book value. So we think that's going to be a cheap price. Now, the nature of IPOs are such that in the first couple of days, I can't tell you exactly what's going to happen. But over time, we're going to compound this book value, or NAV, as some people call it, if we do anything like what we've done in the past, a high rate over time, and it's going to compound and it's going to grow. And we're going to run it like a real company. Closed-end funds are kind of a backwater. No one actually wakes up and gets excited about investing in a traditional closed-end IPO. They're kind of generic. You don't know who runs them. I bet Bloomberg's never even run a story. And they don't hold conference calls with their shareholders. They don't have particularly distinguished boards of directors. If this were a C Corp, no one would be asking me whether it should trade at a discount or not.
Sure.
But you can't deploy our strategy in a C Corp, which is why we've chosen this structure, and it's more tax efficient than a C Corp. It's a flow-through entity for tax purposes. So more tax efficient, and then we fix the things that are problematic about closed-end funds. So it's the lowest cost compensation for a management firm like us to manage this pool of assets. In fact, we charge our other funds incentive fees. We don't do so here. We're not permitted to do so here. So it's the lowest cost version of Pershing Square. You take our record over the last 8 years since we've had permanent capital, it's been a 24.9% return. That's a very high rate of return relative even to the stock market, which did, about 10% per annum, not as well. So it's a liquid way to invest in Pershing Square at very low cost, and we're going to build the value of this entity over decades.
Well, and I know you've said before.
Now, by the way, that's just one of the companies we took public today.
That's true. And you have Pershing Square, the holding company, the holdco, and you also have ambitions to maybe list more funds. How quickly can you ramp up AUM? I know you said just by the nature of what you're doing, by compounding, that you could get to $1 trillion in 20 years. Do you have your own internal targets you're thinking of?
So the first priority is to compound at a high rate for a long period of time. That's a much easier thing than doing an IPO. Right? IPOs can take management time and attention. So we're going to focus on investing. We're going to focus on getting our Universal Music deal done. We're going to focus on helping the administration figure out Fannie and Freddie. We're going to help our company succeed. And the beauty of that is it grows our AUM. And the beauty of this, of Pershing Square, the management company, or some people call it the GP, is it grows with compounding. Other asset management firms generally only grow with raising money. If you look at a KKR or the other sort of alternative asset management firms, if they stop raising money, they shrink because they're constantly sending money back to their investors. As they sell assets, they send money back. In our model, we build off a base, and if we're up 20%, the assets will grow about 20%. And so that's a very fast rate of growth without the need to raise any additional capital.
Can you rival the size of those? I mean, I know it's a very different model, but do you see yourself growing to a size of a Blackstone, of an Apollo? Over
time, for sure. And that was the point I was making. We'll have 25, today, post the closing of this IPO, we'll have 25 to 26 billion of fee-paying assets.
Does the way you invest need to change then? Because these are huge platforms that have many different types of assets they invest in.
The beauty of our strategy, we invest in the largest companies in the world, kind of large cap, mega cap companies, mostly based here. We're tiny in the context of the capital markets. We manage the money in a concentrated fashion, but with 25 billion of capital, a couple $1 billion per investment. That's small in the context of the market we invest in.
By the way, and you know, this is quite unique. As you point out, there's not really another structure that's listed like this. How are you thinking about it, though, in terms of having a listed structure, both Pershing Square and PSUS, that it is centered around you and your very small team, which I know is you see that as a benefit too. Does it change how you communicate? Does it change what you put on social media?
Yes.
Because it could impact share prices?
It does.
Well, I guess legally is one question, but beyond that.
Well, actually, believe it or not, I've been very constrained on social media. Maybe you find that a surprise. But with respect to talking about Pershing Square, there are a lot of limitations up until this moment in time. Now we have an SEC-registered entity. Our existing offshore closed-end fund, we're not allowed to talk about it in America.
Right.
And this is where I spend the vast majority of my time, so it's something we can't talk about. The beauty of this entity is we're going to be able to, we make an investment. We can say today we bought a 10% stake in company ABC. Here's why we own it, ticker symbol PSUS, and investors. We can keep very close touch with our shareholders. And one thing that Elon Musk has done very well over a long period of time is he built a base of followers that were very supportive of Tesla over time, have reduced the cost of Tesla stock. And that's been a competitive advantage that Tesla's had over time. We have already a very large base of followers in the capital markets. They haven't had a way to invest with us until now.
It does sometimes make for more volatility, though, when a post can potentially move around share prices. Sure. How do you think about that?
I mean, we're only going to post stuff that's true. I think that's
a good rule to stand by.
Yes.
At the same time, you've been pretty early in some major dislocations in this market, be it COVID, be the inflation that followed, and some really successful hedging strategies behind that. Do you see any dislocations like that at the moment and hedging strategies you'd want to deploy?
No, actually. I think we're heading into a very good place. Obviously, we have a war still underway, but I think we have by far the upper hand. I think Iran has been denuded of military capability, and I think it's only a matter of time. Administration, I think, this move of closing the strait, I think was a kind of a kung fu grip type move on the part of the president, and I think it's putting a huge pressure on Iran. So I think we're going to get this resolved in the relative short term. I think that's really the biggest overhang on the market, right? We close the strait, obviously has an impact, some, whatever, 4 percentage points or something of oil on a daily basis can move a market, and that has an impact, causes inflation in the short term. But I think it's a short-term phenomenon. And I think once we're through it, I do see, a Federal Reserve that should be able to reduce interest rates. We have massive, AI spending. We have massive energy spending. We have a tax bill that's driving investment. Every day there's however many deals that are being announced. You have an administration that's very supportive of transactions as opposed to an FTC which would stop everything. So I think you're going to see lots of reasons to be bullish on markets generally.
You were pretty early in this call posting on X that any dips would be short-lived, and they were...
I didn't say any dips. I basically called a recent bottom, let's put it that way. I thought stocks were getting stupidly cheap. So I just sort of called it out.
They didn't even sell off 10%. I feel like some people feel uncomfortable with that. I think oil today is trading somewhere around 116, and stocks feel unbothered.
You see, you can't think about stocks. You're thinking about stocks from an index perspective.
Okay.
The index is like looking at the surface of the ocean. The index is like looking at inside the ocean, but the surface is moving around a lot. And what I mean by that is there are, a lot of stocks. There's enormous disparity there's enormous volatility. We have a lot of earnings coming out in the next 24, 48 hours. And you can see massive moves in different directions. There's so much capital leveraged, short-term focused, tightly risk managed, which means stop losses and things like this. And the result of that is that our capital markets, you can see massive moves in share prices. If you have the ability to be long-term, every once in a while, the price of a really high-quality company gets stupidly cheap because someone is forced to sell because of a bad print for the quarter or a guidance change. Really something that doesn't necessarily have any material impact on the long-term business. And those are the kind of dislocations we take advantage of.
But the dislocations, it sounds like, are over. The stupidly cheap moment has come and passed. Is that fair?
I would say we're above stupidly cheap bottom, but I still think there are a lot of very high quality, like the way we sort of model each of our companies, we build a model. And our kind of go forward next 3-year IRR was something north of 30% at the bottom. You don't see that with really high quality companies. It's probably now in the mid-20s. It's still a very high rate of projected return for some of the best businesses in the world. And that's suggestive to me the market's cheap, or at least cheap. This is a case where the highest quality companies are cheap. I'm not saying that energy companies are cheap today.
Sure. So you have to avoid value traps essentially in this market as it stands.
I think that's a
true
of
any market. Fair enough.
Sure.
In this sort of quest to build a Berkshire Hathaway type model. So you've listed these two.
Let me clarify.
Sure.
Because I think there's a little confusion. So we're building an asset management firm that has some of the similar attributes to a Blackstone and KKR, but it's extremely investment centric. We're going to grow this business principally by compounding as opposed to raising lots of funds. So that's one. Buffett was not in the asset management business. Buffett was building a corporation over time. We have a company called Howard Hughes Holdings. We bought an incremental stake in about a year ago. I became executive chair. Our CIO, Ryan, became CIO. The full Pershing Square team became available to the company. And that's the company we talked about building a modern day Berkshire Hathaway. And the first step we took was we signed an agreement to buy a company called Vantage Holdings. That deal's going to close in the next, call it 60 days, something like this. And we're going to manage the assets of that insurer. And we're going to work with management to make sure they underwrite very high quality, profitable insurance business. If you look at Berkshire over the last 60 years, it's built most of its value becoming effectively an insurance holding company. That's what Buffett has built over time. And it was his successful management of the assets So when you heard Buffett buying Apple, it wasn't Buffett buying Apple. It wasn't even Berkshire buying Apple. It was the Berkshire insurance subsidiaries buying Apple. And we're going to do the same thing. We're going to manage this. So the goal of Howard Hughes is to build a long-term, diversified holding company akin to what Buffett has done over a long period of time.
And sort of defining what your various holdings and your investments look like and what they're not. I know one distinction you've made very clear, because there have been these nerves around retail funds, but it's been really centered around BDCs and private credit. And you've really drawn a distinct line that these are not, there's no exposure there.
Correct.
I wonder if part of that, though, is skepticism of the asset class itself. Is there any skepticism of that asset class?
Of private credit generally?
Yes.
Look, anytime you have an asset class grow very, very quickly with a lot of participants competing, return, you either have to accept lower returns or more risk. That's the only way you can kind of grow in that environment. And there's, like everything else, there's a continuum of quality in terms of sponsorship. I don't think there's inherently something wrong with private credit. I think the one thing I would say is investing in illiquid assets, you really should have very long-term capital or permanent capital.
And here you are on your quest to obtaining more permanent capital.
There's so much capital is managed where the underlying asset is long-term. A company, a stock, is a long-term asset.
Right.
The vast majority, what's caused the stock market to behave the way it does is the vast majority of asset management firms have very short-term money. They have money that can leave in a minute, an ETF. They have money that can leave overnight in a mutual fund, or even a hedge fund. Bulk of our assets were hedge funds. About half the money could leave every year. It's hard to be a long-term investor if your money can leave overnight.
So one of the arguments for that, though, of being able to redeem is just you're accountable to shareholders. How do you keep that? How do you keep accountability to shareholders when they're not able to redeem assets out of the fund?
Shareholders have more liquidity than they do in any fund because they have a stock that trades and they can buy and sell over time.
What needs to go right on the flywheel? Because if you do have any sort of discount to NAV, does that make it more difficult to list other vehicles like this?
We're going to focus on doing a great job for the PSUS shareholders. And if we do a great job, we communicate to them well, we deliver the kind of performance we have over time, we deserve to trade at a premium as opposed to a discount, right? Again, the average closed-end fund, the best performing closed-end fund over the last 8 years generated a 14.5% return. At its time, we generated a 24.9% return. That's a huge disparity. And by the way, that fund trades at a 15% discount. 15% premium.
Do you think you could trade at a premium?
Here's my argument, right? Businesses that earn the kind of return that we've generated over time trade at 2 to 3 times book value. Should we trade it at a discount to book value? It makes no sense. And we have a tax advantage, right? We have a favorable corporate structure, much more flexible, much more tax efficient, liquid, listed on New York Stock Exchange. I mean, put aside, I don't know what happens in the first couple of days after an offering, but with good shareholder communication, keep people informed, good performance, this can become a core holding. And by the way, the bulk of this entity is sold to very long-term holders.
Right.
And so now, with so much of the stock held by long-term holders, it's the marginal buyer and seller that will move the price around.
By the way, are you as excited as everyone else is about getting to hear from you quarterly now when you give quarterly updates? Or do you wish it was semi-annually?
No, I'm very happy to I enjoy communicating, and I certainly enjoy communicating with people who've entrusted their future to us.
Yeah.
We actually operate, you're not as aware of this, but today we do quarterly conference calls for our existing vehicle.
Sure.
We're now going to be able to do them onshore.
Yes.
We're going to be able to answer questions from shareholders the way that you would want those questions to be answered.
We're very much so looking forward to that. Bill, thank you so much for your time this morning. We appreciate it. Bill Ackman, CEO and founder of Pershing Square.
All right, Danny Berger, thank you so much. Fascinating to have that much time with Bill Ackman on this day as we wait for trading to begin under both of those tickers. That could happen at any moment. And of course, we'll have full coverage for you when it does. Made a lot of news here. Set to raise $5 billion, of course, in this public offering today. Talking about it as the beginning of a journey. Really interesting. Said it would take weeks, not months, to invest the proceeds from this offering. And they talked as well about the markets as a whole. Ackman saying that we are above a stupidly cheap market bottom. but still sees a lot of opportunity in the markets here with his goal to build a long-term diversified holding company. Stay tuned for the opening trades of Pershing, which again is a combined IPO. So we're going to be looking at the closed-end fund as well as the management firm, and all that could happen at any time now. Live from New York, Bill Ackman with Danny Berger. Let's check the markets and see what kind of a market Pershing is diving into today. Not too inspired at the moment. Amy Morris has the look for us from here in Washington. Amy, how's it going?
Hey there, Joe, sorry. I was actually looking at Pershing Square, watching to see if it was going to start trading yet. And you're absolutely right. Bill Ackman's Pershing Square is going public after raising $5 billion. We are expecting those trades to begin any time now. But that $5 billion was at the low end of its fundraising target. Pershing Square USA shares are indicated to open below the $50 per share IPO price. And the company is facing some questions about what's going to be driving demand in the secondary market. And the markets are actually kind of holding steady, a little bit lower now. S&P 500 down 0.2%, NASDAQ down 0.3%, the Dow down 0.6%, the 10-year Treasury yield at 4.39%, and the 2-year yield at 3.9%. WTI is now 6.8% higher. It is closing in on $107 per barrel. Brent crude has already topped $118 per barrel. That's about 6.6% higher. The entire stock market also riding on 4 big names today when Alphabet, Amazon, Meta Platforms, and Microsoft report earnings this afternoon. We're also waiting for the Fed's April rate decision, plus any possible insight into the future of Fed Chair Jay Powell. Our coverage of the Fed decision starts at 1:30 this afternoon, Wall Street time. That's about an hour from now here on Bloomberg Radio and television and the Bloomberg Business app. You can get on-demand news 24 hours a day by subscribing to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's a Bloomberg Business Flash. Let's get back to Balance of Power with Joe Matthew.
All right, Amy, thanks a lot. I'm Joe Matthew in Washington. Thank you for being with us here on the Wednesday edition of Balance of Power. We served up a special conversation with Bill Ackman to get us rolling, and we turn now to breaking news. It's been a doozy of a day already here in Washington. We were just getting into our editorial show meetings when it hit at 10 o'clock, a ruling that we have been waiting for from the Supreme Court for months, curbing the use of race in drawing up voting districts. This is right down the middle on our program. And against the backdrop of the redistricting effort that's been happening on both sides, right? We had an advantage for Democrats when we came through Virginia, and now we're looking at Florida with a potential vote today that would up the ante for Republicans. Hold on, everybody. That may not matter, as the Supreme Court limits the use of the Voting Rights Act to create predominantly black or Hispanic election districts, rejecting the Louisiana congressional map with a second majority black district, calling it an unconstitutional racial gerrymander. And this sets up a whole new test for creating, or I can only assume maintaining, if we're in this age of redrawing maps, heavily minority districts. Jumping on the breaking news, June Grasso, as we would hope, the host of Bloomberg Law, with us now from New York. June, this came along partisan lines. What happens next if not another redrawing of congressional maps?
Well, yeah, it was 6-3 with the Republican conservatives in the majority and the Democratic liberals in the minority. What happens won't happen probably until 2028. We don't know really how much is going to affect the midterms because we're so far along and so many states already have, ballots drawn up, and it might be hard in some of those states to just rejigger everything. But come 2028, it means, according to some estimates, that about, I think it was, 19 Democratic congressional districts with primarily black or Hispanic populations are at risk. As much as 30% of the Congressional Black Caucus, according to one survey, will be at risk. And we forget, the legislative seats, about 200 legislative seats held by Democrats in the South. So it's going to change things dramatically. It is basically just demolishing the Voting Rights Act, which little by little the Supreme Court has been taking apart. I mean, the Shelby County case, you remember, they said that, you couldn't have pre-clearance anymore because you didn't really need pre-clearance of certain states, that they would have to pre-clear with an entity before they redistricted. You didn't need that anymore. I mean, put this in the context that the Chief Justice has said that the way to get rid of discrimination by race is to stop discriminating on the basis of race. So you can look at this decision through that lens, where they're pulling back in every way they can on any kind of race-conscious decision-making.
Okay. So what happens with this second district in Louisiana to start? This is the district represented by Democrat Cleo Fields. The Chief Justice, John Roberts, described the district as a snake. He was talking about the way it actually looks on the map, to be clear, although I found that to be an interesting choice of words here. That map is an unconstitutional gerrymander, Justice Alito wrote, for the 6 conservatives. Does it go away, or do all of these now have to get another look?
I assume that it goes away, but they'll probably have to do it in context. And talking about a snake, I mean, have you looked at the maps across the country in both Democratic and Republican-led states? I mean, the way they draw these maps is crazy. And so having a snake doesn't make much difference when you have like tortoises and other ones and rabbits and different people look at these maps and go, well, what does that look like? Because it doesn't look like anything like you'd think, like a circle around here or a square. Here's where it's been done for ages this way. And the Supreme Court got rid of the ability to challenge maps based on partisanship. So partisan gerrymanders are fine. And now they've gotten rid of basically the way to challenge it based on race. So racial gerrymanders are fine. And, you know, in the dissent by Justice Kagan, which was really, you know, emotional. She talked about the Voting Rights Act being raised on the blood of civil rights marchers. And she said that this is a 3-part plan, and basically it's the end of the Voting Rights Act, and that it will allow states to dilute the votes of minorities. And Justice Alito, who wrote the majority opinion, sort of downplayed it. No, this isn't really a big deal. We're not overruling the Voting Rights Act. But if you look at what he's done, it basically is overruling the important parts of the Voting Rights Act. So it's a monumental decision, and it makes the court look more political. And I just want to say that the 6 conservatives justices were at the dinner last night held at the White House, but the liberals were nowhere to be seen.
Yeah, I noticed that. You know what else I noticed is that all the whole lineup from Fox News was there, and I'm pretty sure
you weren't
they were
invited,
not from other networks. I don't know what's going on. I felt like I could have enjoyed the Dover Soul. June, thank you. You got a day in store. You're great, and we'll be listening to an important edition of Bloomberg Law. She's right. Justice Kagan saying the decision renders Section 2 of the law, quote, all but a dead letter, unquote. We're going to be unpacking this throughout the day. And look, we've got a Fed special that starts an hour from now. This will be something that comes back around on the late edition of Balance of Power as we keep our eyes now on Capitol Hill. Republicans cannot agree on anything. We've established that. And it's going to become a problem pretty soon here when it involves Section 702 of FISA and whether the speaker thinks he can throw this on the floor. They can't get it through the Rules Committee. They also can't seem to figure out a way to fund DHS. Don't even ask about the farm bill because we don't have enough time with Mike Dorning. Let's bring him in right now. He helps to run our Capital Influence team here in Washington. It's been too long. Good to see you,
Great to see you.
Mike.
As
this
always.
is being described as a conference in dysfunction. Can they get any of these things done?
Well, they've been like punting the ball constantly, and I would expect they'll punt the ball again if they can't get something done.
Get
It's
another
really
10 days or something?
Yeah,
On FISA.
On FISA. Yeah. It's really tough. They barely have enough Republicans, and they're divided and fractured. And as the election comes closer, they have to worry about facing the voters. And so these divisions over, you know, how much the federal government should be snooping on people without warrants and things like that come up. And it's harder to rally them all.
Is part of the problem that the speaker doesn't want to deal with Democrats on this because there'd be a couple Democratic votes to extend FISA, maybe even 10 to overcome the Freedom Caucus, right?
Yeah, the problem is the more he
that's how you get fired around.
He antagonizes the people who keep him employed. The bigger the trouble he has with the next vote. So he's in a tough spot. He's wrangling these people, and unlike Nancy Pelosi, he doesn't have like 10, 12 years of stuff that he may have done for
Favors to
them.
Sean.
And, you know, with her, like another 10 years earlier, raising money for people.
Yeah.
He was just thrust into this, and he's got to make the best of it.
I've lost track of how long DHS has been closed. I had it here somewhere, like 70-something days now,
February
right?
14th.
Yeah.
Happy Valentine's Day.
Happy Valentine's Day. So the White House kicked out a memo basically ordering House Republicans to get this done here because without this pass, 74 days, by the way, they will not be able to pay DHS employees starting next month. April, what are we at? The 29th of April.
Yeah.
Is that a motivator?
It could be once the TSA people stop getting paid again, but some of the Republicans want to do more on this legislation than merely fund DHS and immigration enforcement. So there's kind of a back and forth on that.
Interesting. Okay. Farm bill, can't get arrested? I mean, if we can't get this done, how do you get the Farm Bill done? Or is that another CR or another kicking of the can?
Well, even getting it through the House they're still got to get it through the Senate, and they can't even get an agreement in the committee on it. So if they kick it down the road in the House, it doesn't really matter because there's no agreement in the Senate on how to proceed.
So there's a question about, does Johnson keep the House in over the weekend? Do you cancel recess in May? Or do we just keep going home with things not resolved?
Well, he's got a judgment to make. Yeah. You know, as it is, he has a hard time corralling his members. Does he really want to make them more angry at him by keeping them in? There may be a point where he wants to keep them in to try to get stuff done. But if you just make people more angry at you, it could be counterproductive.
Wow. I have to ask you in our 30 seconds remaining just quickly about Kevin Warsh.
Something works.
Yeah, confirmed in committee today. When do we see a floor vote? Do we know?
Likely well before the May 15th deadline. The Senate and the House are both on vacation next week, so they may not get to it this week, but when they come back, they'll probably get to it.
Next couple of weeks. Interesting to see they finally got that done as Tom Tillis steps down. Great to see Mike Dorning. Thank you, sir. Look for him on the terminal and online. I'm Joe Matthew in Washington, where we will assemble our political panel next. Rick and Jeannie are both with us for the hour as we walk our way up to special Fed coverage. This is the last one, the last hurrah, the swan song for Jay Powell, and it's all covered here on Bloomberg.
1240 on Wall Street, I'm Amy Morris. A renewed rally in oil drove stocks and bonds lower amid worries that a prolonged closure of the Strait of Hormuz will fuel inflation. And we do check those markets for you all day long here at Bloomberg. The S&P 500 down 0.25%, NASDAQ down 0.4%, the Dow down 0.7%. 10-year Treasury yield at 4.4% and the 2-year yield at 3.91%. WTI now 7% higher at $107 a barrel. Brent crude now more than 7% higher. It's now topped $119 a barrel, and Bitcoin is down about 0.8%. The entire stock market may be riding on 4 big names today when Alphabet, Amazon, Meta, and Microsoft all report earnings this afternoon. Mandeep Singh is global head of tech research at Bloomberg Intelligence.
You want to see a clear contribution of AI workloads or AI products to the top line, and then how that trickles to the bottom line. That's where, the job cuts and the cost controls come in.
Mandeep Singh with Bloomberg Intelligence says the Magnificent Seven names could report within 80 seconds of each other after the closing bell. The U.S. has spent an estimated $25 billion on the war in Iran so far. Acting Pentagon Comptroller Jules Hurst provided the most complete public estimate of the conflict's costs so far.
So approximately at this day, we're spending about $25 billion on Operation Epic Fury. Most of that is munitions. There's part of that is obviously O&M and equipment replacement. We will formulate a supplemental through the White House that will come to Congress once we have a full assessment of the cost of the conflict.
Acting Pentagon Comptroller Jules Hurst testifying before the House Armed Services Committee. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's get back to Balance of Power with Joe Matthew.
All right, Amy, thank you so much. I'm Joe Matthew in Washington, and glad to have you with us here on Balance of Power, the Wednesday edition. That means Fed Day. About an hour, a little bit less. We'll turn things over to World Headquarters for special coverage and our Fed special here on what is the last one for Jay Powell. Not clear he's going to leave the building, but as chair, this is it. And as the man who really redefined transparency on the Fed, he'll be holding his final news conference. I bumped into Michael McKee in the newsroom a little while ago. He's down here. In fact, I'm sure he's in the building right now waiting for it to happen. You're going to hear all of that transpire. The announcement, of course, followed by the news conference at 2:30, and you'll hear McKee asking him questions. Mike will join us on the late edition of Balance of Power to talk about it. With big news today from the Supreme Court, we'll get to this in a moment with our panel, limiting the use of the Voting Rights Act. They actually came out with it today. The court rejecting this Louisiana congressional map that had a second majority black district, calling it an unconstitutional racial gerrymander. I'm sure our panel has feelings about this in an age in which we are redrawing congressional maps almost as a hobby now. But we've got a lot of other news to deal with. Remember the idea of a $1.5 trillion Pentagon budget. It was a big deal to get the first $1 trillion budget. Now we're looking for a 50% increase. Well, the administration is. And part of the job in budget season is you have to go up to the Hill. Each cabinet official goes up to the Hill to make the case for their respective agency. And sometimes they face some tough questions that might relate to their purview. And if your name is Pete Hegseth, you're going to hear about a lot. He was up there today with Dan Kane, the chairman of the Joint Chiefs, to make the case for this budget request. Again, $1.5 trillion. And there were a couple of pretty tough exchanges, as you would expect, with Democrats on that panel, not fans of Pete Hegseth, and in many cases, not fans of the way this war with Iran has been comported or transmitted, with any number of lawmakers, D's and R's, saying that they're just not getting the information. And also a lot of questions about, well, what exactly was the motivation? If the president says there was an imminent nuclear attack, how does that rationalize with what he said last year when we bombed Iran and the whole thing he had claimed was obliterated? The top Democrat on House Armed Services, the ranking member's name's Adam Smith. He's a Democrat from Washington. That was his line of questioning for Hegseth today. Take a listen.
Okay, we haven't gotten there yet. For all of the...
Well, their nuclear facilities have been obliterated. Underground, they're buried, and we're watching them 24/7. So we know where any nuclear material
reclaiming
might be.
my time for
we're
just
watching
a quick second here. We had to start this war, you just said, 60 days ago, because the nuclear weapon was an imminent threat. Now you're saying that it was completely obliterated?
They had not given up their nuclear ambitions, and they had a conventional shield of thousands of
So
missiles.
Operation Midnight Hammer accomplished nothing of substance. It left us at exactly the same place.
And he gets to do it again tomorrow. He's back at it, right? They took a break there, but he goes to the Senate side tomorrow. That could be even more chippy. I don't know. We'll see what everybody has in mind. But it's where we start our conversation with our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are both with us right now. Rick is our Republican strategist and partner at Stone Court Capital. Jeannie is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick, I remember you were the first to say on the air, look out for the first ever $1 trillion Pentagon budget. This is probably, what, a year ago. We're already on $1.5 trillion. And the administration's making the case that this isn't just about paying for ongoing operations. This is about replenishment, number one, and two, catching up with where we already needed to be in terms of our defense industrial base. Do you think they can get this done?
Yeah, I think it's going to be a hard slog. Obviously, the idea of even increasing substantially beyond the $1 trillion level is, a year ago would have been a pipe dream, right? No way, this is way too much. We're going to have to gut the domestic spending. But that's exactly where we are today. Yes, replenishment is a big issue. We've been spending our rockets down considerably, not just since Trump was elected, but prior to that, for the last 5 years, we've really done nothing to replenish our stockpiles of strategic weapons or missiles. So that's a problem, and we need to catch up. And all that costs money, and we're not in the process of cutting budget funds because we're building a new Navy. We're increasing our spend on the Air Force. The Space Force is in full array trying to catch up in space to what China's doing. So it's hard to find a place where you can't make an argument for more spending except for the fact that we don't have the money.
It does appear to be an administration that's hunkering down for something longer. Jeannie, the reporting today is that the president has instructed aides to prepare for an extended blockade of Iran. And we got something interesting today, a price tag. $25 billion is what we have paid so far in this war. We're at 60 days now. And the next 30 are going to be interesting as we approach that 90-day deadline. Will this blockade still be in place by then?
It's hard to see at this point how this gets reopened. Iran has come to the table with a new 3-step plan, if you will, as we sit there and listen to the defense secretary talk about the fact that this is all about Iran's nuclear weapons, and that is our goal, to rid them of not just their weapons, but I guess their ambitions in that clip you played. We see the Iranians saying, wait a minute, we have reordered the steps. We are now putting nuclear program number 3. First is we get an end to this war and assurance it won't happen again. Second is we get the Strait open where we still have a role in controlling the Strait, and then we'll talk nuclear. So we have an administration that has entered a war with a Strait open and the economy getting stronger. We are now 60 days in, the Strait is closed, and any talk about nuclear ambitions, which was going on when we started this thing, has been moved down the ladder. So it's hard to see, unless they're willing to negotiate on that, where we go forward. And, it was striking to hear Ro Khanna ask the secretary questions, and I've been listening to this all morning, and for the secretary to describe the cost, questions about the cost of this war to the American people as gotcha questions. When Ro Khanna, a member of Congress, is saying, what is this going to cost? And he had run the numbers and said it's $5,000 per year per American. The secretary dismissed all that as merely a Democrat's attempt at gotcha questions. And last time I checked, they had an opportunity here to come forward and make the case for this funding. And we have yet to hear it beyond him blaming Democrats as the biggest enemy in terms of what we are facing. So I think it's a missed opportunity on the secretary and the administration's part today.
Rick, I spoke off the record with a Republican senator last evening who seemed very concerned about the lack of briefings, which is something that we have talked about, but also the timeline here, the lack of explanation, and made it pretty clear that we're going to need an AUMF. There will have to be an authorization for the use of military force if this crawls past 90 days. And he implied that there would be, in fact, many other Republicans who agree with him. What's your expectation on that front when we get to 90 days and the congressional response?
Yeah, look, I mean, this is not an administration that felt it had to keep the Congress informed on any of its military plans. We've been attacking the sea lanes in the Caribbean to fight drug lords, and the Defense Department, for whatever reason, has just ignored the cries of Congress to come and explain how they have the intelligence to know whether or not these are fishermen or narcotics dealers. We didn't have any heads up on the Capitol Hill on other attacks, including, the attacks that leveled the nuclear programs in Iran. So it's a long list of, I would say, ignoring Congress. And as you point out, Joe, that bill comes due. By the end of the 90-day period in this war, Congress has an obligation to address this, and nobody wants to touch it. It's a hot political issue, but they know they have to, and they're just begging the administration, please, help sell this for us. Don't just give us the highway. And It didn't help when Hegseth started out his opening statement by basically saying the biggest threat to America are Democrats in Congress. I mean, that's not the way you're going to get a positive response.
That's literally what I heard last night, Jeannie. He said, help us sell this. You might only have 30 days to sell it, so let's get it started, because the Republican membership in the Senate and the Republican conference in the House support this effort. They need to go home and sell it, though. Will they have the administration at their side?
They should have started today. I mean, to your conversation, Today was a day. I would argue we're 60 days, 90 days late on doing this, but never a moment to waste. They could have done it today. As I just mentioned, Pete Hegseth went in there aggressively. He's very concerned about what representatives are saying on television, calling the war a quagmire, sort of ignoring the American public and the polls, which show this is widely unpopular. And it's unpopular for a lot of reasons, but one is that they have done nothing to sell it to the American public or Congress. And I am reminded of Cap Weinberger's doctrine, the fifth of the 6 steps that you need to go through, according to that doctrine, before you enter a war, is you need to ensure that you have the support. That is the support of the American public, the support of Congress, not to mention our allies. The administration has completely ignored that. And so what we're hearing today, because they didn't have a debate for authorization of this war, that debate is happening now when they're up there asking for more money to continue this. So they are coming from behind. And again, it is a missed opportunity at the hands of this secretary today.
Look at oil prices today. Crude oil now almost $107 in New York. WTI is up 7%. Brent is also up 7%. Now above $119 a barrel. Gas prices, what did I see? I got to look at this again because I don't even trust myself anymore. $4.23 on a national average. Rick, you heard the story I mentioned about oil supplies, oil storage, I should say, for Iran. They're running out of storage. They're starting to load it onto ships because they can't keep it in the ground. And at some point, it's going to be a problem. They have to, in the next couple of weeks, probably start closing wells. Is that the strategy here? If Trump is telling aides to prepare for an extended blockade, is that the way this ends, that we simply wait them out so they can no longer produce oil?
Yeah, I think that the president has figured out that he can't bomb them into submission. That was the first 3 weeks of this campaign, and it didn't turn out that they were ready to surrender as he required them to do. And so now I guess it's choking them out economically. I think everybody is all sort of on board with this nacho strategy. Not a chance that the strait opens up, and so, yeah, I think that this is just the second phase of the campaign where now it's an economic game. There are a lot of people I've talked to who are experts on Iran and the region who just don't believe that you can, create a scenario in Iran that will bring them to the table where their nuclear program is willing to be discussed first. And so we, I think, are in for a long slog on this one.
The nacho strategy? I had to Google it. This is all right. I'm catching up on this one. Not a chance Hormuz opens. Not actually committed, humiliated overseas. never avoids confronting hard obstacles. I think he meant not a chance Hormuz opens. The nacho. Who needs a taco when you got nachos? Rick Davis and Jeannie Shanzano stay with us. We'll plow into our second hour as we count down to the Fed. Thank you both for a great panel. We'll talk about the Fed and the confirmation of Kevin Warsh coming up, happening on the same day here on Bloomberg.
Live from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
It's Jay Powell's last meeting as chair, just as his replacement clears committee. Welcome to the Wednesday edition, Fed Day, with an announcement on interest rates now 1 hour away, followed by Powell's final news conference, with the Senate Banking Committee voting today to approve Kevin Warsh as the new chair. We're going to get the latest in a moment from Stuart Paul at Bloomberg Economics with insights from our political panel today and from Republican Senator Shelley Moore Capito of West Virginia. It's the fastest show in politics today. We've got special coverage starting in just a half hour, and we start, as always, by setting the baseline on Wall Street. Let's turn to the markets. Here's Amy Morris.
this Fed decision amid mounting concerns that any elevated energy prices are going to curb the potential for interest rate cuts this year. We do check markets for you all day long here at Bloomberg. S&P 500 down 0.25%, NASDAQ down about 0.4%, the Dow down 0.6%. 10-year Treasury yield at 4.39%, the 2-year yield at 3.91%. Now let's look at oil. Both WTI and Brent crude are more than 7% higher. NYMEX crude oil now topping $107 a barrel. Brent crude topping $119 a barrel. Investors looking for clues on which direction the stock market will be headed in the coming weeks. They'll be getting a rapid fire reading as soon as trading ends today. 4 of the biggest companies in the U.S., Alphabet, Amazon, Meta, and Microsoft, are going to be reporting their earnings after the bell. And if they all hit at the same time as last quarter, this should all play out within just 80 seconds. We're buckled up. The Fed's April rate decision is about an hour away, 2 p.m. Wall Street time, but the focus may be less on the future for rates than on Jay Powell's future as a member of the board after his term as chair runs out in just about 2 weeks. Our coverage of the Fed decision and likely final Powell news conference will start about 30 minutes from now on Bloomberg Radio and Television and the Bloomberg Business app. And of course, we are watching for Pershing Square Holdings to start trading. The ticker is PSUS. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power now with Joe Matthew.
All right, Amy, thank you so much. As we count down to our special Fed coverage less than a half hour away, we've got some important news in Washington with a pretty quiet day now that the king has left town, making his way to New York, in fact, where he's meeting with Mayor Mamdani at the 9/11 memorial. The Supreme Court takes our attention with an important ruling today that we have been waiting weeks and months for, limiting the use of the Voting Rights Act to create predominantly black or Hispanic election districts, rejecting a Louisiana congressional map that had a second majority black district, calling it an unconstitutional racial gerrymander. The decision along ideological lines, 6-3. We are also watching the confirmation process, and this plays right into our discussion about the Fed today of Kevin Warsh. He cleared committee just like that. It was less than a week ago that Tom Tillis dropped his objections after the DOJ dropped, if I can use that word, or transferred its investigation into Jay Powell from DOJ to the Fed IG. Tillis dropped his blockade, and just like that, Warsh, as expected, clears committee. The question is when he will see a full confirmation vote, and many expect that to take place on the floor of the Senate by the end of this week. But today, it's about the matter at hand and what it's going to mean for Jay Powell, his final meeting as chair. And I'm glad to say that we're joined by Stuart Paul, of course, Bloomberg Economics U.S. economist. It's great to see you. Just as I introduce you here, Stuart, red headline on the terminal, Brent rises above $119.50 a barrel, the highest since June of 2022. How difficult, before I ask you about Jay Powell's swan song, is this war in Iran, the reaction on the energy markets, going to make it for the Fed to ever cut rates?
Well, so the war in Iran creates two-way risk. Of course, it almost mechanically boosts inflation acting through gasoline, but it also weighs on real household spending growth. I expect that we're going to end up seeing some dulling real spending, especially in the second quarter. Given the fact that the Fed cannot do anything to bring additional barrels online, I wouldn't be surprised to see the Fed become a bit more attentive to downside growth risks in the future. I think that even as oil prices stay high, we could see the door open for rate cuts if we end up seeing further deterioration in the labor market and, again, that downside growth materializing.
Okay. Really interesting. Headlines, by the way, crossing the terminal on Pershing Square. Easy for me to say. We're waiting for the initial trades of this combined IPO. Pershing Square USA now indicated at $32.50 to $37.50 with an IPO price of $50. Pershing Square Inc. indicated to open at $19 to $22 each. When this crosses the screen, we'll, of course, let you know. What's Jay Powell going to say today about the way forward? We don't expect any change in rates. What's the statement going to read?
I expect that the statement is going to acknowledge the downtick in the unemployment rate that we saw in March. So if he were to describe the labor market as solid, if the statement were to describe the labor market as solid, for example, that might be an incrementally hawkish change to the statement. if we were to see any sort of additional emphasis put on well-anchored long-run inflation expectations, again, just hinting that the committee as it currently exists has no intention of cutting rates in the near term, I expect that those are going to be the sort of changes that we're going to see. Again, there's so much uncertainty, policymakers are just going to have to acknowledge that and really lean into uncertainty to maintain to keep their options open.
Move on to the news conference. All anybody's going to want to talk about is him, right? I mean, I guess they're going to want to talk about policy as well, but it's going to be, what are your future plans? Does he tell us today? You think when he plans to stay, when he plans to leave, I should say, or if he's going to stay once Kevin Warsh is confirmed?
I don't think he's going to break any news about his future plans today. I think he's going to be pretty precise and vague. And so I expect that, again, this is going to be the first question we're going to get. It'll probably be 30% of the questions we get at the press conference. And I expect that he's going to start by saying that he's there to represent the views of the FOMC. He's not there to make any personal announcements. I imagine that he's going to acknowledge that Kevin Warsh's nomination still needs to be debated on the Senate floor. It still needs to be voted on the Senate floor, so it would be premature for him to announce any sort of decision that he's made. So we're going to really need to focus on some of the code words that he might bring up during his press conference. For example, there's a difference between saying that he wants to follow the precedent of former Fed chairs, which would hint that he'd be willing to walk away from his board seat. There's a difference between that and saying that he wants to facilitate a leadership transition, for example. Like, to me, if I were to hear that, that would be a hint that he'd be more inclined to stay into 2028.
Okay. Stewart's got the decoder ring out. There was a question in one of the tip sheets this morning if he just goes YOLO and starts saying everything he ever wanted to say about Donald Trump, but that would be a bit out of character, I'm guessing. You mentioned Kevin Warsh. Stewart, let's go back to the committee, the hearing that was held for his confirmation before Tom Tillis dropped his blockade, if you will, knowing that Warsh was confirmed today. Let's go back to the banking committee hearing. Remember Elizabeth Warren? Listen.
Trump is still going after control of the Fed, and he is keeping the threat of bogus criminal charges alive until he gets what he wants. These are uniquely dangerous circumstances to advance any Fed chair nominee. But Mr. Warsh is uniquely an unfit candidate.
It's no secret that the reason that Mr. Warsh's nomination could have been held up is because of my concern with the investigation. I want to thank the Department of Justice for the assurances that they gave me. I've got confidence that this investigation is over. And I think that Senator Warren, I get that she wants to score some political points, but she is flatly wrong on every point she just tried to make.
That'd be Tom Tillis right there, the senator from North Carolina who held this whole thing up, and knowing that he was a Kevin Warsh supporter. We could see a vote, Stuart Paul, on the floor as soon as this week. What will the Fed look like once Kevin Warsh is in the building? What will it mean for the culture in the building and his ability to achieve consensus?
Well, so first things first, he'd be replacing Stephen Myron on the Board of Governors. He would then be chairman of the board. I think that a lot of the folks in a lot of the staff are going to be a little bit nervous. This is Kevin Warsh, who has said that he is in favor of institutional reform. He's in favor of cracking heads if need be. And so I imagine that he's not going to receive the warmest welcome from the staff. But then again, he's the guy who's going to be in the driver's seat. He's the guy who's going to be setting the agenda for board meetings. He's the guy who's going to be determining what interagency rulemakings he wants to consider and whether that could lead to deregulation of the banking industry so that he could achieve the sort of balance sheet reduction he said he wants. So I imagine that it might be a little bit of a culture shock for staffers, and I imagine that Kevin Warsh, when he walks back into the building for the first time in several years, I think that this is going to be a Fed that he perhaps struggles to change its course.
Interesting. I just saw Tom Keene walk by behind you. He must be on his way to the studio, so we're getting close here. The T-Rex
of financial news is in the building. Stuart, it's great to see you, as always, on this Fed Day, no less. Stuart Paul with us live from New York. Let's assemble our political panel because the politics are pretty involved here with all of this when we consider the impact of the war in Iran, the pricing pressures that consumers are facing. It's a huge conversation on Capitol Hill, much like the confirmation of the new chair. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. Jeannie is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. There's Rick Davis, our Republican strategist and partner at Stone Court Capital. Jeannie, what's the swan song going to sound like for Jay Powell when he stands before reporters today? Does he play it straight?
You know, I think he will, but I know many of us are hoping he does like an un-Powell-like thing and really lets us know how he feels, as to your earlier point, but I seriously doubt it. You know, it's interesting to listen to Senator Tillis, though. He says he has a lot of confidence this investigation is over. And we are sitting here, you know, not 24 hours after they indicted Jim Comey on seashells that he took a picture of a year ago. And I wonder, do you think that Jerome Powell feels quite as confident as Senator Tillis that this investigation is over? Or does the Department of Justice come roaring back? Because, of course, Todd Blanche is, you know, aiming to be the Attorney General, not just acting. He is performing for an audience of one, and he is indicting a former FBI director for seashells. So, you know, I'm not sure if I'm Jerome Powell that I would feel quite as confident this thing is over, because apparently the retribution tour continues.
Well, I mean, if you just go and look at the statement from Judge Jeanine, she made it pretty clear that if this Inspector General report turns up new information, she could reopen this investigation. Rick Davis, I'm guessing Jeannie's implying that Jay Powell might want to stay around for a while. Do you agree?
Well, first of all, it makes me laugh. You call her Judge Jeanine, U.S. Attorney Jeanine Pirro. Right. But I made the same mistake earlier today, so I applaud you. Yeah, look, I mean, the safety play here is stick around, right? You know, use the cover of the Fed and the lawyers of the Fed to defend yourself. And I would point out, I mean, you know, Chairman Powell did a video pushing back directly at the president when he was first attacked by the Justice Department. This guy has not held his breath when it comes to fighting for the Fed independence and his own credibility. And so I can imagine when he is replaced by Kevin Walsh as chairman, it may be a liberation moment for him, especially if we're right and that, like, the Department of Justice decides to continue to harass him.
Yeah. Are you optimistic about Kevin Walsh, Jeannie? I'm not sure where Stuart Paul left that with us, but he implied that he might not be terribly popular when he gets in the building. I guess Myron's going to have to figure out what to do in the meantime, because if Jay Powell doesn't leave, he might have to find another job. What will the Walsh culture look like?
That's right. I mean, I think to the earlier point, there is a lot of concern. You know, there is no question he is eminently qualified for the position, but things that he has said, and I think in my mind, even more importantly, just like Todd Blanche, the fact that so many people that Trump brings into any position, even one that is supposed to be independent, people feel beholden to the president. They feel pressured. And if we just go back to his hearing, that was the number one concern. Will you be able to maintain independence given the onslaught of pressure that you're going to feel? And as we all know, Trump will be your best friend one day and, you know, criticize you up and down the next. And so I think that's where the concern is going to be raised. And of course, we are talking about a very fraught time. We've got the inflation, we've got high unemployment, we've got what seemingly now never ending, hopefully not, but never ending war. And we've got consumers very, very concerned, and an administration that just a few minutes ago was in Congress telling members that if they ask about the cost of something, it's a gotcha question. So all of that is the environment. So, you know, bless Kevin Walsh for wanting to come in on this, but I do think it's going to be a really, really tough moment if he intends to fulfill his promise to maintain independence, and I hope he does.
Well, that's interesting. Rick, I don't know if the Fed chair is going to weigh in on the war with Iran, but you've seen oil prices today. I mean, these are some of the highest that we have seen yet since this all began. In fact, I think Brent is in a whole new world at $119.50, the highest since 2022. Their WTI and Brent are both up both over 7%. In the case of New York crude, up almost 8% today. Gasoline at $4.22. I can only imagine what the next UMich Consumer Sentiment Index is going to look like, which you frequently point to. It's going to handcuff the Fed, isn't it?
Yeah, I think that they're going to put me in a really tough position. I actually looked at some of the gallon gas prices in competitive Senate races, and it's a disaster for Republicans going into re-elections for some of these races, because in some cases it's approaching $4.50 a gallon. And when you look at the current spate of polling, which will be reflected, I'm sure, in the consumer sentiment indexes, you know, folks are getting more and more grumpy. I mean, the president's numbers are falling precipitously in 1 month. You know, that there's a lot of things going on. It could be the war, it could be the economy, but more and more people are going back to the cost of living. And I think that is really going to pinch the Fed on its policies.
It's really something. $4.23 for gasoline. Jeannie, we're creeping back up to that $5 or whatever the high was during the Ukraine war. And the president is now saying, according to reports today, he's telling his aides that we need to hunker down for an extended blockade in the Strait of Hormuz to essentially wait out the Iranians. If this goes up to $4.50 or $5, if crude oil keeps rising to $120 or $150, what will it mean for our economy? We're going to be talking about the R word at some point soon, aren't we?
We are, and some people have described it as, if this keeps up, the war and the blockade, we are heading towards a Titanic-style disaster. And, you know, the idea that the president is going to wait out the Iranians, if we can just all take a step back and think, time is on the Iranian side. Iran can wait this out. They have been practiced at this for decades. What the president needs to do, and I'm happy he's not escalating, what he needs to do is get back to the negotiating table. The only end to this thing is to negotiate a settlement. And unfortunately for the president, given where we are now, that negotiation is not going to be pleasant or fun for the United States by any stretch of the imagination. Iran is saying, first things first, we end the war. Second thing is we open the strait and we remain in control, and then we'll deal with nuclear. That's not what the U.S. wants. But at this point, if we think we can wait it out, we should remember recent American histories of wars. When somebody feels that they're under an existential threat, and that is how Iran feels in the face of Israel and the U.S., they will fight to the end, and Iran is well prepared to do that. And so the impact on the economy in the U.S. and worldwide would be devastating, and Iran will sustain that. And I'm not sure that the U.S. people are going to feel the same way. That's the conundrum we have gotten in 60 days into this.
Just want to mention quickly the headline on the terminal on Pershing Square, USA, now indicated at $36 to $39 when trading begins in this IPO. Remindingly, the IPO price of $50. It has not begun trading yet. Reporting today, Rick, that President Trump summoned oil and gas executives to the White House yesterday. They were there presumably after the king went up to the Hill to talk about the menu of options here and how energy markets would respond to some of the various decisions the president could make, including what we're doing right now, just maintaining the blockade, but for a longer period of time, but also the potential for a resumption of strikes or other military kinetic action. Among the attendees, according to Axios, Chevron CEO Mike Wirth, you had the Treasury Secretary, Chief of Staff Susie Wiles, Kushner, and Witkoff were both in the room. Is he going to ask them to start increasing production? Is there something that the oil industry can do to relieve some of the pressure?
Well, the problem is they can't increase production enough to supplant what the entire world is currently short of because of the closing of the strait. So prices are a global price. And regardless of our America First strategy and our ability to pump more and our ability to be energy independent, a lot of the global pricing is still fixed. And, I think a lot of these individuals you just described have a global point of view. They can explain to the president, that we're caught in the trap of our own making, that, as long as the straits close, the prices are going to continue to go up, and those affect the prices here at home. And you can see it every day in the reports on Texas crude pricing. So at the end of the day, there's no real solution that the U.S. oil producers can do just for the U.S. I mean, our economy is actually holding up better than virtually any other developed country in the world right now. But that doesn't fix his political problems, that people don't feel that way.
Yeah, really interesting. As we wait for trading to begin and ahead of our conversation with Senator Shelley Moore Capito, Jeannie, what are your thoughts on this? I mean, some folks say it's time to crank up the shale oil, but to Rick's point, it's going to be a drop in the bucket.
It would be a drop in the bucket. And let's not forget, even if the strait was open today, it is going to take time to get back to where we were. The answer to this is a difficult answer, but it is a negotiated settlement with Iran. And we are talking just to get back to square one, which is an open strait and a stabilized economy, and then deal in a negotiated way for a settlement on the nuclear end. That's the only answer we're going to see, and that's the only answer that will work. Everything else, the United States has lost steps to Iran, and that is a really unfortunate reality of where we are 60 days into this.
Yeah. Something tells me this will work its way into the conversation today with Jay Powell. Rick Davis and Jeannie Shanzano, thank you so much both for a great conversation. Bloomberg Politics contributors and our great panel today here on Balance of Power with our eyes on oil prices. Both WTI and Brent are up over 7%. And before we talk to the senator, let's bring in Amy Morris for a quick update on the markets today, energy prices, stocks, and beyond. Amy, what do you have?
Well, we got a renewed rally in oil. That's driving stocks and bonds lower. The standoff over the Strait of Hormuz, as you were discussing, continues to drag on as we check the markets for you all day long. Here at Bloomberg, the S&P 500 down 0.25%, NASDAQ down 0.3%, the Dow down 0.7%, 10-year Treasury yield at 4.39%, the 2-year yield at 3.9%, WTI topping $107 a barrel, Brent crude also topping $119 a barrel. Now, briefly, like a half hour ago, Brent crude hit $119.50 a barrel. That's the highest price we've seen in Brent crude since June of 2022. The entire stock market may be riding on four big names today: Alphabet, Amazon, Meta, and Microsoft, all reporting earnings this afternoon after the closing bell. We're ready for that. Bill Ackman's Pershing Square going public after raising $5 billion. Pershing Square USA shares indicated to open around $36 to $39 per share, still below the $50 IPO price, and the company's still facing questions about what will drive demand in the secondary market. So for on-demand news 24 hours a day, you subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's the Bloomberg Business Flash. Let's go back to Balance of Power with Joe Matthew.
All right, Amy, thank you so much. As we count down to special Fed coverage that's less than 10 minutes away, it's always a pleasure to bring in Senator Shelley Moore Capito, the Republican from West Virginia, joining us now live from Capitol Hill with a very important deadline ahead tonight that, Senator, we'd love to ask you about. It's great to see you. Welcome back to Bloomberg TV and radio. Around here, we say Happy Fed Day, so I hope you're celebrating. But importantly this evening, and I hope you're feeling all right, by the way, I've got the same pollen going on here.
Allergies,
I totally... This is Washington this time of year. The House cannot seem to find footing around a FISA reauthorization, which expires tonight. Is the House the main impediment to the president's policies right now?
Well, I think the president's been very forceful and asking, and so have the intelligence community as well, that we need FISA reauthorization to be able to disrupt and to catch and to be the most effective intelligence operation that we can be for the safety of the American people. I certainly would vote to reauthorize, and have many times, to reauthorize FISA. I think it's found to be helping us when we're investigating foreign individuals that are after us and wanting to do us harm. And I hope the House can see the way towards passing this tonight.
Well, indeed, that would be a pretty big deal. Does the president have options, as has been reported, to continue working under FISA if there is a lapse?
Well, right now, I think what we're operating under now is almost a 2-week suspension, and as you mentioned, it expiring later tonight. We would have the option, possibly, to re-extend the extension, but I do think the president has some maybe extraordinary means that he can use to still use the asset of FISA for our own homeland security and our international security. Those options, but the preferred options, and certainly the best legal option, is to have this confirmed so that we can have it for the next 3 years, which is the goal. And this, people need to realize this is not listening in on American citizens. This is foreign people, foreign actors in foreign lands that are trying to disrupt and terrorize and figure out cyber crimes and other things to disrupt our national security.
We've got a Fed meeting today, once again, Senator, and of course, oil and gas prices, energy prices broadly, are going to be part of the conversation as we consider the impact on inflation, or the potential impact, with a national average today of 423. I'm looking at West Virginia. You're hovering just over 4. You've got a 4 handle now in West Virginia at 406. I don't think we're going to be driving coal-powered cars anytime soon, which might bring prices down in your state.
I think rightly so. I think we
gone for months.
Well, I think we're all concerned, and I think rightly so. I think we see what the impacts of the situation in Iran and in the Straits has caused to the international markets. I noticed that the barrel of oil is up today fairly significantly, and that impacts our gasoline and particularly our diesel prices. When you talk about ag and other industries in this country that use diesel in great amounts, this has huge impacts for them. And so the longer it goes, the more not just impactful, but worrisome it is for the long-term economic effects. The president is working hard to try to bring this to a close. He's been at the negotiating table with his team. The problem is Iran is not trustworthy. We know this. But it seems to me as though they are having a lot of infighting to decide who's going to be in control of their country. And while I think that's good to have the disruptions, it makes it difficult to know who you're dealing with here. And, they want to take talks about whether they're going to develop a nuclear weapon off the table. In my opinion, that's a non-starter, because that's the real danger to the world. So hopefully sooner than later, we'll see things wrap up. The fact that we are talking and briskly talking, I think is a good indication that this could come to a close sooner than later.
I've been hearing from some of your colleagues in the Senate, Senator, that at the 90-day mark, we will be needing an AUMF to continue in Iran. And these are members who support the war, but that something should be codified congressionally, knowing now we have a $25 billion price tag. Would you support an AUMF at the end of this period of time, whether it's 60 today or 90 days?
I'm certainly going to look at that. I do think that there is a push and pull as to how much oversight we have, I will say the administration has been forthcoming in terms of information and classified briefings to keep us on top of what the situation is and what kind of assets we have there, and what little less transparent on what the real cost, but we should be getting more of that transparency there. That's where I think we can be most effective. Whether I would vote to authorize a use of force, I'm going to cross that bridge when I come to it. Hopefully things will have settled. We don't have boots on the ground there. I think that is a significant factor in terms of making the determination as to whether the president needs to come to Congress for a declaration of war. But there's no question in my mind that Iran is and was and continues to be a source of concern for us, and not in a small way. This, in my view, it was not if we're going to do this, it was when the president had the nerve and the ability to do this at this time, and I have been supportive of that.
Yeah. We've only got a couple minutes left, Senator. Something that you know a lot about as chair on environment and public works is the impact of this energy conversation that we're having. And we've seen kind of a push and pull when it comes to alternative energy. Gas and oil prices start to go up. Fossil fuels are more expensive. People are, as you know, human nature would dictate, more likely to reach for an alternative. But we've seen an unwinding of wind, especially, and solar under the Trump administration. As the chairwoman on this important committee, do you see that alternate energy industry being unwound permanently?
You know, I'm one of those who believes we need everything, and we need everything all the time. I come from a coal state, natural gas state. So on that side of it, we've been providing energy for this country over 100 years, certainly from our coal. And so we have a great appreciation for that, and we still want to be a part of that, and we are. But at the same time, the insatiable desire for more power is going to require everything. And so my view is if we can permit, which I've been working on a lot, and keep the environmental parameters in place, we should have it all.
The president talks about coal, clean, beautiful coal, as he likes to say, as part of that, all of the above. What does that mean for your state?
Well, that means a lot. It means the elongation of a lot of the power generation from coal, where the Biden administration was trying to force the premature closing of many of our coal-fired power plants, but also the Biden administration was going to prevent you from being able to build a natural gas new facility to power. We have to do things that make sense, and baseload energy is absolutely critical here. If we don't know it now, we certainly have learned it over when we see the impacts, what happens internationally on our energy. So these are big things for our state because we're a big natural gas provider, but also coal.
Just quickly, does all of the above or everything include wind? The president has really isolated wind as kind of the outlier.
You know, I know the president doesn't have much affection for wind, either offshore or onshore. Yeah. Personally, we have wind in West Virginia, if it's sited properly and can generate the kind of power that we need. I think we should be looking at everything. Absolutely.
How about that? All of the above means all of the above. To Shelley Moore Capito, Senator, thank you. It's great to have you back on Bloomberg TV and radio. I'm Joe Matthew in Washington. I'll meet you back here on the late edition of Balance of Power, 5 p.m. Eastern. Right now, a special edition of Bloomberg Surveillance. The Fed decides. It starts right after this.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live from New York City this afternoon. Good afternoon. Good afternoon. Your afternoon starts right now. And that rate decision is 27 minutes away. After that, 4 of the biggest companies on the planet reporting earnings. And this is how the stage is set. Let's kick it off with a cross-asset price action and start with crude. Crude taking out the closing high of the year so far, just in the last few hours. Brent crude, 118 on an 8-day winning streak. Over that period, higher by more than 26% and up another 6% so far. Check out the bond market. This is the read-through. Crude up, yields higher. 390 on 2s, 440 on 10s. New highs for the year on 30s if we close at these levels, 498. Something's out of whack. We've got new highs on crude, close to new highs on yields, and equities still 13%, 12 to 13% off the lows. Equities this afternoon just down 0.2%.
And it all hinges on what we get after the bell, which is the earnings from the likes of Meta, Microsoft, Google, and Amazon. Do they justify the enthusiasm for AI, and can it overwhelm some of the concern about a stagflationary shock that's coming to fruition? And that ultimately is what the Fed will be discussing.
I get that almost distant. I mean, it's there and it's really important, and we're all glued to it. And I've had a lot of research notes in this morning. And John, this is the economist Michael Tyson with Everlast. Everyone has a plan till they get punched in the mouth. And your data check, which is wonderful, is that the new punch in the mouth where things become a bit unraveled?
We're taking a beating at the moment, but not in the stock market. That's what's interesting about this setup at the moment, Bramo, insulated by the earnings story so far. And the earnings story so far, coupled with the economic data, so far so good.
This sets up the real tension for a Federal Reserve that has to decide whether or not the strength in the economy can allow the inflation from oil prices prices from the supply shocks to ultimately transmit through the economy and become a more prolonged shock. This sets up the tension because ultimately, can you have your cake and eat it too? Can you have a resilient equity market that also allows consumers to keep on spending while absorbing some of these higher prices?
We're going to get started with the show, but I would just suggest, John, what's so important
Show
here.
started,
I mean, get to the guests and all that.
Okay.
We got Bob Michael on deck. But what I would say that's just so important, John, is you look at the moment we're in right now. What does Powell do? Just softball it through the press conference?
With great
He's got to
difficulty.
step up and make a statement.
There is some suspicion, and I think this is the question going into this decision, the statement and the news conference, whether they introduce a more symmetrical reaction function, or at least try and articulate one to anchor inflation expectations with the price pressure that's brewing in the commodity market.
Some people are saying ultimately they have to say the next move could be a hike or potentially some sort of cut. And could that change the market reaction? I'm not going to answer. Much better people are going to answer than that. Coming up shortly, JP Morgan's Bob Michael, SocGen's Subhadra Rajappa, and Deutsche Bank's Matthew Lazzetti. They'll be taking us up to that Fed rate decision at 2 p.m. Eastern. Then immediate reaction from Stephanie Roth of Wolfe Research and Citigroup's Kate Moore. And finally, breaking down Chair Powell's news conference, which I'm sure will be completely a snoozeville, Jim Bianco of Bianco Research and BlackRock's Jeff Rosenberg. It will not be a snoozeville. That will be where all the fireworks are, John, and we all are waiting to see what that looks like.
Looking forward to it. With us around the table, Bob Michael of JP Morgan. Bob, good afternoon. Good to see you.
Happy to be here.
Is it a problem that we're talking about none of that going into this decision? We're only talking about the future of the chairman of the Federal Reserve.
I think that's one of the big elements of this meeting. Is he going to stay? Is he going to go? There's certainly an exit ramp for him. The Department of Justice has dropped its investigation. He already called the Inspector General that reports to the Fed, by the way, to start its own investigation. If he wants to leave, he can.
Are you more interested in that, or are you more interested in this question of how they really portray a reaction function at a time where inflationary risks are back on the table?
So that's one of the three things we're looking for. The first thing we're looking for is how they characterize the economy, the labor market, and inflation, given all the uncertainty in the Middle East. Changing a word here or there, inflation remains somewhat elevated to just elevated, can tell us a lot. The second thing we're looking for is exactly what you said. It's also in the FOMC statement. Look at the third paragraph. If they change the sentence that talks about the changes in additional adjustments to their policy range and drop additional, that tells you they're migrating to something that's more symmetrical. And of course, the third was what happens to Powell.
Bank credit analyst up in Montreal had a beautiful note the other day that said, look, there's a reset here in inflation, which means all in all, we're more restrictive. This meeting versus the last meeting, $119 oil, you know, the 30-year bond, 4.98% rounded up. Are we in a more restrictive space for Americans?
I think so. I think what we're looking at is cost push inflation. So it's behaving as a tax right now. When you've got gas that's probably over $4.20 a gallon on average, that's going to eat into discretionary income. So it will slow things down. What we have to watch is, does it pass through to core prices?
Yeah. What's great about this is cost push inflation, John. That was the last time people wore thin ties.
Oh, are you taking a dig at me?
No, not a dig at you.
Are you saying this
cost push is from the 60s?
Are you saying I'm a choiceful consumer and can't afford a wider tie?
No.
Is that
I'm
where this is
saying
going?
you're fashion forward.
Or fashion backward, if fashion backward compared to what you're talking
Why
about.
am I the target of criticism? We're only 8 minutes into the programme. Give me a break. Can we move on? What if you wear bow ties? What decade are you in?
This is $119 panic green.
This is what happened after the Depression.
Yeah.
Yeah.
All right, guys. Wow.
Well, you know, we're exchanging.
Yeah.
So you want to talk about markets?
Yeah, I do actually.
Let's talk about that. Let's talk about inflation pressure. Bob, the pushback we get to the inflation review is the labour market simply isn't tight enough to worry about broad-based price pressure. Would you go along with that?
No, I wouldn't. Unemployment's in the low 4s. To me, that looks like a reasonable level for full employment before COVID. Let's see how the Fed characterizes that. And if you look at wage growth, it's going up pretty nicely. I think what we are seeing is inflation starting to pass through the system. Whether that will hit aggregate final demand, we have yet to see. But I think right now the economy looks in pretty good shape, can absorb some level of inflation for the foreseeable future.
This feels different to me from the last time we've spoken to you, or the last couple of times we've spoken to you, and you said you see this more as something more that causes demand destruction than, say, inflation. And you're all in on bonds, right? The idea that there definitely is an opportunity here. Can you describe what's shifted for you in terms of your expectation for inflation and how that kind of bleeds into your call?
Yeah, I didn't think we'd be here 6 weeks later with the Strait of Hormuz still blocked. I thought we would be in the end game. We'd talk about it reopening, there would be moderation in oil prices, and take some pressure off of inflation. It seems like we're more in the middle of it still. So does that mean it goes on for another 6 weeks to 2 months? It could do. And then you're stuck with energy prices that are higher. You're stuck with gas prices that are over $4 a gallon, and you're forcing businesses to make a decision. How long do they absorb those costs versus trying to push them on? You will see some demand destruction, but remember, this time last year, we thought tariffs would create a lot of demand destruction. It did initially, but then the economy picked up again without missing a beat. So I'm reluctant to say this time the economy will stumble. It didn't last year. It might actually absorb that this year.
What's the unexpected you worry about?
The unexpected is that things spiral out of control. You do have $150 oil per barrel. That starts to push through and create a lot of demand destruction. And then the Fed's in a very uncomfortable spot. You've got very high headline inflation, but you've got an economy that's about to tip into recession. They have to decide which decision they make. Right now, we're talking about they could just remain on hold through year end and see how things play out. But a material spike higher would create a lot of problems.
Do you think we're really close to that tipping point right now?
I don't think so. It feels a little different than actually a couple months ago. It feels as though there are workarounds that are going on. We know there's an east-west pipeline. The 80% of oil that doesn't pass through the Strait of Hormuz probably could increase capacity. We're already seeing the UAE talking about leaving OPEC. I don't think we'll get there, but you certainly can't take it off the table.
Bob, it's good to see you. You're going to stick with us. Bob Michael of JP Morgan Asset Management. This equity market wanted to move on. And to be fair, even this afternoon with crude close to 120, this market's not really responding to it.
Yeah, although what Bob was talking about there is really interesting. Is the stock market's sort of placating feature that the economy can look forward actually be a real negative for the bond market that the bond market hasn't woken up to? And maybe that's what we're seeing in the bond market, just waking up a little bit over time.
Looking forward to this. The decision about 18 minutes away. 30 minutes later, a news conference with Chairman Powell. Feeling a little self-conscious now, TK?
No, you look great. You're styling.
I think it looks fabulous.
You know I'm delicate in the afternoons.
Well, you're styling.
You've got to look after each other. Build each other's confidence, not knock each other down.
I haven't changed my look for 40 years.
And you guys look fabulous.
Maybe after the commercial break we'll swap.
Oh,
please. I will pay good money.
Not a chance. Not enough. Not enough. Up next, Evadra Shaffer, Matt Lazzetti.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Have you ever used a credit card and had it denied? I get to Wells. First thing I want to do is get a Wells Fargo credit card. I was out to dinner with some good friends, and I pull out my card and I got denied.
In case you missed it, on the opening trade.
Our revenue has now hit 30 billion in run rate, and we're seeing really significant demand customers like Spotify, Lovable, for example, that are really using and harnessing the power of the technology. 2 months ago, we had 500 customers that were spending over $1 million with us. That's doubled in size just in the last 2 months. So we're really seeing a lot of amazing growth.
Don't miss the opening trade, live every weekday.
Oh, hello there. Just wanted to say,
Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is.
Hundreds and hundreds of billions of dollars are at stake.
We're pushing the envelope of technology in multiple directions: software, hardware, chemistry, physics.
And yes, we will be talking about AI. Watch season 2 on all these lovely channels.
I think it's going to be very hard for the Fed to do anything right now.
The Fed is boxed in here.
The Fed is going to sit on the sidelines. The Fed is just content to hold where they are. On hold. On hold.
On hold.
On hold.
We're in a wait-and-see mode for the Fed.
Wait and see as long as possible.
There's a case for the next move is a rate cut, but it's really hard to say that should be happening right now.
You want to make sure that that door is slightly open.
It's unlikely that the data is going to be that clear moving forward.
I doubt that this Fed is going to be cutting into that. There's plenty of officials who are worried about, the stickiness of inflation.
We have not seen this kind of political angst around a transition of leadership.
Jay Powell will stay at the Federal Reserve for some period of time.
Powell is going to stay on for a period of some months as a regular governor.
What we're going to hear from Powell is uncertainty.
He wants to come out of today, I think, with no market move.
Priya Misra of JP Morgan at the end there. That decision 15 minutes away. The price action, the scores, they look like this. The S&P 500 doing virtually nothing. This looks like a snooze fest. We're down only 0.2%. It is anything but right now. Check out crude. Up for an 8th consecutive session, the longest daily winning streak going back to May 2022. Up by 7% this afternoon, approaching 120. And this move in the bond market. Check out the front end of the yield curve. Twos right now. 391, up 7 basis points on the session. Go back to the day when the Fed last met, March 18th. That morning, 368. That afternoon, 377. We're higher now than we were then.
The thing that's changed is the length of time that this has gone on. And now the question is this a Fed that can cut rates at all this year? Right now, we're seeing a 25% chance baked into the market.
I went back early this morning before you guys got in, and I looked at the 30-year bond yield, and above 5%, I think it was 22. It was 7 days. So you think that's funny, huh? 7 trading days, John. 7 days. And the real risk here, to our esteemed guests, is do we see a more persistent 5-year yield?
TK. Just for the record, I'm sat here from about 5 a.m. Eastern Time. Got Bramo here, and just behind Bramo, I can see the elevator that everyone coming down needs to go down. TK appears at about, I would say, 6:53.
Oh, yeah, okay. That's a little early.
6:53, and walks past the radio studio before even going into it. So.
Yeah,
just to set the stage for who gets here first in the morning. I'm getting more feedback now about you and I doing a tie swap than anything else.
I'm glad that's important stuff.
Joining us now to discuss, not that, more important things, Subhadra Rajappa of SocGen. Subhadra, welcome to the programme. What are you expecting to see in 13 minutes' time?
Hopefully no fireworks. I mean, I think that we'll be looking to see what the changes are to the statement. And at the press conference, I'll be listening to Powell and see if risks are a little bit more two-sided as opposed to, I would say for a good portion of this year, the expectation was that the Fed would deliver cuts later on this year. So, the price action in the bond market's been very, very interesting, as you've been talking about. I mean, 2-year yields are close to, 3.90, maybe headed towards 4%. But what's happening globally to global bond yields is even more interesting to me. So I think what might overshadow the Fed today is the ECB meeting tomorrow, and whether they sound hawkish and there's more potential for them to hike maybe 2 or 3 times this year.
Subhadra, before we get to tomorrow, there's a long road ahead of us, not only the Fed press conference, but also earnings in the United States. Do you think that anyone would care in markets if this Fed moved to a two-sided risk type of signaling, given the fact that the leadership at the top of the Fed is likely to change to someone who's going to be getting an earful from the White House?
And I think that that's really been the bias of the market, is that when Kevin Walsh becomes the chair, the Fed would sound somewhat dovish, and in fact potentially deliver a couple of cuts this year. But I mean, that is yet to be seen. I think that I still think that the bar for the Fed to hike rates is still relatively high, but we'll be looking for the nuance in the statement because it's still a committee decision ultimately. And if we do see a persistence of this conflict over a much more extended period of time than what the market's prepared for, and this actually leads to much higher realized inflation, then the Fed will definitely be in a very tight spot.
Bob Michael, what happens if we do get a persistent higher yield? To pick on the old benchmark to 30, if we get a persistent 5 or even 5.1% for more than 7 trading days?
I think then you have to start to think about what is the Fed going to do. And if the Fed is going to validate that move higher by switching first to a more symmetrical policy stance and then start building in rate hikes, perhaps at the end of this year or early next year, then yeah, you're going to see rates drift higher and stay there. But if they remain more balanced to the downside and thinking about this is transitory, we'll get through it, that will offer us a chance to bring rates down and the dots don't change in the June meeting, then I think you'll see rates start to settle back down.
Let's say they go with a more symmetrical reaction function. This is what I'm interested in from your perspective. You're in the market. Would you believe them or would you fade that move? Is that just a communication exercise or does that display any real intent?
I would 110% believe them. I think it's an enormous policy shift from where they've been over the last 9 months. I think they choose every word carefully. They would sit there and deliberate. They also know that at some point Jay Powell is going to leave. So do you change something that important right as Kevin Warsh is about to step in? So yeah, I would imagine that they're concerned about.
I have no doubt that the market would react to that move. But Subhadra, from your perspective, is it a move that you would fade? A move that you would take the other side of?
It'll be tempting to kind of look at that and say, you know what, maybe if 2-year yields start getting meaningfully above 4%, that might be a buying opportunity. I don't know if that's necessarily a fade. You do get a good, opportunity to be long the front end under those circumstances, because ultimately the expectation is that the bias of the committee will be somewhat dovish, and this could be a high yield to lock into. I think going back to the Fed stance, the U.S. is in a very good position overall, and we're energy independent. Yes, the higher oil prices are going to hit the consumer, but for the most part, I think the economy is in a very strong trajectory. So I just don't see any need for the Fed to really, change its bias or react in a meaningful way. So to me, that signals a buying opportunity in the front end.
Elisa, this is a central question to a key part of the yield curve right now. Does the 2-year have any business trading above where Fed funds is at the moment?
Ultimately, if this inflation does remain sticky and people can look through it, absolutely, because then you have to imagine that a rate hike is in the picture. And to your point about do you sell anything, do you not believe them? Well, sure. If everybody does that, then they don't get the tightening that they want, and then they got to go even harder. More. So it's it's sort of this is lots of fun.
It just feels like a communication exercise at the moment. Still feels like, from my perspective, listening to Fed officials right now, that the bar to actually hike is still extremely high. Now, maybe that changes with guidance, and you'd have to respect that guidance in the next 60 minutes. But certainly the way they've set things up with their own communication into this particular decision, it still feels like the bar is pretty high.
This is the reason why the dollar has underperformed places like Europe, even though you look at the U.S. economy and it's outperforming, because people believe that Europe will hike rates, and in the U.S. they won't, even at the expense potentially of inflation running a little bit higher for longer.
All of that can change in the next 10 minutes, the next 60 minutes, the next 90. Matt Lazzetti of Deutsche Bank joins us now for more. Matt, in your opinion, let's go through what you expect to see. Is this a Federal Reserve that's willing to drop its easing bias, given that crude is back close to 120?
Yeah, I mean, that is the central question for 10 minutes from now when we get the FOMC statement. I think that there's strong fundamental reasons that they should potentially adopt a more balanced language. The economy is looking pretty resilient. We got very strong CapEx data out this morning. Labor market looks more solid. Downside risks have been diminished. Inflation's at 3% on core PCE for the 5th or 6th straight year, and we think they're essentially at neutral. And so I think that there should be a discussion about a more balanced outlook. At the same time, I think strategically they are unlikely to adopt that in 10 minutes' time. In part, there's a lot of uncertainty. They don't want to change the communication language today, only have to unravel that at the June FOMC meeting. They probably don't gain much from going two-sided given market pricing at this point in time. And finally, just ahead of a turnover in Fed leadership, I think they might want to allow for Kevin Warsh to kind of give his view on what that communication should look like. And so I think fundamentally we should be having that conversation, but I'm not sure the Fed adopts it today.
Matt, what's the liability for this Fed if they don't adopt that kind of messaging, this sort of symmetric risk type of approach, given the fact that the market seems to be somewhat subdued on inflation expectations? If you look at the five-year forward break-evens, are there any signs that the market is pushing back on a Federal Reserve they perceive to be overly dovish if they maintain a cutting bias?
No, I think that's exactly the point, that they're at the moment, it doesn't look like they're at any meaningful risk of, if they don't send a materially hawkish signal, that inflation expectations will pick up materially, or that you might see financial conditions ease in a way that they might not like. I think that they're probably happy with where market pricing is for the Fed this year. Forward-looking measures of break-even inflation rates or inflation swaps are relatively subdued. So at the moment, it looks like a relatively low-cost choice for them to not adopt that language at this point, when there is the potential cost that, given the uncertainty that we have today, you have to undo that communications change at the June FOMC meeting. And I think that the Fed just likes to avoid those types of outcomes where they have to quickly flip on their own communications.
And Matt, speaking of forward-looking, what if the dots go away? How blind will you be at Deutsche Bank if Chairman Warsh does away with the dots?
Yeah, part of me would not mind seeing the dots go away. I think having to think about those in great detail every quarter as we look ahead. I think many Fed officials might agree with that as well. I think that there's times where they view the dots as constraining their potential reaction function in the near term. No doubt when you set the September dot, it does seem to back them into a corner a little bit for that December outcome. But I don't think they completely go away. I think more likely they change in a way that reduces their forward guidance signal. Potentially that they talk more about central tendencies, that they go on a rolling window. The dots stay, but their influence is reduced.
John, should we medicate Bob Michael? He seems like
he didn't seem too happy, did he? As soon as you were asking that question and Matt started to answer it, Bob Michael just shaking his head. Yeah. You disapprove?
Yeah. Matt Lizzetti, has a day in your career ever gone by where you haven't had to render opinion on the direction of rates? Have you gone 10 minutes into a conversation where somebody hasn't said, well, where do you think rates are going? I have about a dozen meetings a day, and everyone expects you to have a view on rates. Here is the body that sets the cornerstone for rates, and they're telling us they're not going to give any guidance because it's too difficult. Nonsense. I think they should do dots every meeting. They should put it out there. We're expected to have a view on rates. They're set the cost of money in the system. It's crazy that they're going to drop forward guidance. Okay, I've said my piece.
I agree with Bob there. But as somebody that has to identify each individual dot, I wouldn't mind if they reduce the emphasis on this a little bit. Completely agree with Bob. I think that there's some views that they might drop them completely. I do not think that happens. At the same time, I think that the Fed is overly worried about the precision around the dots and the focus on the median dot in an inappropriate way. And I think there are just some things that they can do to keep the broad guidance, but to downplay the precision of that forward guidance, perhaps by focusing on the central tendencies.
So Matt, just to weigh in, just tell us a little bit more. How's that going to change, do you anticipate? How should it change? Just show the median dot, not show the dispersion?
So I think when you look at the SEP when it was originally introduced, it did not have even the medians. It had the central tendencies and the ranges. And I think, that is probably an outcome that Kevin Warsh prefers, which is that, I think last week he noted that on inflation, he doesn't look at anything to the right of the decimal point. And so I think he wants to reduce the emphasis and the over-precision that you see within the Fed, forward guidance, which might be precise and can become counterproductive. And so I don't know that they lose all that much by doing away with the dot plot and the specific median that everybody focuses on, and simply to say, look, this is where we think the direction of travel is for rates over time. We're not going to tell you exactly exactly where we think rates are going to be, and we think people focus too much on the medians. But here is, broadly speaking, where we think rates could go over the next 2 years.
Bob Michael's not done, by the way. Forgive me for jumping in, Bob. Please carry on.
Go to a trim mean on the dots.
Okay.
There you go.
That's the direction
Get the trim mean and the high and the low of the trimming.
Matt, it's good to see you. Matt Lazzetti, alongside Sebastian Rajappa, counting down to this Fed decision. That Fed decision is about 90 seconds away.
I am there for all of the dot passion this morning or evening or wherever we are right now. All I can say is this is definitely a clear thing that we can analyze and discuss, which at least is positive for us. So for us, it's fodder, as well as for analysts who also can point to that.
Quickly to Bob Michael's point, Robert Kaplan, ex-Dallas at Goldman Sachs, was brilliant on this today, taking the victory lap for Dallas on trim mean. But the research out of Kansas City, and particularly out of Cleveland, on what do you do with inflation to take out the excesses, and then that wandered down to Dallas, and that's what Powell and Michael are talking about, the importance of that trim mean.
It reminds me of that hearing with Kevin Walsh in the last week or so, and I think this will be an important question in the news conference later on this afternoon. Inflation's a choice. That was a pretty powerful statement from an incoming Fed chair. Inflation is a choice, and I wonder how the current Fed chair might respond to a question on that later on.
Well, are you saying we choose the inflation to be high, or are you saying we're choosing which metric to look at to decide about inflation? Because those are two different things.
I thought what King Charles said in his speech yesterday about inflation was really poignant.
You really love the Royals,
I'm sure you hung on every minute.
You really love the Royals, don't you?
I do.
Yeah.
I thought it was really quick.
We're not talking about King Charles in this program.
He mentioned inflation.
This is a royal-free zone, okay?
Sort of.
Let's turn to the price action. Got a king around the table, don't we? Okay, decision, seconds away. Equities negative by 0.1% on the S&P 500. Bond yields elevated, crude elevated. Mike McKee has your decision.
No change in rates, but we have four dissents. Lori Logan, Beth Hammock, Neil Kashkari agreed rates should stay on hold, but they did not support including an easing bias in the statement at this time. Stephen Myron wanted a quarter-point cut. The last time there were four dissents, October 6th of 1992. As for that easing bias, the statement still contains the phrase, in considering the extent and timing of additional adjustments to the target range, a line meant to suggest that the easing cycle has not necessarily ended. The Iran war figures prominently in the economic overview. Inflation is elevated, in part reflecting the recent increase in global energy prices, the statement says. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook. The committee remains attentive to the risks on both sides of its dual mandate, it says, even though recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained low on average, the statement says, and the unemployment rate has been little changed in recent months. The dissents open up a whole new line of questioning for Chair Powell. Four dissents would ordinarily be a sign of discontent with the chair. Since this is likely Powell's last meeting as the chair, it may not be anything more than expressions of concern about the toll of the war. At each meeting this year, the number of open market committee members who have worried they might have to raise rates has increased. We shall see when we get a chance to talk to the chairman.
Mike McKee, stay close. I just want to run through the price action. I've got a big question to come back at you with in just a moment. Equities have stayed slightly lower, no drama here, down by 0.2%. Into this decision, yields were already elevated, particularly at the front end of the curve. They stay somewhat elevated, up 7 basis points at 390. This isn't the kind of decision that moves around crude. Crude is still higher by 6 to 7%, 118 on Brent. Mike McKee, I just wonder, coming into this decision, we were talking about the possibility, the potential that the Federal Reserve introduced some symmetrical reaction function. But looking at that kind of dissent, I wonder if the dissent alone has achieved the same thing, just by introducing some two-way risk, given the level of dissent you can see in this afternoon's decision.
That's a very good point, because, of course, if Powell leaves the Fed, that's one less vote that we know would be on the easing side at this point. We're going to have to wait for the minutes unless the chairman wants to give us a number, which I doubt he will, of people who think that they should be at least suggesting the idea of raising rates in the future. But it's obviously grown since the last time, and feelings have grown more certain, at least among those who think that two-way warning should be included in the statement. It's very, very unusual. Obviously, it has been almost 30 years since we've seen anything like this, and it is definitely a sign that the Fed is split over this question. And one would think that if these people were willing to dissent because they wanted a two-way warning, because they did not want an easing bias in the statement, that they probably would have voted for a rate increase had that been on the table.
Mike McKee, appreciate your time. You get in the news conference. Looking forward to your line of questioning a little bit later. That news conference 27 minutes away. We have an 8-4 vote at the Federal Reserve. That's some level of dissent.
Yeah, and didn't Mike just say that that was the first time we've seen that since October 6, 1992? This is unusual. To me, this really highlights the committee aspect of this and the fact that Fed Chair Jay Powell, for all of the jawboning from the president, sits on the more dovish end of this. And I think that that's very notable. So how does he message this, given that A, he probably doesn't matter as much, but B, how does he signal that this isn't necessarily a sign of dysfunction ahead of a new Fed chair coming in, but rather how difficult this moment really is?
The expert on this is John Farrell, is the gentleman from the United Kingdom, where dissent is far more evident. There were 2 moments of 4 dissents in the 89-92 period, and the distinction here, John, is those dissents were to ease, to let up as Greenspan was stricter, and this is radically and historically different.
So I remember a level of dissent, a degree of dissent back at the Bank of England coming out of the financial crisis.
They basically told Mervyn King what to do, right?
He wanted more QE. Yeah. And I remember the governor being voted down on countless occasions. On this occasion, I'm looking at this level of dissent, and I just wonder if the chairman would welcome it. I think it's probably a good thing right now that there is no groupthink, that we're in a situation at the moment that deserves some kind of debate about where policy should be and where's it going and what kind of risks we face in the economy right now. I actually also think that that's the kind of committee that Kevin Walsh should want to inherit. Groupthink has been a problem at this institution for the last 5 years. I wouldn't look at that as a committee that's voted down the chairman in quite the same way that the committee voted down the governor at the Bank of England a number of years ago. This feels somewhat different. And if you want to move to some kind of symmetrical reaction function at the Federal Reserve, based on that vote, I don't think you need it in the statement. I think the dissent already speaks to it.
Which I think is why I'm noting the increase in the dollar more than anything in bond yields. You're seeing a strengthening in the dollar versus the euro, and that, I think, gives you a sense, maybe at least of the Fed independence question and the fact that this truly is a committee.
But to get out front of the pundits, is this the committee in dissent that President Trump wants?
That's a different question.
Yeah.
This president clearly wants lower interest rates, TK. And the kind of thing that we've just seen voted for right now is not for lower interest rates. You've got a committee that's worried about the prospect of a market thinking they'll always get interest rate cuts, that they don't have to worry about inflation. First and foremost, the first rule for any central banker, any real central banker, anchor inflation expectations. This is part of that exercise.
Yeah, as Neil Dutta put it, he messaged, it's clear that Warsh has his work cut out for him. Good luck convincing some of these folks that it's time to cut rates and potentially overhaul the whole system.
Different question entirely. Bob Michael with us around the table from JP Morgan Asset Management. Bob, your early reflections on this decision?
Yeah, clearly it's in the dissents. Clearly they're moving more towards a symmetrical policy. It's confirmed in the first paragraph where they characterize inflation previously as remained somewhat elevated. They removed the somewhat, and it's just elevated. So they're telling us they are increasingly concerned about the level of prices, the level of oil, and the potential pass-through to the system. I think you're right. I think this is less a message about Jay Powell and more a message to the incoming Fed chair that, hey, we could be dissenting. Get prepared for that. I think he may welcome that.
TK asked the question about the president, what the president would like. This is another exercise. It's quite important. Everyone's been worried about the future of the Federal Reserve, central bank independence, will the chairman stay on? That degree of dissent makes the life of, I think, Chairman Powell easier to walk away from this institution. There's no capture of this institution. This institution is still independent. Inflation expectations are still anchored, and that is not dependent on Fed Chair Jay Powell staying on as a governor on this board for the next 2 years.
I see what you did there. So maybe they agreed. 4 people dissent, although one of them is perhaps in a different direction.
I'm not suggesting this was choreographed.
And then opening the door to Jerome Powell coming out and saying, I'm gone. Good luck for you. Go ahead, Kevin
I'm
Warsh.
not suggesting there was any choreography here, just that there are some benefits to that level of dissent. Stephanie Roth of Wolf Research has been going through the statement and reacting to all of this and looking at the price action. Stephanie, your early take, please.
Yeah, I mean, I think, one, it tells us that the committee is certainly divided, and they're not going to be a committee that's willing to just cut rates because Warsh wants them to do so. And it's also interesting because in the in the hearing last week, Warsh noted that he wants debate in the room, but he wants a more unified statement, and that's certainly not what we got today. So the odds of cuts later this year certainly should go down on the back of what we're seeing today. It's just a committee that certainly doesn't even want to have an easing bias, let alone easing in the near term.
Stephanie, does it surprise you that more members of the Federal Reserve didn't get on board with moving to a more symmetrical type of approach?
A little bit. I mean, certainly it sounds like it was a fairly divided group, and perhaps there were others that were even more on the fence that didn't officially dissent. This was a big question for the meeting today. There was actually two big questions. One was, were they going to maintain the easing bias in the statement? And many thought that they would actually remove it. So that was, perhaps a bit of a surprise to some extent. And then, of course, the other question is, how is Powell going to answer the questions about what his plans are once Warsh is actually confirmed?
Bob Michael, what is our overall stimulus right now? I know we had timing for tax season where everybody got a check in the mail and all that, but is all of this discussion about an historic post-COVID stimulus that is starting to make the wheels come off the wagon?
Yeah, well, when I was listening to Matt and Subhadra earlier, going into this, I was thinking the Fed would be nuts not to move to a symmetrical posture because we know we have higher prices. And what I heard from them is the economy's doing just fine. They're right. You've got the stimulus from the One Big Beautiful Bill Act. That's not finished. We know there's a tremendous amount of CapEx. When I talk to our clients, they're just getting started on the AI journey. There's a lot more spending to come. And we also know there's a lot of money sloshing around the system. You look at any measure of money, M2, right, deposits, money market funds, they're still going vertical.
Can I do an audible?
Yeah, you're about to.
We're about to do an audible here to get to 4 p.m. and 4:15 p.m. You're the bond pro. What's the so what of $30 billion from one of these Mag 7s? They're going to put the money out. They're going to call Bob Michael. It's all going to go to JP Morgan. And when they do that, what does it mean for the dynamics of their balance sheet? What does it mean for the dynamics of the American fixed income market?
Well, the guys reporting today, if they were to issue $30 billion, you'd hardly notice it. That's how big they are. That's how little leverage they've carried. And in our conversations with a lot of big borrowers, we want to know, do they see the demand? These guys have the demand, they'll show you the demand, and they can't monetize it until they put in place the capacity. So there is a big bill to go. And I think these guys are right to borrow and get that bill going.
Can I sell you some twos at 393, up 10 basis points off the back of this?
You asked me, what if the Fed did this? And we never really thought they were going to do this. It's a very artistic way to do it. Nope, I wouldn't touch it
To that
here.
point, to that framing, that's really important. Haven't they achieved the same thing? You don't need it in the statement. Yeah. Haven't the dissents achieved the same thing?
Well, it's kind of in the statement. It's the last line of the statement. And you talked about, was this choreographed or not? I absolutely think it was. Every single word in the statement is choreographed. They sit there and they debate it. I think this very nicely opens the door for Jay to peacefully depart from the Fed.
So this is their sort of offering to him, their farewell gift to him is here you go, and that ultimately we're going to give Kevin Warsh a hard time?
Okay, I didn't say that. I think what they're indicating is we recognize inflation's a problem. We're not going to sit there and keep advocating for more monetary ease. We're going to be more balanced. Don't worry about the independence of the Fed, Jay. Go off into retirement.
You said you wouldn't buy it. Why wouldn't you buy it?
Because I think the Fed has flipped the tables on the markets right now. And
what does that mean?
I think they've now shifted to something, it's not outright hawkish, but it's more hawkish than where they've been. And then you step back and go, there is still stimulus out there. And we're in the middle of the Middle East conflict. Those things have yet to be settled. Let's just get out of the way of this and see where the market
Okay, so let's build on that. Let's extend the conversation a little bit more. 10s are at 441 right now. What kind of numbers are you thinking about?
Well, we're breaking through to new highs. I don't think you get to 5%, but do you get to something like 4 5/8? Probably. then I'd get interested. Then you're putting a percent on the Fed funds rate. Right. And I think it's one thing to switch to a symmetrical bias. It's another thing to actually come in and start hiking rates. And I did say I don't expect any changes in rates this year. That's cuts or hikes.
John, 5/8 is how we used to quote paper. We'll do 30 seconds in the next hour.
I'm aware. 10's right now at 441. With this move at the front end of the curve, as I mentioned, up 10 basis points. 394, let's call it 393. Equity's starting to break down just a little bit. Don't want to make too much of this. We're down by 0.3% on the S&P 500. You will notice, Bramwell, the underperformance in the Russell down by 1% plus.
These are the companies that are most vulnerable to rates going higher. I really am struck by what Bob's talking about, because this is a market shift. And really it does highlight how much this war has changed the dynamic fundamentally for people who believed that rates would just gradually go lower. And if they don't, how much does that change some of the expectations about the equal weight market, which we've seen being baked in, and frankly about the broadening out trade? And adding to that, how much steam can there be behind some of the tech trades that are somewhat dependent on some of the consumer aspects? I'm thinking, for example, Meta advertising, or Amazon, your cleaning supplies, your children's costumes, whatever.
Children's costumes?
I end up buying a lot of those.
Okay, what, ahead of Halloween? Just getting the discount in?
Also senior parties.
Okay, all right. Important stuff. Hey, Stephanie, good to hear from you this afternoon. Thanks for your time. Stephanie Roth there of Wolf Research. To talk about the equity market, Kate Moore of Citi joins us now for more. Kate, yields are starting to move higher. Getting a squeeze over in crude. Brent out to close to 120. Equities somewhat softer, but not really looking at this as a dramatic event. How would you frame things?
Yeah, I don't think today's event with the Fed is the big event for equities right now. This is also like a massive lollapalooza when it comes to earnings this week, which you know, Jonathan, quite well. And I think the equity market attention is much more there. And so far, everything that we got yesterday, expectations for after the close today and tomorrow, are for actually quite strong numbers, reiterating not just the AI tech story, but also actually a very solid U.S. consumer. So I think that is really where kind of equity risk is focused right now, less so on this, what I would argue is also a very interesting set of dissents in the FOMC.
Kate, that said, is there a level or is there some sort of rate of change that gets you concerned as an equity investor about what's going on in the bond market should this Fed suddenly move to put rate hikes squarely on the table?
It seems unlikely, in our view, that the Fed is going to put rate hikes on the table, Lisa. I would say that is not in our kind of any of our distribution for the back half of this year. Stability, even as inflation is warm, and even as the Fed is going to wait and see and more dissent happens across the FOMC. But we, of course, will watch what happens, because the relationship between equities and bonds has broken down a number of times over the last couple of years. The correlations are not exactly what they had been historically, and bonds have not been the safe haven asset that some people had become used to in their early days of asset allocation. So across our multi-asset portfolios, we've been more tactical. We've continued to be short duration. I heard Bob a moment ago say he wouldn't be buying 2 years at this point. I tend to agree with that. And we tend to like to take most of our risk on the equity side and think about other diversifiers outside of the fixed income space.
Okay, I look at where we are in the market, and John, I brought this up today because, frankly, I have misplaced this. The Dow up 20% 1 year trailing. SPX up 28% 1 year trailing. All in NASDAQ up 41% 1 year trailing. Kate is completely separated from the nation's angst. What do you see as an indication that that keeps going, and how can the Fed assist with that?
Yeah, Tom, one of the things we've been focusing on, and something our investment committee was talking about earlier today, is the massive dispersion in terms of sectoral earnings, not just this quarter, but through the balance of 2026. And this is also kind of what we're seeing in the overall economy. We've gotten tired, I think, of talking about the K-shaped consumer, because even the bottom part of the K seems to be holding up relatively well with decent real wages. But there is a huge amount of dispersion below the surface in the equity market fundamentals and in the macro fundamentals. And that can make people uncomfortable. But unfortunately, what's really driving the market higher has been extremely strong earnings and expected free cash flow from the largest parts of the market cap. And we continue to stay kind of anchored to the equity risk and loving U.S. large caps, even as we recognize it is going to be a very uneven experience and perhaps a better opportunity for some more active management as we go through this year.
Unfortunately, part of the dance right now, monitoring equity markets, bond markets and commodity markets, more importantly, is following these headlines regarding the Middle East. And we've got more from the president. This time, some comments on the Russian leader, Vladimir Putin. They've had a conversation. The Russian leader said he'd like to help with the Iranian enrichment. There has been some suspicion for a while that maybe that enriched uranium would be moved to a third party, and perhaps that would be Russia. And some headlines, I have to say, looking at this, that alludes to that, Lisa, at least this afternoon. Now, as we've said on countless occasions over the last 2 months, one headline that speaks to one story will last about 5 minutes and things can quickly change. All I can do with you is share with you the current headlines, and they're the headlines that dropped just moments ago.
Yeah, and they include the idea of potentially having a ceasefire with Ukraine and Russia, and then uranium moving from Iran over to Russia. I mean, a lot of things that are a lot of questions. What you do with this, I think people have shrugged it off and moved on because they don't know what to do with it because it's just a headline. So they look at things like, oh, the placating idea of rates going down. You start removing some of these pillars. That's when suddenly some of the angst starts to percolate up a little bit more.
Initially, I think this market took comfort from the intent. They commit to de-escalation, the commitment to de-escalation, and not returning to hostilities. But the fact of the matter is that over this entire period, crude's not been moving, energy's not been flowing sufficiently, and every day over the last 8 sessions, crude keeps grinding higher. What's intriguing about this, every time we get a bit of hopium, some headlines, some reports here, there, and everywhere, crude has really stopped responding to it in the same way. Yeah. Brent is still elevated here, TK, at 118 and up on the session by 6%.
I really agree with that. You see the angst in Southeast Asia and other selected geographies, and it's way more tangible than anything we have. The sum of this is real GDP and the inflation piled on top of it. Kate Moore, if you're still with us, I'm absolutely fascinated how you feel nominal GDP will affect our listeners and viewers. It's still going to be buoyant, I guess, but it's a different nominal GDP, isn't it?
Yeah, it is. And look, I think some of this, Tom, is getting reflected in the consumer confidence data and the surveys that have come out where consumers are talking about their discomfort. It's not just high gasoline prices. Maybe it's they don't like the direction of the country. They don't feel as confident as they have in the past. Yet the thing that I keep anchoring on is actually what's happening in their behavior. And we've been looking at all this high-frequency consumer data, whether it's around dining outside the home or traveling and spending. And we got some good reports from a couple early consumer companies this quarter. And all of it is showing that despite all these negative surveys, people feeling uncomfortable with the path of the economy, that they're continuing to operate more BAU. So, Tom, this is a little bit of a friction I think we have, which is maybe we don't get a massive acceleration that benefits all parts of the economy, but as long as both the consumer and the AI tech space continue to fire, you know, we feel like you can't be on the sidelines for risk assets.
Hey, Kate, it's good to see you. It's great to catch up as always. Kate Moore there of Citi, breaking down this equity market and reflecting on this decision from the Federal Reserve about 20 minutes ago. If you're just tuning in, welcome to the programme. In about 10 minutes' time, we'll hear from the Chairman of the Federal Reserve, Chairman Jay Powell, in what could be, should be, his final meeting at the Federal Reserve. Just moments ago, 20 minutes ago, we had a decision from the Federal Reserve to leave interest rates unchanged. What stood out was the degree of dissent, 8-4. 8-4, and that 8-4 vote marking the first time since October 1992 that 4 officials have dissented against an FOMC decision. So something we haven't seen in a number of decades. All of this in anticipation of earnings after the closing bell from some of the biggest companies on the planet, including Microsoft, Amazon, Meta, Alphabet, all of that still to come, which has supported the NASDAQ. The NASDAQ is still positive by 0.25%. But if you want to look at the small caps right now, the Russell down by 1%, allow me to give you the why. This move at the front end of the yield curve on a 2-year, up 9 basis points to 393 off the back of this move in the commodity market. Lisa, Brent crude 118 and up 6%.
Fed funds futures have now priced out completely any rate cuts this year. We are now pricing out interest rate cuts by the Federal Reserve for 2026. Whether we shift shift to people starting to price in rate hikes like we did a couple of weeks ago? That remains to be seen. It also is unclear exactly how much the press conference can really do to that. It will be political intrigue and drama with Jerome Powell's future. Nonetheless, this market is moving. It's responding. And the idea that the strength in the U.S. economy can continue is the reason why this is viewed as more inflationary right now than maybe disinflation or outright deflationary later on.
The cross-asset moves are particularly spectacular. We've gone back to where we were about a month ago. About a month ago, when the equity market was about 13 percentage points south of where it is right now in the S&P 500, yields are back through the highs. On some maturities, I'm looking more at the long end of the curve, the long bond on 30s. And crude has made new highs as well. And what's more important, I think, away from the front month of the futures curve, is what's happening on longer dated prices as well. You've talked about this throughout the week on Bloomberg Surveillance, Bramo, where December's trading, where the latter months are, the back end of the futures curve, that's making new highs as well. This is a market that's pricing high for longer, not just for interest rates, but for energy as well.
Yeah, and that's why we always have been talking about boiling the frog, because it's getting hotter and hotter and hotter. And at what point do capital markets start to slow down as a result of benchmark rates going higher and inflationary pressures being there?
This has been the exercise for us now for the best part of 2 months. Energy shock, rate shock. What does it mean for growth? But that's the question I think is still an open-ended question, really. We've seen it in commodities. We've seen it in energy. And I'm asking this question with America in mind. Before we get to the international backdrop where it's much harder, what does it mean for US growth, if anything at all?
Well, I think we have to acknowledge that the three dissents weren't in favor of hikes. They were in favor of a more symmetrical policy, which leaves 3/4 of the Fed still biased towards ease. So let's accept that. That said, the bar to hikes just got lowered a notch. What does it mean for growth? It means that unless the economy can absorb higher prices from energy and higher cost of funding from where rates are, then you're going to see a real slowdown.
At what point do higher yields start to crimp the capital markets activity? I'm talking about all the bond sales. I'm talking about beyond that, mergers and acquisitions that have been absolutely flying recently.
I don't think we're there yet. I think really you'd have to get the 10-year above 5% to create any kind of damage. And let's also remember that most of corporate America finances itself with floating rate. We should know that from private credit and direct lending now. So unless the Fed is going to start hiking rates, which we're not calling for this year, then the cost of funding for most of corporate America is going to remain roughly the same.
Is the Fed doing policy for the haves? It's just as simple as that. The dichotomy here between the haves and the have-nots, we witness the tension of 4 cents. How does the new chairman address the have-nots, the people flat on their back?
I don't think it's a question of have or have-nots, and I think you go back to the 2022 experience. I think they're scarred from that. They were late to react. Inflation was painful, and it hit all levels of the economy, both the haves and the have-nots. And I think they are genuinely, as a body, trying to get their arms around that. And there are a group of people who are courageous enough to step forward and do something different than what's been done in the past.
What will the next meeting look like for you? If you guess right now what the next meeting will look like.
I think there will be a lot more two-way debate on whether they should be hiking rates.
Right.
Will they have to cut rates down the road, or will they remain
Larry
neutral?
Meyer wrote that monograph years ago about Alan Greenspan, and there was some real back and forth going on way back. Is that what we're up for now? Is a Lawrence Meyer, Alan Greenspan Fed with Chairman Warsh?
It probably doesn't feel like the Middle East is in the rearview mirror, or will be 6 weeks from now.
I've got a personnel question. When they next meet, should be Chairman Warsh. Is Powell there or not?
I don't think he will be.
You think he steps away?
I think the Fed is in good hands with Warsh. I think you've had a group of people say, don't worry, we're still independent. And I think you've just got to pass the reins on and let somebody else try things that may be a little bit more innovative, a little bit different from what you've done.
Is there a market liability if he doesn't do that? Is there a market reaction?
I don't think so. I think there will be a lot of concern that it's too much of a political decision. I think the door is wide open to exit gracefully.
John, June 17th. I guess I got to cancel my plans. I was supposed to be in Cheltenham. but instead June 17th, I'll be here.
Two things. One, Cheltenham. And two, for the record, I won't be here. I will be away. I won't be at Cheltenham, though. So
You'll be at Cheltenham?
I'll be missing that one. Does this make the life of Kevin Walsh just that little bit easier? Entering the Federal Reserve, this might sound somewhat counterintuitive, but entering the Federal Reserve under a little bit of a dark cloud, where some people are concerned, particularly the Fed watchers, about the future of this institution and central bank independence. I think not only have these dissenters done Chairman Powell a favour, I do think they've done Kevin Walsh a favour as well. Yes, he doesn't want this playing out in public, but one of the criticisms of this institution, particularly under Chairman Powell, is the groupthink. I think it's refreshing to see the dissent. We've been asking for it for ages. You can't complain about it once you've got it.
Not only that, but arguably the inner Kevin Walsh is a hawk, is somebody who wants to say inflation is a choice. He didn't mention employment once. We didn't talk about the labor market in those hearings. He wasn't talking about the average American flat on their back. He talked about inflation and how important it was to the credibility of the Fed to get it under control. So what's the risk that he comes in and is actually incredibly hawkish and joins those three other dissenters in case of a more symmetric risk? What does the market do with that?
This is the secret sauce of central bank independence. If you want to make it easier to cut rates, convince the market you're willing to hike. And we have gone some way through that exercise this afternoon with this degree of dissent.
What's interesting is what Bob said, is that levels here are not going to necessarily hijack any of the capital markets activity. It's not going to slow the M&A. It's not going to slow the huge tech trade that's really been the ballast to this market. So what exactly is it going to do to actually slow the economy and actually achieve what the Fed is looking to do?
Bob Michael, in just about 90 seconds' time, the chairman of the Federal Reserve, Jay Powell, walks into that room and steps up behind that podium for probably, likely, the final time. Just a reflection on this man and his tenure at this institution.
I think he was dealt some shockingly difficult circumstances, and I think he did his best to navigate through them. We did get through COVID. We got through the regional banking crisis. We've gotten through different rounds of tariffs, and we're looking at an economy that's actually doing pretty well considering. I think he's done a really good job. And Walsh isn't an outsider. He's an insider. He was at the Fed before. He'll do a good job.
Bob Michael, appreciate your time, sir. Thank you. Bob Michael there of JP Morgan Asset Management. In just a moment, the chairman of the Federal Reserve, Jay Powell, stepping through that door, stepping behind that podium for most likely the final time, following this decision at the Federal Reserve to keep interest rates unchanged, with an 8-4 vote on the FOMC, something we haven't seen since the 1990s, as we get some dissent pushing for a Federal Reserve to articulate a more symmetrical reaction function. Ultimately, that view was voted down. How this Federal Reserve is set up for Kevin Walsh, what kind of FOMC he's inheriting, is going to be an important part of the discussion that we have over the next 60 minutes in this news conference. And also, the future of this chairman, not as the chairman, but as a governor of the board. He has the option to stay there until 2028. Will he take that option? Will we find out in this news conference? The last time we heard from the chairman of the Federal Reserve, he wanted that DOJ investigation into this institution wrapped up with transparency 1 and finality 2. Have we met his bar based on what we've heard in the last week?
And has anything that the Fed did in terms of the committee and the dissents there given him a green light to take this exit stage and go off to golf and give speeches, et cetera? Ultimately, what he says here will be more for the political aspect than it will necessarily for the path ahead for the Federal Reserve, because ultimately that job has been done. The committee is no longer a committee of 1. It is a committee of 12, and they are asserting the power of disagreement. That, I think, does make it somewhat easier for him to come out and have his swan song.
This is how the stage is set going into this news conference. The scores look like this. Equities on the S&P 500, negative by just 1/3% on the S&P. On the Russell, the small caps down by about 1%. The move in the small caps driven by this move in the bond market on 2s, 10s and 30s, elevated at the front end of the curve. A move on the 2-year of some 10 basis points. Call it 8 or 9 right now at 392. That's the move in fixed income off the back of this big move in crude. 8 consecutive days of gains for Brent crude, the longest daily winning streak we've seen for Brent going back to 2022 and May of that year. For the final time, your chairman of the Federal Reserve, Jay Powell, steps up to the podium. Let's take a listen.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months. Inflation has moved up and is elevated, in part reflecting the recent increase in global energy prices. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand at a brisk pace. In contrast, activity in the housing sector has remained weak. In the labor market, the unemployment rate was 4.3% in March and has changed little in recent months. Job gains have remained low. A good part of the slowing in the pace of the job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. Inflation has moved up recently and is elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March, boosted by the significant rise in global oil prices that has resulted from the conflict in the Middle East. Excluding the volatile food and energy categories, core PCE prices rose 3.2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. Near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor the risks to both sides of our dual mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a financial system they can depend on. Every decision we make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well. As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come from the podium in different places, but appreciate that. Can you talk about what is gone into your decision to remain on the board? What kind of criteria are you weighing, and how long might you stay? Thank you.
Sure. So, my concern is really about the series of legal attacks on the Fed, which threaten our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected officials. I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors. It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. That piece of institutional architecture separates successful countries from unsuccessful countries. It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve, that the Fed remain able to conduct monetary policy in a way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was that?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
I don't see that at all. As I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have, I think, left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is, and as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Nick.
Chair Powell, if I could ask about the inflation outlook. In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase and that would go away over time. In other words, that there would be no further change, so measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert, and monetary policy works with long and variable lags, so you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock. So I think we're going to be very cautious about that. But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet, and I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or two ago? And what more would have to happen for it to get evicted?
So that was, as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate, and that kind of thing. And I would say that the number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut, that number has increased over the intermeeting period, and it's easy to see why. I mean, it's a good question, right? You see, inflation has moved up over the interim a bit. Core inflation is 3.2 now, moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that and we'd have a vigorous discussion about that. You saw that 3 people dissented over the language. I think all of those people agreed with the rate decision. So the majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? We have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now, because what happens in the next 30, 60 days, even by the next meeting, could really change the picture around that language. So, it's a much closer thing on the committee than it was in March, and that makes all the sense in the world, it seems to me.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias, we've now got oil approaching $120 a barrel when it comes to the benchmark Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
I wouldn't want to guess. Well, first of all, we're going to have new leadership in all likelihood by then, and new leadership's going to have a very important role to play in that. So I won't be standing here at this podium to answer your question. So I don't know. As I mentioned, that's all I can really say is that we had a great discussion about that today. It's gotten to be a better question in the interim period. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and that's where I am. I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
Thank you. Just to follow on, the new leadership also seemed rather lukewarm on press conferences and on the dot plots. What would your advice to him be on these communication tools?
So I'm not going to give him any advice through you today here, but I think communications generally is, I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you can always be looking at new things, and if that happens, it feels like it's going to happen. That's a completely appropriate thing.
Neil. Hi, Chair Powell, Neil Irwin with Axios. Can you tell us if you've been in touch with incoming Chairman Warsh? To what extent is this a normal transition process versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. The last process was with Janet Yellen, with whom I had worked for 6 years, and so it was, we were sitting down the hall from each other, so it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up: is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Chris.
Hi, thanks for taking our question. I wanted to ask a question about your tenure, and Chris Rugaber at Associated Press. During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market, and should they be?
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that the biggest wage gains were going to people at the bottom end of the income spectrum. And we had many reports of, it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were, setting up in people who were confined and like training them before they got out, and it was a very healthy sort of set of societal dynamics. So of course, I think anybody would love to get back to that. I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock that happened essentially very similarly all over the world that had to do with closing, reopening, stimulus, and all that. And I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So I don't think that insight was in any way responsible for the high inflation that we experienced. So, I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates, and we for example, now we don't feel that the labor market is at all a source of inflation, so we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
And just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for, or what else?
I'm waiting, for the investigation to be well and truly over with finality and transparency, and I'm waiting for that, and I will leave when I think it's appropriate to do so.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. I'd like to ask you if you could explain a little more or characterize a little more the discussion about the two-sided view and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because inflation was not coming down fast enough. Is there any sense that interest rates might have to go up, or was this just a setup to sort of warn people that you're worried about the war impacts?
So nobody, the three dissenters and others who could have supported that, and others who were, who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but these changes, it's a form of forward guidance, and you don't want to make them in a way that will be sustained and continue to make sense, and not something you need to take back, fairly quickly. So I think we just a group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument, too, as I mentioned. It's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got three dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by, 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking, and be able to pull them together and get consensus and move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be very good at that, I would think. So I think I'm not so worried about that process. I think that'll work itself out.
Thank you, Chair Powell. Howard Schneider with Reuters. You mentioned that staying on as the governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can... Touché. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention and not be a shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do. The shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but I was brand new at that time, so I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus. And I always felt like I don't want to add to that unnecessarily, and that means try to support the chairs where the direction the chair wants to go in, if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be, they won't, if they're not flexible at all, then how do you ever do that? And so that's why the authority the chair has really is to develop relationships with people and work with them, and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, how do you see the risks of oil prices bleeding into core inflation in coming weeks? Because that was, it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, they were elevated concerns about the bleed into core. And, here we are with 3 dissents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, and they're real, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet, and it's so unknowable because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know until we know. So fortunately, we're in a good place to wait and let things develop.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with with SEPs. Can you talk about why you see that as a net positive?
So we always said when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, during the pandemic, we were moving like a lot at every meeting and sometimes between meetings. And doing that without a press conference, I think, would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to. And I do think it's quite helpful to I try to deliver a message on behalf of the committee rather than 18 other people going out and delivering their message, and it's going to be all over the place because we do, thankfully, have widely disparate views.
Okay, thanks. The other thing I wanted to ask about was the communications review from last year. Could you describe the debate last year, what changes were considered, what you wanted, and what prevented any action on those changes?
So I'm not going to go into the real small specifics, but what we found very quickly was that making really large changes, for example, to the dot plot or the SEP, we couldn't come up with anything that had really broad support on the committee. And so we just moved on. We didn't really do as much on that as we might have. And I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And we've looked at a bunch of things, and it's something. Like I said, I think every new chair is going to look at our suite of communications, and think about what would be changes. We are the only major central bank that doesn't publish a forecast, and that's because we have a 19-person committee, and you try to do that at the board. That's hard. At the committee, that's hard. It's hard if you do it at the staff. So it works. I think our communications are fine, but looking at doing it in a different and better way is the most natural thing in the world.
Thank you. Colby Smith with the New York Times. If I could follow up on Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts? And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive at all right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower. Inflation was moving sideways even before the war and is now moving higher. So where is the committee at on that debate?
Where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now. So it really is going to depend on how things evolve, and that's really where it is. And as I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You just have to find that out empirically. Given our the fact that we're a big exporter of energy, and that our economy is far less energy intensive, oil intensive than it was during the 70s. The effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares I've mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
The neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it between 3% and 4%. We're a little north of 3.5%. So that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. I think the labor market is still probably cooling off just a little bit, and I don't think there's much of a case for any case really for policy looking meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992. Are you handing off a divided Fed?
The thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good. And we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? The central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough, difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. People are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. And I think it's partly a function of the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Thank you so much, Chair Powell. Selena Wayne with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view, does that take a rate cut off of the table? And secondly, by staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year. And it will depend on how long the strait remains closed and how quickly it can be reopened and that kind of thing. But remember, when gas prices go up, that's disposable income coming out of people's pockets, so they're going to spend less on other things. So there will be a hit to GDP. So it's a question whether spending goes down to offset the inflationary effects. So it's not the answer isn't obvious ex ante whether you should move your rate over because of that. We'll have to see how it evolves.
And the message it sends to President Trump by staying on?
I'll stand on what I said earlier.
Victoria.
Hi, Victoria Guido with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law. But it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to continue to respect those boundaries about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal. In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks, that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy, so we've resisted that.
Well, and maybe another way of asking it, too, is do you think that Fed independence is as strong now as when you became chair, and if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. That's what we're talking about, and we've had to do that, and we've been successful so far. But that's not over. None of that is concluded yet, and it's really important. It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it. And I'd like to think that we can get out of that era and go back to respecting, what the law says and what custom has been, which is to, let the Fed do our thing. It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human. Don't expect for perfection, but do expect us to make, decisions without political considerations and the very best analysis we can bring.
Katerina Saraiva, Bloomberg News. How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch? Is this something that others have, talked to you about?
So I think that I don't want to report on what my colleagues think. They can speak for themselves. But there are widespread concerns that these things may continue. That's all I'll say. And and that would be a problem. And so.
And then I just also wanted to ask about Governor Waller's speech on the reserve banks. Do you have any thoughts on centralizing some of those functions in the way he described? And then are you concerned that something like that could potentially be a slippery slope to, to consolidate reserve bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient, and Chris Waller is particularly passionate about that. Of course, so are the reserves, so are the presidents, and it's a question of how do you accomplish it. We of course, and Chris said this in his speech, we want 12 strong independent central banks with their own staffs and their own monetary policy views and all that. But there are things that are done in all 12 which could well be done at one much more efficiently and with cost savings. And so there's a back and forth going on that, but everybody's on the same page. The other thing he touched on was the idea of removing reserve bank presidents from office over different views on monetary policy. And I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Christine. Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right, I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them really since the COVID reopening?
We're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting these events keep happening, which keep driving up costs, and the best thing we can do is to use our tools to guide inflation back down to 2%. I think trying to get there really quickly could be very costly in terms of job loss and things like that, but we try to get there over time in a way that does the least damage possible, and our commitment to that is never-ending and unshakable.
How would you describe the economy outside of the misbehaving inflation? I mean, it's still awfully resilient given all of the blows.
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive thing. If I can have that amendment, yeah, growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that continues. So you've got an economy that's growing at 2% or better. PDFP, which is private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's in a sense, the labor market is in balance, but it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job. So that's pretty good. Inflation is the thing we need to work on. And it's partly tariffs, which we think that inflation should subside over the course of this year because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly, and we'll just have to see how that works out. In the meantime, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. At the risk of beating the dead horse here, clearly 3 members objected to keeping that easing bias in the statement. And you said that the majority still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that, the center is moving toward a more neutral place, and that's sort of what markets are saying too. I just think, there's a lot of signaling going on when you change guidance like that, and so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now. But maybe it'll come to that. And the reason is because, we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the U.S. economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it. And of course, we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to serve as a check and balance on that?
I want to stay until I will stay until I feel it's appropriate for me to leave. And yes, that is really what is driving this. I'm not looking to be, a high-profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. You've made many tough decisions in your time at the Fed. And as your time as chair comes to a close and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that, with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out individual things at this point. I'll just say, we, all of us together, have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation of supply shocks really for 6 years. And that's just a very different situation than, for a very long time, what the Fed and other central banks were doing all the time was demand management. And, and there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging, and we've tried to do our very best through these really challenging times, and I'm really proud of the work that I've done, that my colleagues and I have done during these years.
Now, to follow up on some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical? I mean, what are the consequences if either the Supreme Court rules against Lisa Cook or the Fed in the future decides to make decisions more around the political calendar instead of the economic data?
So every major advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. So after, literally centuries of experience with that, the whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic, inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory, is that don't think about an institution being independent. Think about it this way, that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations, completely ignore them. This isn't bipartisan, this is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy. I mean, think about that. If that's what we were doing, we'd have no credibility. Markets would lose faith in us, and our ability to control inflation and have any respect would be gone. And let me say, whatever people say, the markets believe in that we will produce 2% inflation. If you look at longer run expectations, markets believe that there's no sense in which our credibility in the markets has weakened. It's just not the case. It's people do get it, that this is our commitment and that we will achieve it, and it's priced in. If you disagree with that, then you can go ahead and bet against the markets, but the markets are pricing in Fed credibility.
Okay, we'll go to Richard for the last question.
Thank you, Chair Powell. Richard Escobedo with CBS News. We talked a lot about gasoline prices and even you mentioned airline ticket prices, both of which are up dramatically because of the war in Iran. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending, and that's what the banks will tell you, credit card companies will tell you, the retail sales numbers that we got most recently. People are still spending, and how long can that go on in a world where if gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, and certainly none from this. But you think logically you will, because people have a certain amount of money to spend. If they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in the models that we use to calculate inflation. So they're just parts. You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy, so we're not like a European country where 50% of the external of GDP is in the external sector. We're also, as I mentioned, we're an oil exporter, so we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone. I won't see you next time.
For the last time, the chairman of the Federal Reserve, Jay Powell, wrapping up a very interesting news conference at the Federal Reserve down in Washington, D.C. for the last time as the Fed chair, but that man is not going anywhere. The price action looks like this. Equities unchanged this afternoon on the S&P 500, which is quite impressive given this move in the commodity market. Brent crude very close to 120, higher for an 8th consecutive day, up by 7% on the session, and some significant notable moves in the bond market as well, particularly at the front end of the yield curve. Twos higher by 9 basis points at 392.63. In the next 20 minutes on this program, we need to discuss two things: the future of Chairman Powell, 1, the easing bias at the Federal Reserve, 2, on the future of Chairman Powell staying on as a governor of the Federal Reserve. He was asked why. This is what he had to say.
My concern is really about the series of legal attacks on the Fed. These attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors.
The Federal Reserve Chairman Jay Powell on independence. I think Fed independence is at risk. So what about the easing bias? Let's talk about monetary policy. A question coming into this decision is whether this Federal Reserve would move to a more symmetrical reaction function. That's the jargon. This is the plain speak. Is it just as likely they'll hike as they'll cut? They didn't do it this time around, but there was some dissent. This vote was 8-4, 4 dissents. Haven't seen that since the 1990s. Of those 4, 3 wanted to get rid of that easing bias. This is what the chairman had to say on that issue.
The number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut. That number has increased over the intermeeting period, and it's easy to see why. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and that's where I am. I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
They're getting closer, but they're not there yet. So much to learn, apparently, over the next 30 to 60 days.
I thought that was the most market-moving aspect of the news conference, the idea that it wasn't just the 3 dissenters who wanted to shift to a more neutral kind of positioning, symmetric kind of positioning, but that it was a bigger group that just didn't feel like there was a need to move right now, because ultimately, why move now when so much can change? Nonetheless, this goes on for as long as people might be thinking based on the oil prices in the future. This is something that clearly will come back on the table.
I like the way on the Bloomberg Professional Service we have a way to see the president's tweets quickly. I am waiting to see a presidential tweet. Do we get it by the time the clock turns around here, or do we get it by Meta's earnings here in X number of minutes?
Things have softened somewhat around this institution. Just a little bit. We heard from the Treasury Secretary, Scott Bessent, who said it's understandable if this Fed remains on hold for some time. But the last thing we heard from the president was something like this: if the chairman doesn't leave on time, I'll fire him. Now, what does on time actually mean? Because he can't stay on as the board of governors. He can stay on that board until 2028. Is that on time, or is the president looking for something else?
Are we entering a new standoff? We're dealing with a standoff in the Middle East. We were dealing with a staring contest between Tom Tillis and Donald Trump, and now we might be dealing with President Trump versus Jay Powell, the governor, to see who blinks first, who's going to drop the legal cases, who's going to step away. And this could potentially get pretty tense, especially if the bar is that much higher right now for Fed Chair Jay Powell.
Mike McKee was in that news conference. He'll join us in just a moment. I want to start with Jim Bianco of Bianco Research. Jim, welcome to the program, buddy. I think Fed independence is at risk, the chairman's words. I'll continue to serve as a governor for a period of time. Recent events have left me no choice but to stay. Your reaction, please.
I think it's one of the most disappointing things that he's done during his chairmanship. That is a political decision. The decision was made to push the investigation of the building to the Inspector General. The Inspector General finds some malfeasance or wrongdoing with the building, they'll have a criminal referral. That is appropriate. He seems to be saying that the Fed has billions of dollars in building construction and no one's allowed to ask any questions about it. And he's going to stand in the doorway and disrupt the Fed as long as they're going to look into this building. I think that that is a big, big disappointment. I would have expected more from him, to be very honest. And I'm a guy that liked him. I'm a guy that would have reappointed him. And I think this is a big disappointment that I've seen from him.
Jim, do you think that it has longer-term ramifications for the institution based on the fact that he is saying he does think that this is an independent institution, a committee, but does want to avoid some of the attacks that he says are battering the institution?
Mariner Eccles is the only other Fed chairman that stayed on in the late 1940s. And his memoirs say that he stayed on because he saw with Bretton Woods and with the World Bank and the IMF in the post-World War II period, change was coming, and he wanted to marshal the world through those changes. It seems like what Chairman Powell is saying is, we're 80 years later and change is coming, and I want to stand in the doorway and prevent those changes. He said that he wants to see a more traditional move back to the Fed. He wants to see the Fed institution remain the way it is and not evolve. Now, as far as independence goes, I think we've solved the independence problem with the vote today, 8-4. We have 12 independent voters. The chairman is one of those voters. That is how you're going to get a truly independent Fed. The chairman cannot dictate the policy like he has for the last 40 years. He needs 6 other people to agree with him in order to get that policy across. What's going to happen if we continue to have these dissents? I'll remind you, last year, the Bank of England had a 4-4-1 vote. If we get to a 6-6 vote with this Fed, we're already at 8-4. That gives Chairman Powell all the power to decide what the policy is going to be, even though he said he's not going to give any speeches and he's going to remain in the background. Or is he saying that he will just do whatever Chairman Walsh tells him to do, and that's the way he's going to vote, and he's not going to vote independently? So there's a big problem that he needs to define and try to explain, and he didn't at this press conference.
Jim, I look at this simplistically. I got oil at 119.61, and this announcement that I saw on the Bloomberg that we're leaving an aircraft carrier from the Middle East, the Gerald Ford with 5,400 sailors, I believe it is coming home exhausted. Is Jerome Powell simplistically in the same way just staying to block a Trump appointee, period?
I hope he's not, and I hope that, he's trying to be fair-minded in his decision, and I disagree with the decision, and we can have disagreements in it, and that isn't being as political as that he doesn't want Trump to have another appointee. And by the way, we'll get the Lisa Cook decision by June when the court adjourns, and if they do allow him to fire Lisa Cook for cause, I would assume probably the same day he'll fire Jay Powell, and then he'll get 2 votes, or he'll get 2 open seats to be able to replace. Now, of course, the court could rule otherwise, but that's coming as well too. But I hope it's not that. I hope that it is more that he has a view about the institution not changing in a world where I think we're changing and it needs to evolve, and he's preventing that.
Jim, stay close. I've got Mike McKee standing by. Just hopped out of the news conference. I want his reaction to all of this as well. Mike, you're in the room. Have you got a different perspective on things?
Yes, I think I do. I was listening to what Jim said. I don't think Jay Powell is staying because he's trying to stand in the way of progress at the Fed. I think Jay Powell is staying because he doesn't trust the Department of Justice. He noted at the top that the Justice Department had said that they were dropping the probe, but he referenced back to Jeanine Pirro's comment about we could file another criminal complaint. And he doesn't know what the Justice Department will do, whether or not there would be validity in what the Justice Department might do. So he wants to make sure that that is the case, and he will at least probably stay through the Inspector General's report. It is also possible he would stay on beyond that in order, as you did mention, that in order to deny the president the possibility of another seat if he thinks what the president wants to do is take political control of the Fed.
So, Jim, I want to give you a chance to respond to that. If anything, the chairman's been consistent. He set a bar. He said this needs to be wrapped up with transparency and finality. And based on the comments we've heard, according to the chairman, he thinks they've fallen short of that bar, Jim.
Yeah, I think he thinks that. Senator Tillis does not think that. That's why he voted today to advance his nomination. And I agree with Mike that he does not trust the Justice Department, but it's not his call. It's the Justice Department that the American public elected through the election of Donald Trump. And if he doesn't like it, he's going to then stay as a disruptive force to the Fed to prevent them from making any kind of changes or referrals or even looking in. Remember, this is all about the building cost and why it's been taken several years and is run so expensive. And it seems like he's saying we're not allowed to ask.
I got another disruptive force to talk about, Jim. Allow me to jump in. 120 on Brent. Just breached that level moments ago. Higher on the session by 8%. Let's just take a step back. The chairman's future is one part of the discussion. These market moves are something else at the moment. Brent at 120. Just sit on that. Yields higher at the front end of the curve, retesting the highs of the last 2 months or so. And equities, bring up the equity screen at the moment. Equities this afternoon, in the face of these moves in fixed income, these moves in commodities, doing almost nothing, Bramo. Hardly moved, not even phased ahead of these earnings later this afternoon.
And this was what the Fed was talking about, right? We have the NASDAQ actually up 0.4% ahead of those earnings. As we look to the strength that Fed Chair Jay Powell was talking about at his last press conference, but this is where it becomes tricky. At what point do those higher oil prices that might be leaving big tech unfazed become an inflationary pressure that could be withstood simply because there is enough momentum in this economy?
Jim, let's get to the price action. Not so interested in shouldn't, interested in market consequences. Here's a Federal Reserve debating dropping its easing bias, pressure building in the commodity market, rates repricing, yields higher. What are the consequences, Jim?
Oh, I think the consequences are huge because if you look at the way that oil is trading, you're right, that the June contract went over 120 a few minutes ago, and that's the highest it's been since June of 22. What about the long term? Okay, let's look at the December contract. The December contract is making new all-time highs too. And it's saying to us, at least if you want to take it at face value, that the price of oil is going to stay elevated at least through the end of the year. As Chairman Powell said, we already have, he said, 3.5% on PCE inflation. That's their measure. And if it's all driven by energy, it's going to stay there right now. And it's going to be problematic for the Fed to even talk about an easing with that level of inflation. It's not going to disappear and go away unless there's some resolution in the war. And the problem is the market doesn't see the resolution in the war. That's why both the June all the way to the December contract continues to move higher.
Hey, Jim, good to see you. Appreciate your opinion. Jim Bianco there of Bianco Research. Mike, always good to see you, buddy. Great work in the news conference. Mike McKee down in Washington, D.C. If you're just joining us, welcome to the programme. We are set up for quite an afternoon now. In the next 60 minutes or so, we should hear from 4 of the biggest companies on the planet, Microsoft, Meta, Alphabet, Amazon. Before we get there, some big market moves to talk about. 8 consecutive days of higher crude prices. Brent crude through 120. Just briefly, we've taken out the highs of the year on a closing basis. If we close at these levels, 119.95. Look at that. WTI comfortably into triple digits. This move in the bond market off the back of it. Yields higher at the front end of the curve, up by 10 basis points. Not just about oil, also about this Federal Reserve. If you missed it, here's a summary. An 8-4 vote. Haven't seen that level of dissent since 1992. Of that 4, 3 hawkish dissents, a conversation about dropping the easing bias. They haven't got enough people on side just to do that just yet, but we're losing support for that easing bias at this Federal Reserve.
And potentially, if this conflict in the Middle East doesn't get resolved, then all of a sudden you will have a consensus to move to asymmetric risk. We have now priced out a rate cut for 2026 in the Fed funds futures. At what point do we start repricing in hikes? Because ultimately, this is an economy that can withstand oil prices at this level, rates at this level, and that was the word that we heard from the Federal Reserve.
Repricing here is hard because it's a war. Somebody mentioned there, it's a war. We forget we're in a war. And within that, I don't know what the unknown is tomorrow or out to June 17th. Nobody knows. We're just going to take in the data and take in the war news. And what I'm waiting for, John, is to take in the next marginal President Trump tweet.
The S&P 500 down by 0.1%. If you looked at that, it was a snoozy afternoon and nothing happened at this Federal Reserve meeting. That's just not the case. Jeffrey Rosenberg of BlackRock joins us now for more. Jeff, what's the bull case in the face of what's brewing elsewhere?
Well, you highlighted it well between trying to disconnect what's going on between oil prices and the committee meeting today and what we heard. And, I want to highlight, the thing that I found most interesting about Powell's comments were explaining I think the second main point and takeaway of the meeting, which is this theme of a divided committee that comes out of the 8-4 vote. And he framed it as a natural consequence of the conflict in the Fed's objectives between growth and inflation, which the $120 oil, is that point. And he got asked the question about pass-through. And this is, I think, what the markets are really struggling with is he basically made the point. It's all about the time of which the Straits of Hormuz remains closed. And no one knows what that will look like. So Jim just talked about the forward curve, December contract making its new highs, but it's significantly lower than the front end of the curve. So there's an expectation here that at some point that's opening up. We don't know what that is. is. And I think divided committee is likely to be the continuation because of this point that Powell highlighted, that when you're faced with the conflict of the dual objectives, that people are going to see that in different ways. Some are going to be arguing for the growth impact, some are going to be arguing for the inflation impact, and that might be the more expected outcome as opposed to what we've seen and the historical comparisons of this being, very unusual. Maybe get used to that being a little bit more usual.
Jeff, it seems like the conflict in the Middle East isn't necessarily that close to wrapping up. Maybe it is, and we just all are getting mixed signals. Do you think this market needs to price in a greater chance of a rate hike as the next move by the Federal Reserve?
Well, it's already done that. And to this discussion about the easing bias and the language, the market already took the easing bias out. It did that at the onset of the oil price impact from the Iran war. So I don't think that as a catalyst for sort of the next move. That's mostly, the Fed is a deliberative body, getting the right number of people willing. You heard Powell talk about that. They're slow to move that bias. The market is not, and it's moved the bias to easing out of the market pricing. So I don't think that's really the market event. The market event is really the uncertain, unknown question that he was asked. What's the pass-through from headline inflation to core inflation? You heard Warsh talk about it in terms of trimmed mean and not looking at core PCE as a measure. That's a very particular way of looking at the potential for pass-through. Will he get and move the rest of the committee onto that view? If so, that's a very dovish implication, and you bring the bias back in. But as Powell highlighted, we really just don't know, so you're going to have to see whether or not those pass-through of headline into core shows up, whether Warsh's more dovish interpretation shows up, and whether he can push the committee towards his direction. And that will bring the bias back into market pricing, but right now we're pricing it out.
Jeff, I got 8 questions and time for one, and it's just simple. For our listeners and our viewers across this nation and worldwide, what is the best tool to use in the bond market to study the potential dynamics? Don't, the benchmark 10-year or is there a unique Rosenberg spread that makes sense? What is the efficacious way to study the pulse is seen in fixed income?
Yeah, Tom, the kind of historical rule of thumb is if you want to keep it simple, it's about the 5-year maturity point on the Treasury curve. That's kind of impacts the best estimations of where you're looking for current and forward-looking Fed expectations, and that kind of is your benchmark for looking at. You can look a little bit shorter. 2-year is going to be the more near-term expectations. I think that's a really good metric. And then on the inflation side, remember inflation, headline inflation is going to impact shorter maturities. You want to look a little bit further out. You can look at the slope of the curve. 5-year forward measures on break-even inflation is better when looking at longer-term market expectations of the impact on inflation. And so far, that's been relatively benign, and so that's kind of supporting, Powell's comments in terms of market longer-term expectations not being unduly impacted. If you started to see that change, that's going to be a major signal for Fed policy pivoting more towards the inflation concern if you start to see that show up in that metric.
Jeff, last question from us. Last time we had yields at these levels, close to them, was the end of March. And every person we spoke to in fixed income on Wall Street had a very favorable interpretation of these moves. They said we were creating value and they wanted to buy it. Jeff, do you think we're creating value this afternoon, and do you want to buy?
Well, I think the move in the front end is creating some value. You're seeing a big curve flattening. Again, a lot of it is conditional on that pass-through of inflation, but stepping out of the curve into the front end, we're having Warsh come in. He's already signaled that he wants to look through that and take a more dovish interpretation. Will he be able to bring the committee along with him? When you start pricing hikes in, it depends on the oil move and it's persistent, but I think there's a little bit of value there. Completely different answer, really to the opposite side when you look in the long end of the curve. The long end needs to build term premium. We got a savings glut that's turning into a savings deficit, particularly as we need to reshore, rebuild, reallocate in global savings around the implications of this Iran war. all at the same time as fiscal deficits are increasing the demand for that borrowing. I think there you see a different story, and that's less of a buying opportunity and more of something we're going to need to see increase in terms of the term premium to bring investors back into the long end of the curve.
Hey, Jeff, good to see you. Great answer. Jeffrey Rosenberg there of BlackRock, breaking down his views, not because I think it's the right answer, just it's an important answer to a very difficult question right now. Two-year yields higher by 10 basis points, 10s at 441.
If you think that right now there's a great opportunity to buy in the 10-year, give us a call, because right now everyone who we ask seems to go right to the front end and saying that's where I'm going to get some yield. But right now on the long end, things might be changing, and ultimately we just can't get ahead of it, and that seems to be a theme again and again.
Bob just emails in. He's on his way to F1 in Miami here. And Bob's looking at it, and he's going, the price of gas went up 10 cents yesterday, 22 cents this week. People aren't eating out at restaurants. That's got a lot more to do with this than any of the fancy
That
talk.
flight got more expensive. This afternoon is not over. Big tech coming up after the close. Coming up tomorrow on Bloomberg TV, on Bloomberg Surveillance, we'll kick things off with Julian Emmanuel of Evercore. We'll catch up with Mike Wilson of Morgan Stanley, and a whole lot more from New York City this afternoon. Good afternoon.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Welcome to Bloomberg Business Week Daily. I got to say, it's a Fed decision day. There's so much coming at investors on this Wednesday. We're just minutes away from 80 seconds of a Techapalooza, big tech earnings that may very likely decide where the market goes next. We're talking about Alphabet, Amazon, Meta, Platforms, Microsoft. Tim, all coming out after the closing bell.
Yeah, that's 4 of the 7 Mag 7. It is what we call a high-octane Wednesday. It's April 29th, 2026. A special day, of course, because it is a Fed Wednesday, and we're getting all of those earnings. Coming in another big market event, that third FOMC meeting and decision of the year.
Yeah, and we just have to say, Fed officials, as expected, left rates unchanged, revealed a deepening division, though, over the outlook for policy amid increased uncertainty caused by the conflict in the Middle East. 4 officials voted against the decision, including 3 who objected to language in their post-meeting statement that suggested the central bank would eventually resume cutting rates. So you had that come coming out. Gotta say, the meeting, though, I think the big headline was what we heard from Fed Chair Jay Powell. Likely his last meeting. Actually, he did say this was his last meeting at the helm of the central bank as the Justice Department dropped a controversial criminal investigation into the Fed, clearing the way for the Senate confirmation of Kevin Warsh as the next Fed chair. However, Jay Powell not exactly going anywhere.
I've said that I will not leave the board until this investigation is well and truly over with transparency and finality, and I stand by that. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have I think, left me no choice but to stay until I see them through at least that long.
All right, so he's not headed to the golf course or a bridge tournament.
I was going to say that retirement's going to have to wait.
That, of course, was Fed Chair Jay Powell at today's press conference. Next FOMC decision, in case you're wondering, June 17th, 2026, Tim.
With more on today's Fed decision and market reaction, let's bring in Jason Draho, Chief Investment Officer, Head of Asset Allocation at UBS. He joins us here in our Bloomberg Interactive Brokers studio. We'll get to the markets and the path for interest rates moving forward and the effect of the war on inflation. But first, the news about Jay Powell staying until this investigation is over, or rather until he feels like it's appropriate for him to leave. The Fed's independence, he says, is at risk. What are your takeaways?
Look, I think it was the first question he's probably going to be asked, so I think he just preempted it. From the market's perspective, you get a read of that uncertainty. Will he stay, won't he? So we know he's going to stay. The question is, obviously, for how long, and that's, I guess, probably to some extent out of his hands. Ultimately, what we assess is, does it change the direction of path for monetary policy? I think near term unlikely. The committee was more surprising as the three dissenters to the statement. That's kind of unusual. It's like dissenting against a hike or cut, but it tells you that the committee is divided, and that to me is that's the bigger story.
Well, he said to continue on Jay Powell. He said he's not going to be some sort of shadow Fed chair. He will maintain a low profile. He's not going to try to influence the next Fed chair. But yet he still feels like it's appropriate for him to stay. Does it change the path of monetary policy, him staying versus him leaving?
I think it's unlikely, just because think about the path going forward.
You do think it's unlikely that it changes, or
I don't think him staying to me does not change the outlook that we would have for monetary policy.
Okay.
Only because right now, the key drivers, like where's inflation, where's the economy going? I think June, it's very unlikely given where the committee is, and then you kind of play out like where is the data? As we get into the summer, our official view right now, September, December, the Fed cuts. I think the risk certainly is it gets pushed back later. I think from a market's perspective, whether it's September, December, Q1. Not a big difference. It's really going to depend on where's oil prices, where's inflation, where's the labor market. If the data is not warranted to cut, I don't think the Fed cuts. I don't think there will be enough consensus. So whether Powell's there or not, I think there's enough people who are against it right now to suggest that in the near term, the next few meetings, that it really changes the path.
Yeah, he talked about vigorous debate. We can assume that debate will continue under Kevin Warsh. We're assuming, of course, that he will be, and it sounds like he will be based on what happened this morning, that vote, that he will be the next Fed chair. Having said that, Jason, Jay Powell out of the press conference, right out of the gate, U.S. economy has been expanding at a solid pace. Job gains are low. Unemployment little changed, consumer spending resilient, business fixed income expanding at a brisk pace, housing sector remaining weak. Estimates based on CPI suggest PCE rose. I mean, this is not an economy falling apart, right? So at this point, if the momentum continues, if the labor market starts to come undone, is that what triggers the Fed in your view?
Well, if you look at the totality of data, there are people out there who'd say, why is the Fed cutting? The economy is growing at 2%. The unemployment rate is actually ticked down. Job growth, if you take the last 3 months of private sector job growth, it's about 79,000. Estimates of the break-even rate to keep the unemployment rate from rising is less than that. Like, let's say it's 20 to 50. The Fed, as Powell said last meeting, it could be as low as 10,000. So you have an economy that's doing fine. Inflation's above target, will continue to stay above target for a few months. Why cut? So our view is that ultimately the Fed, their framework and all the research would say they will tend to look through these oil price spikes for inflation. They'll look at the core inflation measures. Those still seem to be trending lower. The tariff component of inflation looks like it's going to run off. And so then it's like you can sort of be balanced. If the labor market does weaken, they would sort of move in that direction.
What if inflation stays persistent, but the labor market starts to come undone? What does which favorite child does the Fed choose to listen to?
mean, to some extent, this question, like, for Kevin Warsh, how strongly he feels about those two aspects.
Yeah.
What I would say, just looking at for the past few years, anytime the labor market's really showing signs of weakness, you've seen a Fed that's kind of reacted to that. That was the case when they started with a 50 basis point cut in September of 24. It was after some weak job data in the summer. I think, at other points in time, any signs of weakness in the labor market, they've been pushing forward. So just based off of that, I would err on the side. If you see, unemployment go up to 4.6%, I think they'd move towards cutting.
So, have we covered everything we need to with the Fed to move on to the big tech earnings? Do you think there's anything we've left out?
I think we've kind of covered it for now, yeah. I mean, basically, bottom line, not a whole lot of new information from a Fed policy perspective.
All right, let's get to the 80 seconds that matter for markets. It's
really crazy.
Oh, it's really crazy. I mean, it's not often that we have a Fed decision on a day when we have 4 of the 7 Mag 7 stocks reporting. Alphabet, Amazon, Meta Platforms, and Microsoft all set to report earnings after the bell. If we look at what happened last quarter, that all happened within 80 seconds of one another. Which is the one to watch if you would have to choose one?
Oh my
speaking
gosh.
of favorite children, yeah.
So I would actually leave that to our tech analyst who's going to be going crazy for the next few hours. I would look more at the totality, what does the overall trend in terms of guidance for CapEx spending?
Yeah, CapEx. I knew you were going to say that
because that's every quarter they've been sort of moving higher. It was a big jump higher in Q1. I think it's unlikely we're going to see that level only because you don't do it every single quarter. It's probably like a big one-off, and then you kind of go from there. Any sort of evidence of monetization, kind of general themes there. That's what investors would be concerned with.
It seems like investors are okay with CapEx for 3 of these 4. With Meta Platforms, they don't love it as much. Is there sort of a balance when it comes to, because if CapEx comes in above expectations, then these companies can take a hit. But then if CapEx comes in below expectations, they're like, wait a second, where's the demand for this stuff?
And I guess I would argue, and tell me, Jason, it's the totality. Okay, if you're spending, great. If it doesn't eat into margins too much, great. If cloud is expanding, great. You've got to look at, and not me, but our own Anurag Rana kind of laying it out, that those are the 3 metrics. You've got to kind of look at the entirety of it.
So I think what we've seen coming up into kind of this week today for these numbers is that, the money's been spent. Someone's making the money. We can see some maybe downstream other companies who are, involved in supplying, other chips, energy to this whole build-up. They're benefiting. The question is, are the hyperscalers going to sort of benefit? I think that would be a key thing that the market would want to see is can they start to monetize in general? Because I think it's more a statement about, from my perspective, the overall AI thesis as opposed to individual companies. I'd leave that to kind of more the experts to dive into that.
I think we can connect this to the Fed because there was a moment where Jay Powell said, I think these were his words, the insatiable demand for data centers in this country.
Continuing, right?
Continuing, yeah. If that doesn't continue, then what are the macroeconomic effects of that?
Well, if you just take the numbers at face value, through Q1 or in Q1 when they announced their results, the 5 hyperscalers combined capex was in the neighborhood of $650 billion this year. Now you think of it as a percentage of GDP, that's about 2% of GDP. You think about the incremental growth this year versus last year, that's your sort of delta for growth. That was one of the key components when we had earlier this year, growth in the mid 2.5% range. That was a key component. So if you take already, some of the tax, or not the gas price sort of being a drag on the consumer, if spending isn't there, that does kind of lower overall growth. But again, it's, I think it's, we're talking a couple tenths of a percent. It's not a material change.
All right. Are valuations, though, a little bit overdone heading into earnings here? And we've seen quite a bounce back. Just got a few seconds.
Big picture earnings for, the Mag 7 are cheaper today than they were 5 years ago. Yeah, because the earnings have been so strong. So I think that's not a big concern.
Yeah, and I do want to point out that we have seen the NASDAQ 100 firm after the Fed decision. And as Jay Powell continued talking, I mean, the market, NASDAQ 100 specifically, was up about 82 points ahead of the Fed decision. It's up 140 points, up 0.5%.
Look,